uncertainty is stability and convergence. For this reason, regulatory texts, as the ones that I will talk about today, that bring legal certainty, ensure a level playing field across the EU, and aim to manage risks while promoting innovation, are of paramount importance. Let me start with DORA, the Digital Operational Resilience Act. Actually, as finance becomes overwhelmingly digital, institutions that harness new technologies gain a competitive edge by providing consumers with round-the-clock access to their systems and instant transaction times. A significant number of financial institutions rely on technologies and utilize AI capabilities to deliver services faster and more effectively. What sets the current digital transformation is exactly the fact that the many interconnections and interdependencies across countries, firms, markets, and third-party providers of ICT services exist. Yet the same interdependence that enables competitiveness gains also amplifies operational and cyber risks, including concentration in critical ICT service providers and more complex incident cascades. This is exactly why DORA matters. For the first time, we have a single technology-neutral framework on digital operational resilience across the financial sector, aimed at safeguarding the transition from traditional models to the digital age. DORA consolidates and strengthens those ICT risk management requirements that up until now were spread over various financial services, legislative texts, and that gives us a stable operational backbone on which financial digital innovation can thrive more safely. What exactly DORA changes for financial institutions? Three main things. First, common major incident reporting, which means single EU taxonomy, timelines, and data standards for major ICT incidents and significant cyber threats, which enable their comparability along with faster and more coordinated action to address them. Second, mandatory thread-led penetration testing. That means that for selected entities and on a 3-year cycle, control checklists are replaced by intelligence-led scenario-based tests that validate real-world operational resilience. And third, direct EU-level oversight of critical ICT third-party providers. And this recognizes concentration and contagion risks in shared infrastructures. These innovations included by DORA, when combined with strategy, governance, and strategic and testing obligations, shift operational resilience from being just an IT tool to an enterprise-wide capability. And that requires clear understanding and sufficient support by senior management. We are 10 months now into the implementation of DORA. Implementation started in January 2025, beginning of this year. What we can safely discuss is the fact that we can see and observe divergence in the institution's maturity levels. As expected, credit institutions are much more mature, typically ahead, and that reflects their adherence to earlier ICT risk regulatory regimes. On the other hand, insurance, payments, and e-money firms and the newly included in our supervision perimeter institutions for occupational retirement provision are moving fast, but from a lower starting point compared to credit institutions. Another observation is uneven operational mapping. Some financial entities still struggle to map critical or important functions against accountable owners, supporting processes, information assets, and ICT services, and moreover, to keep these maps and asset inventories up to date as their systems and architectures evolve. ICT third-party risk management is currently the heaviest lift. In Greece, our points of attention for financial entities are consistent with those in the rest of the EU. build a high-quality, error-free register of information, and institute a third-party management system that detects underachieving service level agreements and concentration risks is really important. According to our data, major incident management still needs sharper reactions and faster internal escalation, disciplined external notification, and better stakeholder communications when events are unfolding. Resilience testing must also mature from ad hoc penetration tests to risk-based annual programs. That requires building up the internal coordination capacity and securing credible threat intelligence and testing partners. Finally, strategy and governance require a firm-wide digital operational resilience strategy. This strategy, which should include scenario testing, investment roadmaps, and regular board engagement, should expose gaps in the management of ICT risk and be linked to a periodic review of the ICT risk management framework. Beyond these observations that we make at local level, early feedback from DORA policy work at EU level has also underscored the need for stability and clarity. Stakeholders ask for proportionality, streamlined incident criteria, and consistent treatment of subcontracting and outsourcing. On paper, this has been achieved with the adoption of standards. However, consistent application among supervisory authorities remain the real test, and this is why it is important for further supervisory convergence. Let me briefly turn to MiCAR, another very important regulatory initiative. The regulation on markets in crypto assets. This regulation is designed to protect investors and safeguard market integrity, while at the same time addressing systemic risks linked to crypto assets that purport to maintain a stable value. These risks concern financial stability, payment systems, monetary policy transmission, and monetary sovereignty. Importantly, MiCAR leverages the development of crypto assets to support innovation in the sector. At EU level, supervisory convergence is fostered by the EBA and ESMA in close collaboration with national supervisory authorities. In Greece, the relevant law has been adopted, and it provides for the Bank of Greece to have the prudential supervision of credit institutions, electronic money institutions, and payment institutions that plan to issue e-money tokens and asset reference tokens, or to operate as crypto asset service providers. We have also the power to license these entities and to impose administrative measures or penalties for breaches of the regulation. Now, recent developments show that the stablecoin market has grown rapidly, increasing its linkages with the financial sector and thereby creating potential implications for euro area financial stability, banking sector soundness, payment services, and the international role of the euro. US dollar-denominated stablecoins dominate the global market, while euro-denominated stablecoins remain marginal. Nevertheless, growth in the latter has picked up since early 2025, following the regulatory clarity provided by the MiCAR regulation that I just mentioned. Two key concerns have emerged in connection with implementation of MiCAR. The first relates to multi-issuance schemes, meaning fully fungible stablecoins issued jointly by EU and third-country entities. As has been noted recently by the European System of Risk Board, such schemes have built-in vulnerabilities and may operate under regulatory regimes which are much more lenient than those for financial conglomerates, raising the question of divergent prudential standards. The second concern relates to the interplay between MiCAR and the revised Payment Services Directive, particularly for e-money tokens, where certain activities could trigger overlapping requirements under both regimes. And that is exactly what gives rise to a risk of double licensing and regulatory complexity, which supervisors and the EBA are seeking to address through transitional arrangements and future alignment of the two frameworks. At the global level, the regulatory landscape remains fragmented, creating risks of regulatory arbitrage and cross-border contagion. In the US, the Genius Act advances federal stablecoin legislation, but with a narrower scope compared to MiCAR, covering only payment stablecoins. Its provisions are generally more favorable to the development of stablecoins, including broader eligibility of reserve assets, exemptions from certain capital requirements, and the possibility for service providers to pay interest, which MiCAR prohibits. Such divergences may give US issuers a competitive edge, reinforcing the dominance of US dollar-denominated stablecoins. To safeguard European interests, it will be essential to close interpretation gaps in MiCAR, promote euro-denominated alternatives, accelerate progress towards the digital euro, and develop DLT-based settlement solutions. Future adjustments to MiCAR will also be key to ensure a level playing field with issuers in other jurisdictions while effectively managing risks. I will turn now to a brief presentation of the Artificial Intelligence Act, which has been enacted recently with an EU regulation and establishes the world's first comprehensive regulatory framework for artificial intelligence. It will become fully applicable in August 2026, while certain obligations are already have already taken effect. The AI Act seeks to balance the protection of fundamental rights with the promotion of innovation in AI. The most important AI obligations that come from the relevant act relate to the management of potential risks before an AI tool is put into productive operation. Transparency in order to ensure that natural persons are always aware if they are interacting with AI systems and that content generated or manipulated by AI systems is flagged as such, as well as accuracy and safety. Obligations are addressed to all entities in the value chain. The regulation applies a risk-based approach, which means that it distinguishes between totally prohibited AI practices, high-risk systems, and limited-risk systems. It has established several bodies and fora at the EU level to coordinate exactly its enforcement, secure consistent implementation, and also address systemic risks arising from general-purpose AI models. Looking ahead, the success of the AI Act will rely on close cooperation among authorities, sufficient technical expertise, and a balanced approach that fosters innovation while upholding trust and accountability in the use of AI across critical sectors. Allow me to turn now to Basel IV. As you probably know, Basel IV standards represent a major evolution in global banking regulation. They are designed to strengthen the resilience and stability of financial institutions, enhance prudential oversight, governance, and risk management across the EU banking sector, provide stronger tools for monitoring emerging risks, upgrade stress testing, and improve supervisory reviews. The reform process related to the Basel standards, after extensive negotiations, it culminated in the adoption of the regulation commonly known as the Capital Requirements Regulation, CRR3, and Directive on Capital Requirements, CRD6. The implementation of CRD6 will introduce new rules for both EU and non-EU banks operating here in Greece, notably third country credit institutions that provide core banking systems, core banking services in Greece will be required to apply for authorization to establish a subsidiary. Moreover, EU banks must notify in advance to the Bank of Greece of any mergers or divisions, material transfers of assets or liabilities, acquisitions of material holdings in other entities, and will be subject to periodic penalty payments on top of administrative penalties and measures. These are some of the upcoming changes under this harmonized set of rules, which overall brings more activities under direct supervisory oversight. I will close my intervention on today on the developments of regulatory texts with a reference to the CMDI framework and the current work on simplification. Recently, there has been an agreement between the European Parliament and the Council on an agreement on the crisis management and deposit insurance framework. This will mark a significant improvement in the EU framework for managing the failure of banks, and the agreed provisions enhance especially the ability of authorities to deal with small and medium-sized banks that could have implications for financial stability either at national or regional level. The banks that do not have sufficient MREL, minimum requirement for own funds, and eligible liabilities capital, can, as a last resort, rely on deposit guarantee schemes or resolution funds to finance their resolution without bailing in their depositors. Given the agreement reached on the CMDI framework and the enhanced resilience of the euro area banking system, it is time to press ahead with the establishment of the third pillar of the banking union. The European Deposit Insurance Scheme, the EDIS, would strengthen the resilience of the banking sector even further, as it could fully cover both liquidity needs and losses in resolution. A common scheme would ensure that the level of confidence in the safety of bank deposits is equally high across all member states, thereby reducing the risk of bank runs and safeguarding financial stability. Keeping depositor protection at the national level maintains the bank's sovereign nexus, impedes the creation of a level playing field, and weakens financial stability. As my concluding remark, I would like to note that the EU is currently working on the simplification of the EU regulatory framework. This started with the publication of the Draghi report and before that the Letta report, both of which singled out regulatory simplification as key for unlocking EU competitiveness. EU institutions have initiated efforts to simplify supervisory rules and practices in order to remove unnecessary complexity, enhance coordination, and achieve shorter implementation timeframes. Simplification, as perhaps you have heard before, does not mean deregulation. Supervision and regulation form a framework that preserves financial stability, protects depositors, and shields the real economy from the impact of bank failure. This safety net should not be compromised in any way. The Bank of Greece fully supports this initiative, and it stands ready to take on the powers and responsibilities assigned by the regulatory framework, and it will continue working to maintain stability, facilitate progress, and support economic growth. With this, I thank you once more for the invitation to join you today, and I wish you all success for your 2 days meeting. Thank you.
Thank you very much. Well, this was the perfect timing. I mean, I cannot do it better. Thank you very much. So, thank you very much. We are continuing with our program. Our next speaker is Gheorghe Panou. Hope I pronounce it well. The head of Innovation Center Group Digital Banking, and he will be talking to us about banking trends. So quite a good follow-up after the regulations. Let's see what else is there in the banking trends and innovation. The stage is yours.
Thank you, Davor. Can you hear me? It's okay. So good morning, everyone. Thank you again for inviting me to this World Banking Forum. I was same year in Vienna, so this is an autumn-summer edition. So my name is George Panou. I am the head of innovation at Eurobank. It's an honor to be here presenting this in my hometown. So the world of banking is evolving faster than at any point in the modern history, not because banks suddenly decided to innovate, but because people now expect to experience more and something completely different. They expect banking to fit life, not the other way around, and that changes everything. So this is not working, Christina? Okay, just for a small housekeeping, this is just for informational purposes and not investment advice. Okay, so why do I care about the banking future? Okay, actually, I lead the Innovation Center in Eurobank, and our role is simply but challenging. We need to turn the future into real things and people can use. We experiment with AI, open banking, digital identity, sustainability, and other innovations. And we work hand in hand with fintech, startups, universities, and big techs. We every day ask ourselves how we need to make banking better. Okay. Sorry about that. It's not my fault. So to understand the trends in banking, we must first understand the pressures shaping them. Okay. Okay. So we have technology advancements. Technology is accelerating faster than people can absorb it. AI, IoT, quantum computing, quantum security, and sixth-generation networks are reshaping what's possible every year. Another megatrend, demographic shifts. Our population are aging, cities are growing, and mobility is redefining workforce and customer expectations. Environmental stability. Sustainability is now financial strategy. Climate risk is business risk, and banks must lead the transition. Economic shifts. The center of economic gravity is moving. Digital economies and emerging markets are rewriting competition. We have social changes. How we work, learn, and maintain well-being, we'll see some examples later on, have been transformed. Customers expect empathy and support from the brands they choose. Geopolitical dynamics. Uncertainty is the only certainty. From power shifts to trade tensions, resilience becomes a strategic imperative. Last megatrend, cultural and ethical evolution. Trust, fairness, and purpose matter more than ever. Organizations are judged by their values, not their results. So these megatrends are not abstract. They are shaping banking as we speak. And they are the new operating environment banks must work on it. Let's move on to the key technologies that redefine banking before we proceed to the trends. These are the technologies that are changing banking from the inside out as the very foundation of customer experience and operational excellence. We have artificial intelligence and generative AI. AI, especially generative AI, is the brain of any bank. It's how we unlock value. It's to give proactive guidance to our customers, real-time decisions, and natural language interactions. The other trend is cloud computing and core modernization. To innovate at speed, we need flexible, resilient infrastructure, scalability on cloud, integration, and faster time to market. Another technology that is reshaping banking is open banking and open finance. Open APIs turn banking into a platform, enabling partnerships and embedded financial services into other ecosystems. Mark Weiser, then he introduced Calm technology, and he said the most profound technologies are the ones that disappear. We have, on the other hand, automation and AI agents So from onboarding operations, making things easier, comply to the EU regulations. Automation frees humans from repetitive work and reduces costs to serve dramatically. We have cybersecurity and fraud prevention. Trust is a feature, and without security, everything collapses. Another very interesting topic is blockchain, stablecoins, and CBDCs. As Mrs. Papakonstantinou said, I had a presentation last night introducing stablecoins, and I will tell you something that was recently announced. 9 big banks have created a consortium to create a stablecoin, and also 10 mega banks, including JP Morgan, Goldman Sachs. They have created another consortium in order to create another stablecoin. And you will ask me why. Because of programmable money, because of faster settlement, no intermediaries. So this is a very big breakthrough nowadays. Internet of Things. Our devices are becoming financial touch points, and this can be integrated to banking, everyday banking. From mobility, smart homes, wearables, enable contextual, invisible payments. Another technology that helps shaping banking is hyper-personalization and immersive experiences. We may all have seen banking through the lenses of augmented reality, virtual reality, and emotionally user experience. We have quantum computing and quantum-resistant security because you have to be prepared and using quantum algorithms in order to protect yourself from what is coming. And last but not least, we have digital twins, which is very important because you can replicate processes, run tests on a bank resiliency, for example, and even customers that will allow simulation, prediction, and optimization that is before making real big changes. So all these initiatives are converging to deliver a smoother, smarter, and more human experience. Before we delve into the banking trends, let's see what is the paradox banks face today and why we all should care.
Banks today face a paradox. Digitization has transformed banking, making it faster, simpler, and more convenient than ever before. But at what cost? In the relentless pursuit of efficiency, something vital has been lost: the human connection. Disconnected, overwhelmed by generic services. Customers see no difference between financial brands and no reason to stay loyal. To move forward, banks must go back to what made them trusted in the first place. AI holds the key to resolving the paradox. While digitization made banking efficient but impersonal, AI will restore recognition, understanding, and trust. It's not just about technology, it's about a mindset shift. From why can't we to how might we? This transformation will reshape banks into trusted financial partners, building deeper connections and creating value for all. Sometimes the best way forward is to bring the past into the future.
So we have to travel to the past in order to go to the future. This is the paradox. So trend number 1, AI-powered personalization. And why is this a trend? Because customers expect to be understood instantly. People don't want more products, they need experiences, and they need the right help at the right moment. AI makes banking relational, not transactional. Imagine your bank saying, George, your utility payments is up to 20%. Do you want to check why? It looks like you're traveling. Here's an instant card protection abroad. So to be proactive, that's value, and that's loyalty. Trend number 2, composable banking and embedded finance. Why this is a trend? Because banking moves to where life happens, everywhere. The best banking experiences often won't look like banking at all. We said that the most profound technologies are the ones that disappear. So when you shop, travel, rent, move, split bills, money flows quietly in the background. And that's where banks suit perfectly. APIs let banks plug into those everyday moments, and the relationship shifts from come to the bank to the bank comes to you every day. Another trend is sustainable finance and ESG. Sustainable choices are financial choices, and sustainability used to be about image. We all might heard about greenwashing, but now it's a risk, it's profit and purpose. Customers are actively choosing banks aligned with their values. From green bonds, carbon footprint tracking, ESG is shaping product design, risk models, and brand recognition. Regulators are watching investors, and investors are demanding, and customers are voting with their wallets. Trust in banking is increasingly tied to doing the right thing, and customers follow. Trend number 4, phygital banking. So why is this a trend? Convenience and human reassurance is a winning combo. After all these years of development, we learned something very important. People love digital until they need a human intervention. Bank branches are becoming advisory studios. Mobile apps become life companions, transforming into super apps. The future is not digital only. It's digital first and human supported. Trend number 5, fintech collaboration and ecosystems. Why is this a trend? No bank can build everything internally anymore. We need help from fintechs, and we need to innovate faster together through collaboration. Fintechs bring speed, specialization, and banks bring scale and customer trust. When we stop asking build or buy and start asking who do we build with, that's when we unlock true growth. Trend number 6. Why is this a trend? We say you can innovate only as fast as you stay secure. So cyber risk is systemic. It's about the bank and the security about the bank. Customers expect safety without friction. RegTech allow us to automate compliance and prevent threats before damage occurs. Security is evolving to a very competitive advantage. We need to protect the customers. Trend number 7. I think this doesn't have to do with technology, but it is very, very important. Workforce automation. People and AI is the future. AI doesn't take jobs, okay? I think that AI just augments people. Human focus on trust, creativity, and complex judgment. Upskilling, continuous learning, culture of experimentation, this is what truly transforms a bank. People aren't the cost. People are the differentiator, and we must invest in people. Together, with AI first, we can do miracles. Last trend, and very, very important, generative AI and conversational banking. This is a trend because conversation becomes the new UI. 3 major forces drive this trend. Gen AI is now capable of understanding context and giving personalized financial guidance. People prefer conversation over navigation, and additionally, Gen AI not only understands, but also executes with AI agents. So banking in 2025, it becomes seamless, predictive, human-centered, and purpose-driven. So what comes next? From solving problems to preventing them. It feels almost like we're transitioning to a guardian banking model. Your bank is watching out for you. And I'm closing. So this is the A bank of the future. In the bank of the future, AI becomes the core intelligence behind everything we do. It powers every major decision, from how we acquire and onboard customers to how we assess risk, prevent fraud, personalize advice, and keep people engaged. It's the heart of the operating model, enabling experiences that feel simply proactive and truly supportive. Thank you very much.
Thank you, George. Thank you. Very, very interesting oversight. Stay. There is maybe a few more minutes for questions. Maybe one quick from my side. You mentioned this human touch, which everybody is mentioning, but then you said the solution for that is AI, which is a system. So it seems like a contradiction, at least for me. How do you see it?
I see, as I said before, that AI is augmenting people. So from repetitive tasks, people can do something more interesting, and let AI do the repetitive tasks and the automation. Also, we should start by thinking AI first in banking. And this would help us improve a lot. There were some MIT papers that show that people that did a task alone, they scored, for example, 10%. And people along with AI, 80%. So you see, there is a huge augmentation. It's not it's a huge advantage that we have AI and Gen AI nowadays.
Makes sense. Any questions from the audience? Yes, please.
Thank you for your presentation. I'm Triton Amini. I have a question. I mean, in your presentation, one of the points that was stressed is that the global number of the population in the world is expecting to increase, and that automatically can create new opportunities. But I'm wondering, how can we be resilient in case when for example, World Bank in the region and the country where I come, due to immigrations issues, is expecting to reduce and shrink the population, etc. Business opportunities are going to decrease. So how is this controversially theories can be adaptive to the bank business? Thank you.
So if I get this right, you see that with immigration, the population rises?
No, decreasing. For example, World Bank is predicting, for example, I came from North Macedonia, and according to those stats, World Bank is expecting to decrease the population nearly for 750 small population in my country. So how can bank, according to all these technologies, all these systems, all these tools, progressively find new opportunities?
Okay, so
thank you.
This is a very challenging question, but I'll try to answer that. A bank is always here to help, and by helping and investing on companies and financial inclusion, they can give more opportunities to the people that stay inside the country and help them grow. We as Eurobank, for example, we help people we give incentives to people to have another child, so population increases. And also we help small businesses with loans. We have very good programs. So I think this is the way. The banks need to be present to what is happening inside the country and try to be not just a watcher, but to help them grow. That's my point.
It's very challenging.
I know.
Generally, it's very challenging.
I know.
Thank you very much for your program. Thank you. Thank you, Georgi.
Okay.
It was excellent overview. So we are continuing our program. Ljubomir Tankishev from EvoTrust, our sponsor. He's a business development director, and he will be talking to us about identity assurance methods showdown. So, Ljubomir, stage is yours. Thank you.
Should I click something or? Great. Good morning, everyone. It's a pleasure and honor for me to be here at the World Banking Forum in Athens, sharing the stage with such great industry experts. It's still early. Hopefully, already managed to have your first coffee and you enjoy the topic I've chosen today to discuss in a bit more detail, namely the different identity assurance methods for digital onboarding. We're going to compare them, see what are their strengths, weaknesses. We're going to touch upon the upcoming UEDI wallet. We're going to discuss potential common pitfalls, how to avoid them, different practical examples, and we're going to finish with a success story with one of our clients. Without further ado, according to research, we can see that 70% of the customers abandon their digital onboarding if it takes longer than 20 minutes. And also, we see that the abandonment in the digital onboarding across the European retail banks is estimated to range between 67% and 80%. Later on, we're going to see how this data fits in the whole picture and why having a comprehensive end-to-end solution for digital onboarding matters a lot, and how it will actually allow you to manage this data in your favor, in your financial organization. So what are the three onboarding methods known today? We have the identity verification. You'll see it with the abbreviation today, IDV. We have the identity attestation, and we have the upcoming UEDI wallet. Identity verification, we have the ID document and biometric checks. It's very fast, but it's not that secure due to the lower level of assurance. Then we have the identity attestation method, which is provided by certified notified TID schemes, qualified trust service providers, government bodies, where a third party certifies the user's identity and bear the legal risk for it. And the UEDI wallet, which is going to be the EU official method for storing and sharing personal attributes of the citizens. So what are the three broad classifications for the onboarding methods? We have the traditional, where the journeys start and finish in an offline channel, a branch or office of the bank. We have the digitalized or semi-digital, where the foundation is still based on the traditional method, but there is one or two more digital interventions. For example, the customer can be identified remotely via web or mobile channel, but he will come to the office or branch of the bank to sign the contract agreement or the relevant documents for the opening a new account or debit or credit card. That's why we call it semi-digital. And we have a fully digital experience where the whole customer journey starts and finishes in an online channel. It's fully remote and it's end-to-end. We see a shift towards the digitalized and digital approach based on the customer demand, and we're going to explore in a bit more detail how this happens in practice actually. So how these methods compare to the wallet? we're going to see three columns here: identity verification, identity station, the UDI wallet. And what you will see as a result of the identity verification comparing to the ID and the wallet is you have a one-off KYC password fail report, pretty much a certain percentage, which compares the scanned document and the biometrics of the ID selfie of the person. Whereas with the identity attestation, you have the reusable digital identity attestation due to the qualified certificate being issued. It's reusable because the duration of the certificate is based on a certain duration, and you can interact with the user multiple times across the duration of the certificate. With the UDI wallet, you have the citizen-held verifiable credentials, which can be requested upon the different use case in need. When we talk about level of assurance, it's both high for the identity attestation UDI wallet, while it's lower, it's substantial for the identity verification. If you'd like to use qualified electronic signature that's natively built both in the UDI wallet and the identity attestation due to the qualified certificate issued upon successful verification of the user and the native QES keys with the UDI wallet, while that usually will require extra vendor implementation of the IDV. When we talk about compliance, both the identity attestation solution providers and the UDI wallet are compliant with the eIDAS 2.0 regulation, while that's not the case for the identity verification. When we take into account the white label integrations, that can be easily achieved with the first two solutions, while with the UDI wallet, that will require the end user to leave the environment, complete the onboarding in an external application, which will certainly increase some friction and drop-off rates. When we talk about acceptance, out of these three solutions, the only solution which will have to be mandatorily accepted by the banks is the upcoming UDI wallet. Well, that's not valid for the first two. However, what is compliant with the regulation, the eIDAS 2.0 regulation today, what is available is only the identity attestation solution provider. Going further, having reviewed the different methods, it's important to take into account certain factors. The core factors which I have selected today are risk, user experience, and compliance. And certainly partnering with the qualified identity attestation solution provider will allow you to mitigate and manage the risk due to the strong encryption and robust authentication, which will allow you to have a much better user experience due to the seamless onboarding done with just a few clicks via the different flexible white label integration. It will also allow you to achieve out-of-the-box compliance with eIDAS 2.0 and the relevant AML and KYC regulation. Just if I'm missing something, it's very important. What are the top challenges reported by both on the left side you'll see the businesses and on the right side by end users? If we start with the businesses, if the process is considered as too slow and burdensome and potential missing information or incorrect collected information, that will certainly be accepted as a challenge for the businesses. Also, insufficient security or potential communication issues, last but not least, potential technical errors. And if we pay attention to the reasons, abundant reasons reported by the user, certainly we have started a few slides ago with the process. If it takes too long, that's considered as a challenge for the users. The process somehow may be considered as too intrusive or invasive due to too much personal information being collected or not user-friendly enough, which also, last but not least, security and privacy reasons, certainly a concern for the end users when they're going through the onboarding method. And going further, here I have illustrated the three methods and their relevance. On the top, you can see the wallets. They have a starting point, which currently in 2025, we are in the development phase. We have the compliance and technology in place. In 2026, we expect in the beginning the early pilots, and by the end of the year, we expect all of the EU member states to have their wallets available for their respective citizens. At the bottom, we see the identification solution providers which are fading out due to the lower level of assurance being not legally binding and AML proof. And in the middle, the focus on the IDA, the identification solution providers, which are relevant, and I believe they will continue to be relevant due to the higher level of assurance, strong security and compliance out of the box being achieved with the meeting with the relevant regulations, and also, last but not least, the great customer experience they're giving to respective end users. Going further, just a very short roadmap of the wallet. As we have said, in 2025, all the EU member states are focusing on the development of the wallet. We have the technology and compliance frameworks in place. In the beginning of the 2026, next year, we expect the first early pilots. And by the end, by December 2027, we see that all of the 27 EU member states must ensure the EUD wallet is available to their citizens. In 2027, we expect the scale and reuse phase. We expect a wider adoption across the banks and the financial institutions. And the financial institutions must accept the wallet for strong customer authentication and KYC. Going further, we're going to touch upon the idea behind the wallet, the use cases, and the implementation. The idea is first and foremost to focus on digital interactions. The wallet should be able to facilitate digital interaction across the EU member states. It should lower the reliance on third-party private companies for storage the personal data of the EU citizens. And last but not least, the higher security and transparency across the member states. The use cases, that's just few potential use cases which expect to be used, but government institutions, banks, insurance companies, telcos, education, as long as there is a need for the citizens to provide a certain attributes or their status, age, nationality, it can be extracted and shown to the relevant institution for the different use case in place. The implementation, what is important is that, we have said earlier before, by the end of the next year, we expect the wallet must be fully functional and available to the entire EU. So, just quickly touching upon the few reasons, key reasons why identity assurance is relevant in 2025. When we start with the fraud, with the technological advancements in the AI world we're currently living in, we need to be able to block account takeovers with synthetic identities. We need to stay ahead of the regulation and meet the relevant requirements of them, build customer trust. Having a comprehensive and secure process for digital onboarding will help you achieve this. And last but not least, there is a push for efficiency. Will help you reduce manual checks and lower write-offs. So this is very important. What are the key principles for efficient digital onboarding? If we start with process optimization, the process should be seamless, should be quick. It should ideally under 10 minutes. It should be very intuitive with clear steps. It should be uninterrupted for the end user with seamless transition from web to mobile environment to complete both the identification and the signing part. There should be a leverage, an end-to-end solution, and the end user should be complete the onboarding journey just in a single session. We shouldn't compromise security. There should be a multi-layered security approach for robust customer protection. So, what are the metrics that really matter? I have selected 3 key ones, being conversion, fraud, and cost. We started the presentation with some metrics and research regarding the different abandonment rates across the European retail banks. Why this is important? Because if we have a smooth onboarding customer journey, that will help certainly reduce these abandonment rates. It will help you reduce the drop-off rates, and will actually help you not only increase the customer lifetime value, but drive revenue for your organization. Also, fraud. We need to be able to stop the bad actors at the front door. We see that even a 1% fraud rate can translate into hidden costs. So we need to have a secure and robust encryption methods in our digital onboarding. Going further, we need to touch upon the common pitfalls and how we are actually able to tackle and overcome them. If the banks are over-focusing on compliance, potentially that will lead to leave the user experience on the site. There should be a balance between security, compliance, and user experience. Siloed approach, embedding identity attestation solution provider will allow you to digitalize more than one use case. Digital identity is not limited only to digital onboarding. Having the right solution in place will help you take into account the different qualified services in the portfolio and digitalize much more customer-facing process in your organization. If we have a passive approach for change, certainly we'll keep you behind the competition. And we also need to invest in standards and partnerships to unify the trust across the borders. With 5 of our key clients, we have managed to achieve some great results, which we call return on digitalization. On the left side, we have the improved customer attraction, experience, and loyalty. And on the right side, you see the increase in the customer lifetime value. Just some quick percentages. We've managed to reduce the onboarding time by 10x, 95% automation of onboarding and first service management, 15x lower customer service costs, and 90% reduction in fraud loss. This has been all achieved by building a smooth journey which allows end-to-end digitalization of the process without having the user to leave the environment, be able to be fully in your flow, in your control of the journey. So some impressive percentage here. This has been achieved by UniCredit, one of our core clients, across a 5-year period. This has been done, and they have actually started with just a single process, signing contracts for small consumer loans for pre-approved clients, to today digitalizing 90% of their mortgage loan process and 95% of the SME loans being signed fully remotely. We see the amazing growth throughout the 5-year period. Also, we see the year-over-year growth in the demand for digital service. We see around 80% year-over-year growth from 2022 to the last 2-3 years. This has been the demand in the digital services. We have the e-signature in place. We have the remote electronic identification services, the authentication, and we are happy that we've been partnering with this financial organization in a great way, managing to achieve such great results across the last few years. And what we do is helping these organizations to digitalize their process, both internally and externally with their partners and end users. We have digitalized more than 35 customer-facing processes with our clients. So I'm very happy to share these metrics with you. And I'll be happy to discuss how you're doing your digital onboarding with your organizations, and potentially if we can partnership or help you. So I'm open to any questions if you might have.
Thank you. Any questions from the audience? Maybe one quick from my side. As out of curiosity, I was trying to open account in different those digital banks, and what I noticed in your slide, when you were mentioning there is on one side this scanning of the documents, on the other side the wallets. I didn't saw yet that anybody is using those wallets. So how far we are from that solution, which seems to be very great, but I don't see them use it.
I believe we're not that far, actually, because I've been speaking with representatives from different member states across the EU, and many of them are in final development phase. So we expect, as I said, the early pilots in the beginning, actually in Q1 next year. Of course, that will vary on a case-by-case basis across the different states, but at least internally in our organization, we expect to have the pilots in the first half of next year. That may vary, but it's more interesting how this will impact the financial sector in general, and how the wallets will be accepted by not only the banks, but the different institutions, pension funds, and the whole organization, the whole financial sector as a whole.
Yeah, and I guess in countries like, for example, I live in Vienna, there is about 20% of population there which are not Austrian citizens, which means they would also have wallets from different countries. So this cross-country trust will also be important, I guess.
Yes.
Good. Any questions still from the audience before we move to the panel? No? Okay. Thank you very much.
Thank you.
Good. We are then, we are moving to our panel discussion before the coffee break. Topic will be Banking 2030, predicting the next wave of disruption and opportunity. So today in the morning we already spoke about some regulations, about innovations, about the digital identity. Let's see what is there. Panelists are Catalina from Raiffeisen Bank International. Then we have Sarah from Julius Baer. You have to jump in as we speak. Yeah, and we have Ishtiaq Ahmed from HSBC. And I will bother you as the moderator this time only, and in the other panels I won't. So, and one thing which we will test this time a little bit, we spoke already about AI and how great it is. So, okay, I will come closer to you guys. We will ask, of course, our panelists some questions. We will get some good opinions, but just for fun, I guess, we will also ask the same questions to the AI. So let's see. I mean, maybe AI has some better ideas and maybe not. But AI comes at the end. Good. Let's start. And by the way, if the audience has some questions, please raise your hand. We will come to you. So let's start. What, if anything, will fundamentally reshape the banking in the next decade? How do you see it? What do you see as the trends beyond what we have already discussed so far? Please.
We take the order of the seat. So first of all, good morning, and very happy to be here. Just quickly to say about myself, I'm currently working in risk management. I worked before in corporate banking, so I will try to bring from that perspective. I think, of course, the banking will still have the core. We will still have to offer loans and take deposits and support clients. But I think what is fundamentally changing already is the technology and the fact that we would be able to employ it and to have it as a part of the team. These AI agents, I think one of the good opportunity will be for us, and the change that might be part of how we work and who we have into our, let's say, capabilities, which obviously then also drives the same, let's say, understanding that it will be part of the team of our competitors, and there are many more different type of competitors coming in, facilitated by the technology. And this technology will be also part of the team of our clients, and we have to then understand this is going to be a more balanced upgrade game plan for all of us to deal with what technology brings into play. For sure, for banks, I think in a more mundane and down-to-earth approach, it will be a lot of changes in the regulations. We already heard earlier from the Deputy Governor part of it. This will for sure change the model and the way we do banking in the next 10 years, for sure.
Okay, so technology and regulations are kind of summary. Sarah.
Hi, everybody. Good morning. I would say, George actually touched on a lot of the topics earlier in his presentation. And I think what we're seeing is this emergence of kind of the Revoluts of the world, where they're very creative about the services they offer outside of banking as well. So, for example, they saw, up front early on, that a lot of people were using it for foreign currency, right? When they traveled, they wanted a Revolut account because there were no fees. Well, no immediate fees, obvious. So then they went, okay, well, why don't we do SIM cards? Not completely unrelated to banking, but thinking about the related services you want to be able to offer in that digital world. And I think we're going to see more of that. We're also living through the biggest transfer of wealth that's ever happened in history. I work for Julius Baer. It's a pure play private wealth management, right? Biggest transfer. And the next generation is already 60, right? So this is going to be snowballing. And the younger generation, I think to George's point earlier as well, the younger generation, if they're talking to a relationship manager and they say, hey, what would happen if I got this, that, and the other? They want to see it then. They want to see that modeling happen real time on screen. So this drive towards these digitized services, but also being able to cater hyper-personalization, but real-time hyper-personalization so that people can make decisions very quickly, because otherwise they will move off. And I don't think they're going to wait 10 minutes for onboarding. I think they're going to wait 2 seconds for onboarding. So I think this kind of cater for these services while building digital trust, because, my daughter's 19. She doesn't trust anything she sees on the internet, right? That trust has been eroded dramatically through social media. So, catering for the services, making sure we're looking forward, but also thinking outside the box in terms of what else could you actually offer your clients that may not be traditional banking, but provides that total package through.
So going beyond actually banking altogether.
Yeah.
But by the way, when you mentioned, the trust and everything and daughters, I also have a daughter which is 19, and there was some interesting research from your colleagues, actually, from Raiffeisen, when they find out that besides this wish for personalization, the younger generation actually don't like to talk to people. They like to talk to agents, which is kind of strange. Okay, we can debate it from different perspectives, but yeah, good. Michelle.
Morning, everyone. I think because we're talking about 2030, it's important to put it to perspective that we just can't rely on traditional banking models. Banking is fast evolving. I think we are today all glued to AI as a buzzword, but let me just remind, AI has been there for 20 years. AI is not new. What has happened is that our interactions with AI have changed, and GPT models have made it a buzzword. But fundamentally, AI has been there and will continue to be there. It will not challenge the business model, it will evolve the business model. That's how we put it. But because we're talking about the future models, it's important to put it to perspective that traditionally banks have been the custodians of trust and custodians of balance sheet, right? So all the balances sat with the bank, and the only method in which consumers imagined banking was that they had to interact with the bank. In the future model, that relationship is likely to transfer, which is why, to Sarah's point, Revolut is doing what it is doing, because you just can't provide banking services and say that I will hold on to the customers. So you have to provide adjacent services that will complement your core offering. So if, as a bank, I would offer a savings account, a current account, and a payment services, the customers are no longer going to have the stickiness to come to me often, right? There was a time that a customer would, on an average, open a banking app 3 times a day. Today, possibly they do it once, because many of the services are facilitated by complementary service providers. For example, in Europe, particularly, we often use Apple Pay and Google Pay as our first go-to method to interact, right? There was a time our primary method was that we had to take out a bank card or we had to take out cash. But today it has been almost outsourced to somebody that we subconsciously don't even know that it is our bank, right? So that relationship is changing. And I think what is important for banks is to recognize that the model is changing, and therefore, what do you do to have that relationship with the customer? And then I think we can talk about many other emerging technologies that are fundamentally changing the banking model. And what I'll essentially say is that today banks, as I mentioned in my opening remark, that they rely a lot on deposits, but imagine a world where everything is on-chain. So how would that particular business model look like? I think these are some fundamental questions that banks will have to introspect on.
That's very interesting. Maybe let's have the same round with a little bit deeper. All three of you mentioned a bit of this relationship and how this will change and whatsoever. And of course, 30 years ago, 40 years ago almost, when I opened my first account, of course, I went to the first bank, which was across the street, and frankly speaking, I stayed with that bank until now. Although I work for another bank, I moved to another country, I still have that account. So there is some kind of link to it. However, we talk a lot about this customer loyalty and so on, but the fact is, like it happened with the telecoms some years ago, that when you look statistics, people have more than one mobile phone. Now they have more than one account. So are we as customers not loyal if I have 2 banking accounts or 3? Or we simply as banks need to consider or reconsider these customer relationships that they are, or we are one of many banks that will have?
So, I mean, there's this concept now of the first bank. So I think in our industry, it's very well recognized that people will have multiple accounts. What you want to do is be the first bank that somebody goes to so that you're their primary point of contact. And certainly in wealth management, it's very rare for high net worth individuals to just have all their money in one place, right? I mean, they're going to spread it out. That's the way that they do business. I think if you're taking that for a fact and then you're looking at, okay, what makes you the first bank to go to? What makes it sticky, and why do people want to keep coming back to you? That's about the ease of use and services, right? If it's a single click to do something versus having to hold on a line or going through 20 clicks, you're going to go to the single click option. Because you're right, I mean, if I think about it now, you know, Switzerland especially, where I'm based, was a very cash-based society. Even when I moved there 8.5 years ago, people used cash. And there's still quite a lot of cash around. But actually now, the jump to cards are now digital, from watches through to scanning stuff is amazing, right? I mean, my daughter, you know, going back to the children, doesn't even have a card. Doesn't need one, she just uses a phone, right, to pay for everything. So it's a whole new world out there. And you want to be that piece of thing on your phone where you're getting that first. And then I love the idea about the push services. You know, you're traveling, hey, how about this, how about that? So you're really adding value into people's lives.
No, I definitely agree. I think it will be for sure the customers will expect this instant type of banking available in real time. They would for sure expect, and they are already dealing in their reality currently, that compliance should be embedded, so therefore they should not be bothered with all of this information every time. It should be also possible to do it cross-border. But I think the additional element, it will come from the client perspective that they would also like to stay in control of the data and of the sharing that it is then being used, and they want to know not only who is using their data and why, but probably they would also want to understand then if it's a no, for example, why it's a no and what could they change so that they do and achieve a different result. I think from the relationship perspective, and I liked the comment earlier about going back a bit to the past and to the human connection, we have to probably understand that this will be the most important asset that we can bring to the client. And instead of, you know, relationship banking, waiting for the client to come to the branch, we have to switch to proactive help, support, thinking what do you need. We see that next week you have a potential gap of payments. These are the options. What would you like to choose? Can we offer something else? So it will have to be also from our perspective, from the employees in the bank perspective, the understanding that on one hand we have to be careful not to end up talking AI to AI, so that we are becoming all a bit out of touch with the reality of our customers and our own support, but it will move away from products into advisory for complex decisions, for managing escalation issues. This will be the efforts where we have to keep our human interaction and increase the capabilities and quality of that advisory.
I'll possibly attempt to give a very contrasting view. 30 years ago, banking was relationship-based, right? My parents opened a bank account because they knew somebody who worked at a bank. They had a personal relationship with that individual. And when you go to a branch, you got like a personal touch. Whether the person was qualified or not is secondary, right? You just knew the person, so you opened a bank account with them. Fast forward like 2020, let's say, that particular model has been completely replaced by the model of digitization, where everything today is done by what customers expect as ease, speed, certainty, and security, because everything is digital, right? So the relationship model has been lost. Having said that, there is still an element of relationship where possibly Sarah works, which is wealth management, where because big decisions or life-changing decisions are made, people still want a human to come and advise because they have that element of trust. So you no longer want to, or customers still hesitate in making those big decisions without an element of human touch. So that is still there. For how long that will be there, we don't know, because when we speak to wealth customers today or private banking customers, they look at advice from AI models before they speak to the advisor, right? So a client coming to me 10 years ago versus a client coming today, they are much informed, well aware of the industry, the insights, what is right, what is not right. So there's a counter argument from a client to say, this is what I know, now tell me what you know in addition to what I know, right? So there's a change in that particular model. But more importantly, why I said that I'll give you a contrasting view is we'll have to imagine banking. I keep going back to this thing that future forward, it is not just about personalization. You gave the example of telecom. Telecom became so easy today because you can change your mobile service provider seamlessly because the mobile number itself is not changing because there is portability of the number, right? Why do people don't change banks? People don't change banks because it is difficult to move all their services from an existing provider to a new provider. But imagine that tomorrow the regulator says that you have to do banking portability, that a customer can move a bank account from, let's say, an HSBC to a Eurobank without having to change their account number and without having to change the services, and everything can seamlessly switch by a click of a button. You would see customers changing at the flick, right? So account switching is possibly the biggest barrier that customers have today. 20 years ago, if you would have asked me, there was an element of trust and a brand recognition and a recall and an emotional value and a connect. Today, it's about convenience and ease.
But if I could just add a little onto that, right? Because what's interesting was I think it was Starling Bank was at the World Banking Forum 2 years ago. And they had seen, because they're very much reactive to customer feedback, it's how they built their brand. And initially, they were fully digital, right? So all the support and everything else was done digitally. And the piece of feedback they constantly got was, no, when we have a problem, we want to talk to a human. So they actually do human first for the call center for support. And I was talking to a reinsurance company recently, and they've done the same thing. As soon as you call them up, because these are life-changing events, right? Your house is burned down, somebody's died. Right, so as soon as you call that number, you get to a person. Yeah. So they're doing digitized product offerings, human, for the empathy and the support when there's an issue. And I thought that was an interesting dynamic that they've observed, because that was the biggest feedback they had from clients.
I agree, Sarah, but I think we have also got to see how generationally the behavior and the experience is evolving, right?
Yeah.
In our generation, possibly, we still see the need for a human, but as you said, your 19 years old child or daughter, I mean, I have a sister who's 21 years old, and she doesn't like speaking to people. She would rather do chat.
The generation.
Yeah, because she's very comfortable doing chat rather than picking up a phone and talking to somebody, because she feels that it's easy and it cuts through rubbish, as she says it. So it's a generational thing. For all you know, the alpha generation may not even want to go and interact with the banker. The alpha generation would possibly rely everything on bots. Because behaviorally, we are now psyched in a certain pattern. And I think as bankers, we got to understand the psyche of the generation to be able to understand what they need from us.
Actually, when it comes to this desire to talk to a bot or the chat and whatsoever, I had the chat with my daughter and few friends of her. I was just curious, to understand. I mean, you guys are talking to each other, I mean, to a person whatsoever, but, what is the reason when it comes to talking to a bank, whatever? And in between the lines, the answer was, well, if I'm talking to a person in a bank, I don't know that person, and, telling that person whom I don't know something which might be personal, I don't like that, right? But, you know, talking to a bot, I mean, who cares? I mean, you know, I can tell them whatever, you know, this is something, which means that they actually have quite a lot of trust into technology because, I mean, I will be talking about that a little bit later, but, you know, behind the technology, there are still some people, right?
But maybe to add a bit to the challenge and also leverage a bit our own, again, family focus groups, because it seems that we all have teenagers at home. What I noticed is that it's not only that they want to talk to technology. I think I'm not that 100% sure that's true. What I think is true is that they rely a lot on the endorsement of the people that they follow or they believe that they trust in the public arena. And I think that brings the other challenge in the future that we have to understand. It goes beyond the banking and what you regulate the ethics of the employees and even the third-party supplier that have to adhere to the same rules. It will be, I think, an effort also, apart from the education that we have to make sure it's helping people to discern, but also the ethical codes of people who then endorse and kind of support and send people to different services. That has to be also, in a way, guided in such manner that, of course, remains available the full freedom of speech, but also the responsibility which comes with the advisory.
That's such a great point, because right now, if you're a relationship manager or an advisor, you have to get certification, you have to go through training, you have to go through annual certification. If you're a social influencer, you don't have to do any of that. So if you could just advise on products without knowing anything about them whatsoever.
But not for long. Actually, a few days ago, I read an article that in China, they have introduced now some laws that actually, as the influencer, you have to prove that you have knowledge
That's
about
very
the
cool.
topic.
Yeah.
And actually, they require them to show the university diploma. So if they are, you know, influencing about health,
Yeah.
well, you are not allowed to be influencer about health in China anymore since a few days ago.
State control.
Unless you have, I mean, we can debate state control, but I do believe it.
I think that's a good thing, no?
Actually. It's
I
not
can't
that
see it
bad.
happening in the US.
Let's see. But on the other hand, as you mentioned, that customers are coming, you know, and first checking the AI and then coming to the advisor. You know, maybe we should in the future invite some medical doctors because they already had that problem. People are Googling, you know, their problems and then coming to them and say, okay, I need these pills. You know. Okay, but we are now talking about the customer expectations. So let's move a little bit towards how these expectations, how are they evolving and how are they going to shape actually our offerings in the bank? So how the banks are going to react on that? And do we want to follow those trends or maybe rather stick to what banks are for?
Well, I mean, I can say from certainly the kind of Swiss side of banking, and I've worked for a number of international firms there, but we're not tech leaders, we're at the best fast followers, right? Usually not even fast followers. So because of the risk landscape, we have to be very cautious and very careful. But I think broadly speaking, there is an absolute realization that we have to stop dragging legacy behind us, and we've got to get more componentized, more agile in our architecture, so that we can lift and shift and move faster when new things come up. It's hard for older institutions because they have a ton of legacy. And that all has to get broken up and reworked to be able to move in the digital age. And that's not easy.
I mean, for me, I think for any institution, for them to future-proof themselves, they've got to take some steps now. I think the challenge for many of the organizations today is how do you balance revenue and growth alongside cost, right? Because we all talk about modern technology, we talk about emerging technology, but when you speak to the CFO or when you speak to the chief operating officer, the first challenge that they would throw at you is reduce cost, right? So many of you sitting in this room and many interactions that we do with the industry folks, I know that there is a technology that could help me, but I know I am constrained by the element of cost control, right? So how do you strike a balance? The only way I see that you can strike a balance is there is leadership endorsement and an acknowledgement that we are going to invest on a parallel bank, right, for a lack of a better word, which means that your legacy infrastructure can continue the way it is. You need to build something ground up. because many banks know that their existing infrastructure is not fit for purpose. What they are doing is they are just taking it along with it to the last end when they know that everything is going to be dead is when they are going to switch. They know that the road is going to end, but they are constrained by the environment in which they are operating. Now, what's interesting is that until about 2 years ago, we would have thought that conventional banking will possibly evolve and digitization is the future. API services or microservices is what we are all kind of graduating to. But now there's a new dimension that has come in. We are now talking an economy where we are talking everything on chain, right? So the reality is that now do I just modernize my legacy infrastructure to become a microservices kind of a service provider? Or do I embrace this new parallel that is coming through, which is everything is on chain? Or do I need to build an interoperable ecosystem where I can continue with my conventional ecosystem and embrace what is going to be on chain? Right, and I think that's the biggest challenge that banks are going to do, because something that most banks now recognize is the revenue margins are going to just reduce over time, because there are so many intermediaries that are coming in that your margins are going to be cut day on day, day on day, day on day, and customers want everything cheaper and cheaper, right? So that's the dichotomy we are in.
For free.
No, definitely. We cannot assume that we close our eyes, and everything will disappear and we will stay all the same. That's for sure. We have to open the eyes, look up, and then adapt to the situation, and also embed in our services what others can do. But maybe another point, what we can try to leverage is what we are doing already very well, and it seems boring and maybe too expensive for the newcomers and the new, very agile type of players, which is basically the regulated part, because that could be also in the future the token of trust that as you are a bank maybe embedding and also connecting in the ecosystem, maybe that ecosystem can build on the backbone of the banking, let's say, partner, and for that we have to make sure we do it well, and that we reduce our failures, but also improve our capabilities to handle them. And probably we'll also have to manage and improve the way we handle risk, and also do risk as a service for the other players, because that's a part also that requires maybe specific type of knowledge, expertise, and instruments that could be then easier for other players to outsource rather than to build themselves into the ecosystem, since they are so much more, let's say, good at and faster at onboarding and acquiring clients. Then maybe some of these management of the downfall can be then partnered with the banking environment, so that we can leverage what we have, not only completely throw it away and do exactly as a neobank would do now.
Before we continue, any questions or comments from the audience? I mean, as mentioned, you are free to jump in, test our knowledge, or whatever. Good. Think about that. Let's move on with our question. So, sorry, you mentioned this revolutes of this world. I mean, I never heard for that term, but actually it does make some sense. I mean, okay, let's not make the commercial for the bank, which is not here. But one thing which they did, which I do believe it's, among the other things, quite important, they introduced actually kind of international competition, let's call it this way. So you are not anymore obliged or focused to open the account in the country where you are, with some banks working cross-border. You are able now to open the account in another country, and actually this account should be kind of valid for any purposes in your own country. So in some countries, for example, in Croatia, where I was living, there was for some time law that you have to have your salary account in Croatian bank, but not anymore, right? So beyond these trends, so what other geopolitical and economic trends pose the risks and opportunities now for banks, besides China and, influence?
Yeah, the East versus the West versus Europe, right? I think what is very interesting to me is we're starting to see companies be quite innovative in how to provide services to previously untapped populations. So sub-Saharan Africa, for example, we hear the global north versus the global south when it comes to the digital divide. But for example, in South Africa, there is a company that's, startup company, decided to start delivering stuff to the townships where nobody wanted to go deliver anything. And they're now gathering all data around the people they're delivering to, their patterns, their habits, their shopping. Now, we go back to risk in terms of, do people understand what they're giving up in terms of their data? But we may start getting data and insights into populations that we have not had any information on before. So it's been very difficult to design products to be able to cater. I mean, there's microfinance that's been inroads made there, but there's a whole ton, massive amount of the rules population where we haven't been able to cater these nuanced products for those populations. So I think that could be a big opportunity, but also a risk because it could be abused as well as used. So being able to get that balance and make sure, because a lot of these countries won't have regulation in place as well. So to make sure that you're protecting the people and doing the right thing for the people, but then dynamically you could have amazing products that you could create in a new world. So that's what I would say.
Okay.
I mean, definitely with what we discussed, the technology is going to be the biggest disruptor for sure. The cybersecurity and everything associated will be, in a way, that the most important risk. I think going a bit away from that, it will be still an uneven development and with the efficiency also slower growth. But more importantly, I think that one of the risks can be a more fragmented type of rules, and therefore you have to think in corridors and pools of actions rather than global regions where you can act in a unified way. And I think the third element, I would still believe it and hope it will stay relevant, but I think we will be forced to keep it relevant, would be the climate factor. The climate cost will be more visible and embedded, and it will affect both the margins and the access to finance, I think.
Well, given that we're talking about geopolitical risk, I think there are lots of things that financial institutions need to keep an eye on. Outside of what we know as US-China trade war, I think there are lots of moving parts that we need to keep a tab on. Of course, technologies is the core element that is going to influence the future of banking, but I think the movement of or the trade that happens in the world is going to significantly influence how banking from a commercial side is going to challenge. Simply because now banks are having to plan not just on one scenario, but on multiple scenarios at one point. So your scenario planning is no longer just for one scenario. Your scenario planning is 2 or 3 scenarios combined together and then doing the forecasting to see how, as an institution, we would respond. How would we respond to, a trade kind of a policy change that, United States can do overnight, that every bank will possibly wake up and realize that, we need to have a scenario model that can respond to that particular change. But geopolitically as well, I think we all talk about the war. I mean, with all respect, yes, there is an element of war that is happening around the world. There are tensions at borders, but then cybersecurity is possibly the biggest challenge that we are going to face as a community, as financial services. Cyber war is today possibly the most underrated, but it is the most threatening tool that is available in the world today. If banks cannot plan on cyber, I think they are going to be on the losing side. And I think that is the biggest risk that today nations have and regulators have, possibly from a risk point of view, that there needs to be a lot of emphasis on controls. Yes, we all get fascinated by technology, experience, etc., but there has to be an engine room which needs to have full control on cyber.
Makes sense. Still questions from the audience? Challenges also, yeah. Good. Let's maybe still stay on that question and twist it actually 2 times around. You mentioned the cybersecurity, which I would agree with the fact that, the major problem is we are, as banks, becoming more and more dependent on the technology. With the advancement of technologies, we are actually outsourcing quite a lot, cloud, right? And on the other hand, this means that we are opening up our vulnerabilities to anybody to jump in. I mean, previously, if your computers were in your basement, it was quite easy to protect them. But now they are not in your hands anymore, right? So we have regulations like DORA, which are actually turning banks into police officers, in my opinion, to actually take care about IT. Is this really the right way to go? I'm just thinking openly as we speak. You know, resilience of bank is depending on the technology, but this doesn't mean that a cloud provider shouldn't care at all, right? So how much this responsibility should shift maybe towards technology providers?
Well, I think it's a tricky question, right? I mean, today it's not about, I mean, you said two very important things. One is the world today has moved to a stage where a lot of technology is outsourced to service providers, and banks own very, very little in terms of IP, right? That said, I'll just draw parallels with the geopolitical tensions, and I think there's a wave of nationalism that is happening across the world. That is significant, right? Because when nationalism wave comes through, this is not just politically, but in terms of intentions and emotion that people have as human beings, that we live and we associate with the country. There are lots of factors that influence, right? We talk about immigration, we talk about refugee statuses that is being observed because of war situation. Now, what nationalism does is it associates you with a particular type of product and a particular service, and then policymakers are then compelled to take decisions which they are not very comfortable with. For example, there is advisory. I hope that I'm not saying anything incorrect, but US doesn't want any more jobs to go to developing countries, including the likes of India, where a lot of outsourcing is done today. If that was to stop and jobs were to stay back in the United States, which is what President Trump wants, then there are lots of implications, not just from an experience point of view, but from a cost point of view. Then how do you balance that? There is a wave of nationalism that we are seeing in Europe. How does that influence outsourcing? How does that influence contract outsourcing? I'm not talking about outsourcing of just work. This is about contract outsourcing. So the modus operandi that many organizations have, and for I think almost 2 decades now, we all thought about outsourcing and globalization, as the word suggested, we are now seeing an anti-pattern. We are now seeing a world where deglobalization is happening. So if deglobalization is the new reality for at least, let's say, the next 5 to 10 years, until something, a major world event happens, then how will financial institutions respond? I think those are some of the big challenges that the boards are having to kind of navigate today.
Yeah, I think from the technology perspective, the dependency on the big five, for example, I mean, we've had to rethink our whole approach to third-party risk management because we can't just rely on the old questionnaire we had. Now we have to uplift all the questionnaires to understand what the underlying components are that they are dependent on. I mean, we saw this with CrowdStrike, right? Some hidden widget in a box that you don't even know is being used by everybody, and then it goes out, and all of a sudden the whole planet starts freaking out. So I think there's definitely a risk in terms of what are the cloud providers using, what are the big third parties using, with the lock into the top 5, does that even make sense? And understanding from a component perspective, or where the liability is around those components, who's going to hold the ball at the end of it? If something goes wrong, who's holding the ball? Because a regulator needs an accountable party, and either they're going to pick on you as a consumer, or they're going to pick on the provider. But I think we're starting to see a bit more happen in regulation towards the provider side, especially in the AI space now, where they're trying to look at, okay, you're accountable. If you're a provider of AI or general purpose AI, then you have these liabilities and accountabilities. Still doesn't help us with what components they're using that they're dependent on that could cause a systematic outage, right?
I mean, just to add, I think this is a problem in the West. Asia has already kind of graduated to a level where they don't look at multiple providers. They look at providers in country, right? For example, China has a very clear policy in terms of who, when, where, and what. So unlike the challenge that we have in the West, although we consider China to be a closed market, but I think they've already taken steps. India as a country, which is massive, they have a very strict policy on data and cyber. Anything on data needs to be on soil. I think it's West possibly which has been liberal in terms of globalization. Now the question here, as you said, has changed, which we now need to have a rethink in our strategy in terms of how do we relook at a world when deglobalization is happening, because our reliance has changed now.
Now I have to change slightly my head to back to the chairman. We are running out of time, so maybe quick answer from your side, and then we have to check our AI, Christina. Yeah.
No, I don't have much to add. I think definitely the third-party reliability will be very important, but I think the other part will be eligibility, and we have to all train ourselves to think, what if we can't use anymore these providers that we trust and they are reliable, but maybe they are not eligible because of, I don't know, sanctions or different other geopolitical shifts, and that's a bit more complicated than to try to do the ones that we do normally test and that they work well and that we have control that they deliver what they need to.
Okay, so I hope you enjoyed the discussion. Let's see what AI thinks about what we said and how aligned we are. Well, let's stand up and let's do it.
Let's do this.
Thank you very much.
Interesting. Thank you.
Thank you. Moment of truth. IEC's evolving customer expectation driving personalized, real-time and embedded banking experiences where services adapt proactively to individual needs and lifestyles.
AIC's evolving customer expectations driving personalized, real-time, and embedded banking experiences where services adapt proactively to individual needs and lifestyles.
Shall I read the rest, or AI
No,
will do them all?
it's an AI, so it's
Based on that trend, in 10 years we can expect banking to become invisible, fully personalized, and autonomous. Essentially, banking will fade from view but become smarter, faster, and more aligned with daily life.
I believed it was listening to us a little bit. Partial. Okay, AI perspective.
From an AI perspective, banks should prepare by building adaptive, learning organizations with flexible governance, scenario planning, and a culture of experimentation. Resilience comes from empowered teams, rapid decision loops, and systems designed to adapt, rather than trying to predict the next crisis.
It was definitely listening. Good. Thank you very much. It was very interesting and engaging discussion. And I think we all deserve a coffee break called networking pause. Please come back at 10:40, back to the room. If you haven't changed your clocks so far, which I didn't, for example, it's now 10:20. So. Good. Welcome back. And those who are coming, hopefully will join soon. Okay, good. We have now the panel discussion. Another one about how telco data strengthens trust in the global banking. We just touched that topic a little bit on the previous panel before the coffee break, but let's now go into more details. So our panelists are Pavel Kowalski from mBank. We have Peter Arbiter, Aduna, and Andrzej Oczowski from Deutsche Telekom, and David Arman from Vantage. The panel moderator is? Peter. Okay, it's not written, so that's why I'm asking. Good. So, gentlemen, stage is yours. Please entertain us.
Yeah, absolutely. And we have a slight change in the process, so I will get started with a brief impulse keynote, and then I will ask my channel partners and partners in crime to get on stage. So we need the presentation, and after the break, I need some interaction with you folks here in the room. So here we are. So my name is Peter Arbiter. I'm the Chief Commercial Officer of a company called Aduna. You have not heard about that company before, I'd guess, but I will talk about this one in a few minutes. So here's the interaction. Who has ever heard about something like Gaza, G-A-S-A? Does it ring a bell? Yeah, not really. So, okay, that'll be a tough one now. If we start already on the first line and you get challenged, that'll be tough now with all the other numbers, but I'll give you some help. So, GASA is the Global Anti-Scam Alliance. And they just recently presented a study. They interviewed 46,000 people in the US. And out of these 46,000 people, they wanted to better understand how scamming has evolved over the past years and time. And these are the numbers. I'll walk you through. 377 scamming attempts per adult in the USA per year. 377. Now we have less days in a year. That translates into more than one scamming attempt per day per adult in the US. So if you look at the success rate from the fraudster's perspective, it's 22%. So now if you multiply these numbers, that means that more than 60 million Americans got, unfortunately, hit with a successful fraudster experience in the last 12 months. Now, again, a success, how does that translate into, in that scenario, what was the loss of these individuals per person? It was $1,068. And now you can do the math again. That means it's 65 billion in fraud just from scamming in the US in the last 12 months. And this is tremendous. Now, unfortunately, and we talked about that AI is there for 20 years. Yes, one could argue. But on the other side, you could also argue probably not in everyone's hand. And that's exactly causing the problem. In the past, from a banking perspective, you try to protect the account from any kind of account takeover. So that was, from a cybercrime perspective, what you were focused on. And representing the telco industry, looking at the banking industry, you did that quite well. Unfortunately, these fraudsters also moved ahead because they no longer just intend to hack that account or to take it over. No, that got probably too complicated. No, they're going to take over the account owner, the individual. And now we are in that scamming fraud, where people get called. We see that grandchild trick erasing. People get called. We see a typical calling pattern that after 15 or 20 minutes, an abnormal transaction is happening while someone is on the phone. And with that, we are really entering the next level. Unfortunately, AI supported, and unfortunately, through AI, really massively scaling. I mean, everyone was laughing at these emails we received years ago, where there were so many spelling mistakes and grammar mistakes, and everyone obviously saw that scam email. This, unfortunately, is gone. You hardly, and you can't recognize that you are not talking to a robot. You believe it's one of the people you know who's calling you. And that, unfortunately, is also the basis of AI in the wrong hands. So that means, in that scenario, so it's not an bank account takeover. It's not a hacked account. Someone is doing a bank account transfer legally, unfortunately, to the wrong bank account. Now, what's the telco industry doing here on stage? Now, we in the past and in many countries still are part of your processes, especially if we look at OTP, one-time passwords, SMS, one-time passwords. This is still a big business for the telco industry, and we see a lot of countries where SMS, one-time passwords are still used. I mean, let's face it, and I yesterday had the pleasure to talk to the Greece operators here in a workshop, and I also told them the same story. This SMS business will be gone, and if you're still lucky in your country that you still have banks who use SMS OTPs, this will be gone. Definitely will be gone because it's unsecure, and from a user perspective, it's just inconvenient. But the bigger problem is that it really became unsecure. Now, from a telco perspective, this is old technology. SMS are around for decades, and that business, especially since it's also not really pleasant for the consumer to get a code, which you then type in again or copy and paste in again. There are new technologies around, and this is why we are here. And this is why we are actually sponsoring this event as a gold sponsor, because there are quite a lot of new APIs around which make your lives easier. So you folks in the banks, your life is getting easier if you want to fight fraud, because the telco industry as the next level on top of SMSs has introduced APIs. Now one would say, if you're in that business, oh, I've heard this before. Number verification is an API. Actually, it got defined in 2015, so that's not latest news, honestly. But that was the starting point. And since 2 years, under a new initiative, a new set of APIs, and more relevant, more standardized APIs are around and got developed. And in that prime example here, we also look at an API which is called Scam Signal. It's actually already running in the UK, quite successful. And Scam Signal does exactly that, what I've mentioned before. It checks whether if someone does an abnormal bank transaction, whether that person is in parallel in a phone call, which runs since 15 minutes. And there's a pattern where if this is an abnormal transaction, the likelihood in the fraud case that this person is in a call which lasts for 15 minutes is quite high. After introducing this one in the UK, this fraud went down by 40%. Now, such an API call is not expensive, a few cents. So that's technology, and I talked about new APIs, a set of new APIs. These are two examples. There is actually a whole set of new APIs arising and currently introduced in the market. Now, talking about Aduna. As said, you've never heard of us, absolutely right, but you have heard of our investors. So we just recently got found as a joint venture, more or less of the telco industry. And if you look at these logos, what is interesting to observe, there are not that many occasions where the three American players, AT&T, Verizon, T-Mobile, as well as the two Indian players, Jio and Bharti, are doing something together. So you'll see 12 logos of companies who invested into Aduna or who founded Aduna. They've chosen a technology partner, which is Ericsson. Ericsson holds 50%, the 12 telcos hold the other 50%, and that joint venture went live end of July this year. Now it's not limited to these 12 telcos. So Aduna's charter is to expose APIs in a significant easier way than in the past. That's news. Significant easier, so that all of you no longer have to deal with the complexity of the telco industry. Now, these 12 invested telcos are just the starting position. So Aduna's mission is to more or less cover the entire telco industry. And we will have the most relevant 25 countries covered by the end of 2026, next year. So by the end of next year, Aduna will provide the industry and the ecosystem with APIs, which are especially interesting for the banking sector. We have seen two examples. There will be 10 APIs available by the end of this year. So it's a significantly larger set of possibilities. Now, how does that now work? And with that, I'll get started now to introduce my panelists, but let's first look at how this comes together. So we need the telcos and their capabilities, and in our panel, we will have Deutsche Telekom representing the telco industry as one of many carriers. Then Aduna, as already just outlined, a newly found joint venture, which consolidates and aggregates these APIs so that it's northbound for a company called Vonage, who is specialized in providing solutions out of these individual APIs. An API is just an interface. And from a banking perspective, that's probably not something you really want to work with, because you need to get really deeper into technologies. So this is why we have companies like Vonage who are then wrapping this one in solutions. And then we have with mBank a customer talking about that experience. And with that, I'd like to welcome on stage Andrei Ochoki, the head of identity management at Deutsche Telekom. He's also the chair of the Europe GSMA European, identity group? Yes. Then David Darman, the vice president international sales, API from Vonage. And then we have Pavel Kowalski, the product owner for digital channels. So, Pavel, we are missing you. All right. And feel free to also ask questions. We will reserve some time. If you don't have questions, I just continue to ask questions here. So it's up to you whether you want us to go after the script or whether you challenge us with some new things. Let's get started with my first question to Pavel. So the world is changing. We've heard that this morning. We also talked about this one now from an anti-fraud perspective, but not just looking at anti-fraud. So what are the most pressing challenges you face on your way to deliver digital services?
Okay, so first of all, we have to understand the customer perspective. We also have to understand the fraudster perspective. To create a process, we have only the mobile phone, because everything now goes into the mobile. So we started to think how to combine those all features together, how to make this smooth process, how to create it with the security by design and privacy by default, just to have this unique unique opportunity to make this seamless experience for the customer. So now we see that we as a bank can do a lot of things, but we have to find new solutions just to give the customer, let's say, bigger part of security by default, and the security should be somewhere in the background, because we do not want our customer to make a lot of actions just to feel unsecured, yeah, because we are trying to face them somehow.
Thanks a lot. So starting from the customer perspective, moving now to the other end of that value chain, Andre, from the Deutsche Telekom perspective. Now, how has the digitization of banking impacted network security demands and service expectations?
Oh, it's impacting a lot, and not only digitalization as such, but also other megatrends which we discussed this morning. So from our Deutsche Telekom perspective, we obviously see an increasing demand for encrypted secure connectivity services. So connectivity is a basic of all we do with digitalization. On top of that, of course, we heavily invest into the capacities, into the clouds and data centers. You might heard maybe recently our billion investments into the factories for the AI. So brand new data center just to cope with the future capacity needs which AI will require. But also what is our bread and butter, we do provide solutions for our customers which enable them to communicate through different channels, so omni-channel communication with their end consumer. And last but not least, of course, the topic of today, which is related to real-time fraud detection and fraud preventions.
All right. Back to the customer and the bank, and let's better understand who is now who in that entire ecosystem. So how critical is authentication reliability? I mean, we talked about SMS, number verification is one example. Now for your digital banking services, and what are the limitations? So why is SMS fading out or will be faded out?
The most critical problem right now is like SMS copying machines, like remote desktops or other kind of applications that are trying to get those OTPs in real time to the fraudsters. So our customers can feel insecure because we are not protecting them out of the application. Yeah, we have our mobile applications like banking applications, but we do not see a lot of things on the device and on the, let's say, traffic. Messaging traffic, SMS traffic, and so on. And the same thing goes with calls, yeah, because we have also the call verification, which are also with the OTPs, but they can be forwarded. And we as a bank do not see this. So the only one who see this is the telecom.
All right. Andre, and we'll get Damon in a minute engaged, but Andre, now, the current trends around phasing out the SMSs in banking, and especially in Europe, and we also outside Europe have seen first countries who came up with regulations so that no longer SMS tons are allowed. So what are you observing here in that phasing out process?
So when we look at the figures, the total volumes of SMSs, both one-time password but also application to person, we see those volumes stable despite all of the discussions we have about phasing out SMS being unsecure. Many of our customers, banking customers, are relying on SMS one-time password, although we know that the use of SMS technology in the secure customer authentication, which you guys have to provide to be compliant with respective regulation, will change. From what we see is that the usage of the secure customer authentication will need to be adapted, and therefore we as telcos, we came up with the solutions like number verification, which is based on a possession factor. And when we talk about the possession factor, it is something what we all have in our packets, is subscriber identity module. You know it under the abbreviation SIM card. So we have it in our pockets, and this is a possession factor which is used by us, by telecommunication companies in authenticating the customers to our telecommunication networks. And now our idea is, because of the problems you are facing as a banks with scam, to bring this technology to you, to enable you to use the ubiquitous possession factor in your strong customer authentication.
David, let's talk about these network APIs and what they are, how they work, how they help detecting fraud, how they help authenticate. Just give us some examples, and also let's talk about the customer benefit. I mean, most obviously, if we can fight fraud, there is one, but there are more examples.
Yeah, sure. Thank you. Thank you, Peter, and good morning, everyone. Kalimera, so happy to be here. I would like first to start with, of course, it's obvious for everyone here, but when we talk about fraud in that particular area, so there are two kinds of fraud that we see. So one is the fraud that relate to identity takeover, identity theft, and that impacts like the end customer and the reputation of the bank. And the second category of fraud is 100% like relate 100% to the bank backend services, and I'm referring here to toll fraud or AIT kind of attack, like artificially inflated traffic, and that impact, like of course, spend and efficiency of the onboarding process. So maybe we'll talk about the second case later. So for now, we'll focus on the number one, so authentication of users and threat around the user, and how do we solve these challenges with the network APIs in a much better way than what was done so far. When we talk to our banking customers, they tell us that within the past few years, so OTP, one-time password, using SMS was solving 99%, right, of the fraud problems and was very reliable, right? But as a matter of fact, and Peter talked about that, when you look at the increase of social engineering, right? When you look at the sophistication of attacks like man-in-the-middle attack, one of the famous like digital bank like that was last year in the UK, one of their customers got the OTP stolen, and because of that, a lot of money from the account was moved to the hacker account, right? So this is the kind of attacks that SMS can unfortunately not prevent, right? And when you look at the need today, so customers need to have as much as possible like seamless, frictionless experience. And everyone, of course, is looking for top-notch security and want to trust, of course, the bank and make sure that sensitive data is not accessible, right, to hackers or any like party with bad intentions. Network APIs rely on secure and real-time verified data that comes from the operators. They use like technologies today that enable banks, enterprises to, if we talk about number verification, silently authenticate users in real time. So there is no password to enter, there is no interaction, so it's completely transparent and does not like enable any man-in-the-middle attack, or there is no OTP that can be communicated to any third party. But it also enables, like if we look at other APIs that are available today, like SIM swap, for example, to do some advanced KYC check. So when we authenticate a user, we make sure that that's Peter a byter, that's Peter using his phone, his phone number, his SIM that is authenticated, so we're sure that no one is faking Peter's identity, right? And then he can start accessing to the data. Now, so when it comes to the benefits for the customers, so as we've said, so one is frictionless. And we all, like in situations where we are mobile with the phones and trying to install an application, and then we're waiting for the OTP, it's really not convenient, and then it's sometimes a mail, sometimes WhatsApp, sometimes SMS, it's not convenient. And two, so we want to trust, of course, the bank. I mean, I'm a user of a bank, right? And I want to trust my bank. So the more robust is the security process that authenticates me, the more, of course, the trust will be bigger, right, in the bank. And point number three, we want that security to be proactive. So it's good it's a good point, of course, and it's a mandatory condition that we get securely authenticated, and there's no way that the account can be taken over. But I want to make sure also that the bank is applying some proactive measures. So I'm protected against scam or any like potential threat that will not come during the authentication stage. And to share some metrics here, back to your last question, Peter. So we have a lot of banks today in fintech using our technologies, and we'll talk about that later. But I can share some metrics. Then one of our customers, like it's a public reference share, so it's a French fintech company. The name is Lydia. They were using SMS for OTP and facing a lot of fraud, mostly due to social engineering and scam. They migrated to silent authentication, so number verification, and the metrics are like, I mean, super straightforward, like here. So in terms of improvement on speed, so the authentication accelerated big time, so it's 50% faster than with SMS. 2, so they're getting like higher conversion rates. So the conversion rate like increased from 82% to from 84% to 92%. So it's 8% more, right? And that translated directly into 26% more in terms of sign up. So then you get a positive impact and a ROI, right? That you can of course share with the CFO of the company. And 3, so they eliminated 100% of all the threats and fraud that were coming from social engineering and scam. So that's a reality, and those are customers who went live with the network APIs.
Thanks a lot. Very impressive. Back to the bank, Pavel. I mean, when we got to know each other and talked about number verification and the APIs, and again, it's just one out of many, I directly jumped on the anti-fraud scenarios, and you brought me back in actually saying, hey, this is just a smaller part of our transactions, luckily. But network APIs do a lot of good things also for all of the other transactions. So let's talk about that.
Yes, it's not only about digital security, because everyone are trying to think that, hey, let's move on with the digital security, but what about the customer? He doesn't want to know about the security because he wants to trust his bank as much as possible, and he wants to feel secure there. So we are thinking about how make all of those processes, like different processes, to be analyzed in a step-by-step mode, to see where there is a potentially fraud possibility, to overcome it before it happened, before it happens. So we see that there are a lot of things which you haven't mentioned, because you are talking only about the number verification now and the scam signal. But we are talking about many other processes that we have in the bank, like personal data change. You are changing the address because you are moving on to a different house. So we can use geolocalization. When you are, let's say, changing the number of your phone, you still are the possession of the SIM card. You have it. So why do we have to, let's say, call you on that number? Why do we have to send you some kind of SMSs? We are sure that this is really you because you give us this data. So we are thinking about how to improve not only the security, but also the user experience with all of those, let's say, APIs. And you were talking also about the scam signal, because currently there's a lot of social engineering problems, because the bad guys are calling and trying to tell you that, Harry, this is the bank calling you. My name is Pavel, I'm from the bank. So you have to verify yourself. I will send you the SMS data. This is not the SMS from the bank. Anyone can send an SMS to you. So the person is trying to understand how the bank process works, but he hasn't. He doesn't have to. We have to make it somehow very secure in a manner that the customer will not feel it. Because when there is a bad guy, we will know this as a bank. When there is a good guy, okay, we will let you do the job.
Now, Pavel is using many more processes, or has many more processes where he's now integrating telecom data to telecom. So what kind of network APIs are you exposing?
So as of today, we expose our network APIs on both sides of the Atlantic. So both as T-Mobile USA and here in Europe, we have very similar set based on the global standard Camara, which Peter described in his introduction, but of course adopted to the regional legal and regulatory frameworks. Talking about Europe, about what we offer here, as of today, we have very nice solutions which could reduce the fraud which you guys are facing. So the number verification is one of them. It's a successor of the SMS O2P from our perspective, and also future-proof in terms of future requirements for the strong customer authentication, and also, last but not least, for the upcoming European digital wallet, where we as a telco industry are collaborating with the European Commission and governments to bring those network APIs like number verification into the wallets itself. Then very simple ones like SIM swap, so a signal where we inform a bank based on your request whether there was a recent change of a SIM card which we see on our data records, and this might be a good defense against social engineering, which is happening. Last but not least, a know your customer match, where usually challenger banks are using it for a kind of a pre-identification of the customer, where we check the customer identity on the records we have. But there is much more, which is either available right now in Germany, coming very soon to other European markets like Greece. Here we want to be technically ready by end of this year, so starting January 1st, Greek banks, we are encouraging you to start testing those APIs here locally in Greece with our partners together. The new categories of the APIs which I'm referring to are related to the location, and location is quite important. Signal, it might be either simple information whether customer is in roaming or in home network, or maybe even thanks to the capabilities we have in the 5G networks, really up to the very precise level of few centimeters. Imagine about ATM machine in the shopping mall, so we will be able to give you information about the floor even. And last but not least, because today we were talking very much in our panel about the fraud prevention API, but just to give you a bit outlook what is coming in 2026, which is fitting very much what you were referring about the megatrends this morning. So network APIs related to the service quality differentiation, which we do believe it might be also a new thing for you for provide new future experiences in the banking. Last but not least, some of you are involved in crypto, so there is also a Camara blockchain API, which is already standardized, and we plan to introduce it as well.
All right, so we have Pavel on the banking side who wants to use all of these information in the processes. We have Deutsche Telekom with their entire footprint, Cosmote here, T-Mobile, yes. There's something missing in between, because if you just have these APIs, and that was easy in former times when it was just SMS, because SMS is fairly well known to everyone. We are now talking up to 60 new APIs, which are currently defined under this Camara project. Not everything is available right now, but it's significantly more than one SMS. So how does now the capability which sits in one network or in a few networks of Deutsche Telekom come to one edge? I'll add before I hand it over to you, to the banks, that Eduna's purpose is now to talk to the Cosmotes here in Greece, to the Vodafones here in Greece, to the Novas here in Greece, as well as the operators in other countries, because it makes no sense if only Deutsche Telekom has these APIs. It has to be the full country which is covered. So this is Eduna's role. So we ensure that these capabilities Andre was talking about will also exist in the other networks. But then we just have the capability. How do we now get to the banks and to the solution?
Yeah, very good question, Peter. Thank you. Can you hear me well?
Yes.
Yeah. So as Peter and Andre said, so when you have like a full set of APIs, that's great because they address like pain points and they provide solutions to real like problems or challenges that you want to address. But then comes the time to integrate these APIs. And when I look at our banking customers today, they are all global banks. So they operate in global markets across the globe for most of them, right? And when they integrate like APIs, they want to make sure that they will integrate these APIs like once. So they won't have to replicate in any region for each of the vertical they're targeting, that integration. So bottom line, they're looking for a unified solution that it's at scale and will enable them to go to market like rapidly with limited efforts in terms of integration. So that's what we provide with solutions like Verify, for example. So Verify is a multi-factor authentication solution that includes the silent oath number verification that we get through Aduna, from the Dutch Telecom and the other CSPs of the world, but not only. Like with Verify, you have also like failover solution, for example, like if in a country there is no silent oath available, you can use RCS or WhatsApp or SMS or voice or whatever for authenticate. We also provide within the Verify solution so velocity rules that are infused by AI. So that way we provide some advice in order to choose like the best authentication channel in the country, depending of the conversion rate that we see, but also make sure that we prevent like user like centric attacks. Last but not least, so with a solution like Verify, so we provide an economic model that enables you to be in a position where you can demonstrate an ROI. Why? Because we charge only on successful transactions. And two, so because as I was sharing the example of Lydia, so you will enjoy like significant improvement on the conversion rate, right? So fraud elimination, in most of the cases, so we try to bring it back to zero, but let's say fraud mitigation or elimination. And two, so higher conversion rates. That's one solution then. We have other solutions like Identity Insight, for example. Because again, authenticate securely user is good, but not good enough, right? You want to make sure that this user is really the person that is claiming or she's claiming she is, right? So run again this old KYC check. Make sure that the SIM was not a swap, right? So those are all the checks that you want to run. And again, these APIs rely on verified operator data that we trust and that enable us, again, when we deploy these solutions with you, to give you the possibility to integrate once the Verify, for example, API into your workflow, your application, and then roll it out across the cloud.
Thanks a lot. And I think with that, we'll hand it over to see whether we have one or two questions. Fast ones. Over there on the left.
Hi, good morning. Thank you for the very fruitful discussion with slides. Do you have any insight on what is happening on the other side of the world on the same topic?
Which side of which world?
I'm wondering, because you're obviously on the topic, all the whole process flow of this service. What is happening on the other side of the world, meaning how do in China or in Japan treat the same problem?
Yeah. So China is well advanced with the network APIs. So they are leading the pack. We have, through Bridge Alliance, access to the Chinese carriers. We have directly connected the Japanese. So they also got started and got engaged. With the exception of Rakuten, where we haven't started yet. The other three are members, and KDDI is even invested into Aduna. And on the other side of the world, we will launch actually tomorrow AT&T. And AT&T, for those of you who had a business in the US, was always the problem child, so to say, because they were quite reluctant to provide access to their network. So they will launch end of this week, and with that, we're going to go live with them, with Verizon and T-Mobile US by January.
Thank you. Very nice discussion, by the way. Thank you.
So I'm not sure I quite understood everything, not being a telco expert, but it sounds to me like each individual provider, like AT&T, Deutsche Telekom, create their own APIs, which you then wrap up in a package for consumers, right? So are you following a standard protocol in design? And why can't there just be one API that you guys use that will verify across all these different mobile networks because it adheres to standards? That's one. And then the other is, how easy is it to clone an eSIM? Because if we're going to put all this onus on the SIM and the eSIMs, right, how easy is that then to clone and really breach the security in a big way?
Yeah. I leave the second one for you, Andre. The first one, these standards are called CAMARA standards. So this is the new thing. We were talking about that. CAMARA is an open source alliance where 400 companies joined forces. Not only the telco industry, also many of the software providers, so the entire ecosystem. And since 3 years, they defined these standards. And this is why this version is the same one than with Vodafone, is the same one with Telefonica, and by us, then aggregating them as Aduna, you get one API. And why do we need so many of us here? Because unfortunately, just in Europe, you have 73 mobile operators, thanks to regulation, so 73 times an API. That's too complex for anyone to work with. And there are more companies around than Vonage. And the telco industry has realized that they will not participate in their journey any longer if they don't simplify the access to their networks. But there is not that one and only telco provider. This role is now taken over by Aduna. So Aduna is the one in the middle, making your lives easier. And then with partners like Vonage, we create full solutions. So if you do not want to do the programming, take one of the solutions they are providing. eSIM cloning.
eSIM cloning. So the SIM many different form factors which have evolved over the decades is a very, very broad aspect. So we as telecom operators obviously use the SIM card, subscriber identity module, as a base, as a trust anchor into all what we provide, controlling the access to the services, allowing the right people to use to consume our network and our capabilities. And over the decades, along with the standardization, so starting with the 2G, then through 3G, 4G, 5G, now we are working together on 6G initiatives, 6G, sixth generation of networks. We of course evolved the SIM card technology itself with the cryptographic, with all the technology advances which are needed in order to keep it up to the highest limit, which is guarantee for us to stay as trusted partner for our customers, both consumers and B2B customers.
Thank you. So kind of the crypto level security.
There are many technologies behind the small plastic which we have in our smartphones, or the software pieces in it with secure elements and stuff around it, and of course connected with the network intelligence working together. And one of the proof points is that we managed to also convince the European Commission and the member states to consider the SIM card, the subscriber identity module, with its uniqueness and great capabilities as a possession factor to be part of the upcoming European Digital ID wallet.
One last statement for all those who do banking business in the US. We're going to do a summit with AT&T, T-Mobile, US Verizon in January in Dallas. If you are interested in, send me an email. Thanks a lot.
Thank you. Thank you.
So, we are continuing with the program. Now I need to again switch heads and move from the chairman role back Okay, turning on. Actually, one of the first things I learned in Polytechnical school when I started as a student, a professor told us, you know, the electrical instruments work much better when they are switched on. So I haven't learned that lesson, obviously, yet. Anyway, cloud providers are huge, right? So that's the major difference in comparison to your data center. How huge? Roughly, average cloud data center is about 50 times bigger than average data center of a bank. How much is 50 times? So if your data center is this big, cloud is that big, right? And now, this is the first thing which usually is then being discussed. And you know, when we talk about cloud, we talk about investment, right? And we talk about investment, you know, the first person to be in the room is CFO. What CFO wants to hear? How will this impact my cost-income ratio, right? So this is one of the most important things. And of course, here we talk about the cost. And if you talk about the cost, of course, the next thing which you will hear from provider is, you know, our cost will be cheaper, right? Because we are big, we are more utilized, we can utilize our costs better, and of course, we can provide better service for you than you can, cost-wise, in a small data center, or smaller than us, which is partially true. First question is, yes, they can definitely run it more efficient, but the question is, will they share those benefits with you, or they will take it as their margin? All right? And let's see what they'll do. So let's take one very simple example. I guess most of you have iPhone, right? Right? At some point of time, whatever great iPhone you have, I guess you had this kind of message like, you know, your storage is full, but no worries, you know, there is cloud. You can get it for how much? Something like less than euro a month, 50 gigabytes. Like, you know, what is euro a month? It's not even a coffee. Like, it's a nice, you know, thing to think about. You can get, and if it's not enough, you can, you know, take another one, which is 3 euros a month, so it's a kind of 200 gigabytes, and you can get 2 terabytes for 10 euros a month, right? Doesn't sound like a lot of money, very, you know, and very convenient, by the way. Problem is, convenience never comes with a discount. Convenience comes with a actually premium. And let's see how this works. So, for this example, let's take comparison one small external data carrier of 2 terabytes. Costs you on Amazon something like 80 to 100 euros, right? It's not that convenient, but it's cheap also. But 100 euros paying at once is definitely bigger than 1 euro a month, right? Even after a year. So let's take the example. Let's say that you take this 50 gigabytes, no, 50 gigabytes for €1. And then you realize after 6 months, well, you need a little bit more, so you pay 3 for 200, and after 2 years, something like you take this 2 terabytes, which means at some point of time, you will come to comparable data usage as with, as if you bought the external hard drive, right? How does it look from the cost perspective, right? You will start with rather cheap, right? But look, it's a monthly cost versus the fixed cost, right? And then it piles up. And now the question is cloud cheaper or not? Where obviously at the beginning is, right? And as you consume more, well, it costs more, and at some point of time, it will cost you more than if you have it on your own. Of course, it's more convenient, but the problem is at the time when it becomes more expensive, you will already have a lot of data there. And then moving it someplace else is also going to be a little bit of a problem, right? So looking like that, problem is you can actually utilize this cost efficiency of the cloud, but you have to take care of if you are really comparing apples to apples and pies to pies, right? Because the complexity is here quite a huge. Problem is, I gave you the example with one device, your phone, which has, one memory need, one CPU and whatsoever. But you're running banks. It's running hundreds of services. This service needs extra space, the service needs extra computing power, and on cloud, all this is very conveniently dynamically added, right? But the problem is, when you pile all that up, I would question whether the costs will really be as cloud providers are providing. Another problem is here. One of the things which is highlighted as the benefit of the cloud is that, in a bank, you don't always utilize, and you cannot simply utilize all your computing power which you have in your data centers. Why? Well, there are times in a day when some services are not that much used, right? And there are times of the day or night when you are doing batch processing whatsoever, and then it explodes. Of course, if you have everything on-prem, you need to buy your hardware and everything to actually cover the peaks, right? Otherwise, everything crashes. But if you cover the peaks, this means that most of the time it lies unutilized, right? And this is exactly what cloud providers are kind of highlighting as a benefit. They say, look, you can easily buy a computing power just for this peak. And they are right. They are not lying to you. But the problem is, to make it very convenient for your, agile tribe teams and everything, you should allow them to make these purchases when they need them. And you should trust them that they will use it only when they need them. But you should also trust them that they tick it off when they don't need them. And this is where the problems usually come, because of the convenience of the use and everything, and because of the fact that not many development teams are used to actually be kind of rational with their orders. Many times it happens, they will order something, they will order extra space or whatsoever, but they will never switch it off when they don't use it, which means your costs will pile up tremendously, and it will be very, very difficult to cover those costs altogether, because, again, the only way to control it is to somehow, again, centralize and have some checkpoints and whatsoever, with which you are actually killing all the agility which we are getting. So you're back to base one. Again, it's not impossible. I'm just trying to give you the taste of what might happen. The other problem, which we mentioned actually today, was around security, right? Security is supposed to not to be the problem in cloud, because, these are top companies, they have, good experts and so on. And that's fine. Problem is, who is providing majority of cloud services in Europe? Big five, right? Amazon, US company. Microsoft, US company. Oracle, US company. IBM, US company. Google, US company. More than 90%. Whenever you go, you will most probably take one of those. And they are in evaluation and so on. So technically speaking, they are great. No question about it. But here is now the trick. US company is under US legislation, right? Yes, you might consider some contracts with them when they will be also regulated by EU and whatsoever and so on. All nice. But let me remind you, Ukraine also had a contract with Russia and US. And guess what happened, right? Contract like they will protect them and they will take care that nothing happens. I'm not saying in the banking world this will not happen, but, well, there is a possibility. If FBI or somebody says, okay, I want you, Google, to disclose the data about the European clients. Yes, they also have the contract under EU, but I'm not sure that, when they will be in between two fires, between, their own government and EU, which one they will hear. And then the question you have to ask yourself is, okay, how much do I really want to expose myself? Because again, you are gaining quite a lot of technological benefits by moving certain services to the cloud. No doubt about it. Whether they will be cheaper or not, I'm not sure, but with proper management, you can manage that. But when it comes to security of your data, as a technical person, I will tell you, think twice and, get proper people in this discussion. It's not that simple, not that easy, and no contract in some cases will help you. Clear. Let's move on. Another problem which we have now with the mainframe topics and everything, I need to hurry up, is I grew up actually in the time, my father was even the software developer. Oh, I'm sorry, Evo Trust. It's okay. It's Evo Trust and it will be okay. When, the mainframe computers, from engineering perspective, I'm usually saying, these are the last pieces of software which were made by real engineers, right? These guys are, Jesus, this was, something can happen, right? No, it's okay, it's okay. It's just fitting well to
We have it on video, Davor.
That's good. I didn't run out under the desk, so that's important. Anyway, let's move. The topic is the following. Those mainframe systems, which are slow, which are kind of, mediocre whatsoever, there was some kind of thought, engineering back then built into it. And yes, there is a reason why changing something on that is kind of difficult. But now we are coming to the time when you have, those millennials who are running around, they are, cool people. We are, trying to, adapt to their needs and whatsoever. Problem is, these millennials, when they start to develop, they work from home, they are kind of cool and whatsoever, but, do you really want to have your core systems managed by, I don't want to say, those guys that they are bad, but I'm not sure that their level of professionalism, running some systems on the data center remotely would match what we had when it comes to security. For sure, they will be able to create a great, new, nice systems, user-friendly whatsoever. But when it comes to resilience, when it comes to stability, when it comes to everything, I'm already now in my organization seeing a lot of discussion between those developers, how much testing is really needed, can't we test in production and things like that, right? It's an open discussion about things we shouldn't discuss in the first place, which honestly makes me worry, right? And then coming further, security, not only from the development perspective, there will be quite a lot of discussion already on the panel and later about the security, but one thing which we also, I would say, constantly forgetting with this overall, making banking human and everything open and whatsoever is that we are pretty much opening and giving customers who are not necessarily educated properly access to their data and through the systems which they also probably not care enough, right? So new generations treasure this usability, easiness of use, but easiness of use means you can make a transaction without entering the PIN or something like that. Usability and security are not always hand in hand. And then the question is, when things go wrong, and they will come to you. So how much of these technological advancements you really want to build into your systems? And now moving back to the first question, how much should you move to the cloud, in which way and whatsoever? So let me try to conclude with the following. Cloud from technological and also I would say commercial perspective is a big step forward, no question about it. You as a bank and the bankers should consider this very seriously because it gives you a lot of flexibility when developing applications. But don't forget, bread and butter of banks is not development. Bread and butter of banks is operations. You earn most of your money with stable operations. If some app doesn't have the latest features, yeah, maybe you will lose one millennial client or whatsoever. But if your payment system doesn't operate for an hour, you are in the evening news, right? And that's a serious problem. So consider in which areas do you really want to have this dynamics, flexibility and everything, obviously in some development. But when it comes to operations itself, Somebody mentioned in India they already have this act that data should stay on soil, and I do believe this makes sense, especially when it thinks about moving to the cloud. Moving to the cloud in terms of computing power and whatsoever, probably very good idea. Moving your data to the cloud, I will think about it. And with that, I will close my time. I said, I'm running out of time, I already am. But if there is maybe one question I can answer, other than that, I will not take the time from the next speaker and the panel. Other than that, yes, please.
Just a comment.
Okay. Yes.
Very nice presentation. OpenAI, I think they opened their data to Financial Times over a US support because the Financial Times wanted to prove whether they're training their model over Financial Times data. So I want to say that once you have uploaded something onto the cloud, it's never yours.
That's the point.
Very good point.
That's exactly the point. I mean, the moment it's there, even if you have a contract, even if everything is kind of safe and secure, trust me, from technical perspective, you don't have your hands on that anymore. You simply don't. There is no control. And don't trust that contract will save you. Sorry to say, but stay safe.
How can we encourage about,
What do you mean, encourage?
to share this?
Look, this is. Yes and no, but consider the following. There is on the cloud, you have computers and you have storage, right? And what I'm trying to tell you, using it for computing, probably fine. Using it for storage, be careful what you are putting there. That's the big difference, okay? Okay, let's go.
Just the last comment.
Okay.
I think that you could add in the flow of the presentation, which are very nice basic points, is that you run on different type of risks as an organization as well. Yesterday at noon, on the Greek time, we had a major cloud infrastructure failure.
Which can happen, yeah.
So you might be affected by something happening overseas, which has
That's the
nothing
thing.
to do with your business or your domestic environment. So you run different type of risks. So why this system is not up and running? Because something might have happened at the undersea cable somewhere. I don't know.
It can happen.
In another place.
It can happen.
So it's different type of risk assessment.
Correctly. I mean, DORA is supposed to handle it, kind of. But I believe, okay, we don't have any more representatives of national banks, but I do believe from, again, engineering perspective, those acts like DORA are mostly like washing hands, right? So regulator says, okay, there is a regulation, you banks adhere to it, you banks say, okay, I have checked, the question marks, but what is the question mark when you sign the contract and somebody breaks the contract? And your data is with the company who break the contract and it's overseas. What can you do then? You're done, right? That's the point. Good. My time is out. Thank you very much. And switching heads. Thank you. Thank you. Cheers. Thank you very much. Before the lunch, this is always difficult to find slots. We have a panel discussion. Topic is rip and replace versus are Michal from Bank of
Environmental protection.
Yeah. Even within the Slavic world, we have problems between each other.
True that.
And yeah, I'm the second one, so Johnny, at some point it's fine. Which one do I have? Yes, I'm still having technical issues. Thank you.
This is my favorite panel just before lunch, so let's keep it. It's 2 hours, no?
Sorry?
It's a 2 hours panel, no?
Yeah. 2.5.
2.5. Okay, let's start. Okay. Let's continue the discussion from the previous speaker. We will talk about legacy system and how we can get rid of them. This is an issue for all of us all the last years. All banks have, National Bank of Greece exists since 1841. We are almost 200 years old. And as all the old banks, we had a legacy system. We started very early in the 60s and after. So we had also, as the previous speaker said, a transformation program that we think it's a successful one. And we are about to change procedures, but also the IT. So the discussion is, there is the trend we have, how to change your core system. You have two basic approaches. The first is get rid of all of it and do it from scratch. And the second one is to try to do it in different phases, more in a more adaptive and maybe a more productive way. Let's discuss on this, and I would like to have examples, lessons learned, and things that the audience can follow up with us later. Michal, please tell us.
All right, thank you. I wanted to give the floor to my honorable colleague, being chairman of the conference, but here I'm the first one to go. I will try to connect a couple of dots that already, were here during the conference being mentioned. So one of them is basically the margins getting lower, right? So before you invest, right, because it's kind of an investment decision you need to take, you need to make sure you have enough money, basically, right? So all of those reasons, I don't want to talk about them, too much. We are all aware of it. Why the margins in banking, especially retail banking, are coming down. Regulations, right? Competition, international fintechs, all of those reasons. And take a look that regulations are cutting the margins on the revenue side and the growing costs at the same time, right? So so this is difficult. So you need to answer yourself a question: can you afford it, right? So my answer to the question you raised would be: it depends, right? I have a couple of the famous lawyers' answer: it depends, right? I have a couple of examples in my head, because what I like about this conference is that we are all guys that are doing that business on a daily basis, right? So a practical approach of it. I would give you an example of not necessarily the core system of the bank, right? Because I'm more into payments, right, than the overall, core banking system. But I would say it's a good example because payments are pretty difficult part of the business because of the large scale of the transactions, right? You need to support because of the constant nature of those transactions. So, for example, if you want to do a mortgage, you need to be there for a couple of hours a day, right? But if you want to do, I don't know, card payments or whatever kind of payments, you need to be there 24 hours a day, and it's much more transactions going on, right? So it's usually a difficult transition, difficult shift if you want to change those systems, right? There is a crossroad of different regulations, also international standard of payment schemes, and there are a lot of partners in the ecosystem, right, that you need to compatible with, right? So it's a very difficult thing to change those systems for payments. And I would give you an example of our national champion. We are proud of it in Poland. It's called BLIK. Maybe you've heard of it. It's kind of a a national scheme, alternative scheme for payments. It's growing really, really fast in the last couple of years. Not sure if you are aware of it, but BLIK agreed to sell like 20% stake to MasterCard, right? So, and because of it, one of the things that they got, apart from the money, is that they got access to the technology. So tap to pay, for example, right? So BLIK could offer a better UX experience for the customer being tap to pay, right? And also international exposure, right? So the customer having BLIK on his phone, he can pay also in other countries, right? Because using the MasterCard Railways. So what I'm trying to say here is that, they were building a lot with the banks in Poland, like from the scratch, the systems, but also, they've seen a good synergy to use what was already there as an infrastructure and make it happen again. I think it's a win-win for BLIK and for MasterCard. There are some downsides of it, but that's kind of one of examples. And the other one would be
what's the lesson learned behind this deal, this joint venture?
Well, I think the lesson learned is like we are saying that that even if you build something new, to get the scale, to get profitability, and to get up to speed with customer satisfaction, customer UX, right, or functionalities, you may want to use some things that are already available there and try to find a cooperation, try to find a synergy, right? That's, I think, one of the lessons learned.
Startups are not, fintech startups are not standalone.
In a way, some of them are trying to, and maybe even successful, but most of them are not, right? Even the mentioned Revolut, right, is cooperating with many other.
We had a similar case in Greece with Viva Wallet, which was acquired by JP Morgan.
Right.
For the same reason.
Exactly. I can give you another example, or I can leave it for later.
Of course, yes.
Okay. The second example I wanted to mention is there was a wave of buy now, pay later. I'm not sure if you remember on the market, right? Everyone was talking about buy now, pay later, right? And I used to run a big portfolio of cards in Santander Bank back in Poland, which was the second debit and the third credit card portfolio on the market, right? So, like 5 million cards, 5 million debit cards, 1 million credit cards, more or less, right? So relatively big portfolio. And they were coming to me saying, okay, let's invest that crazy number of millions, to develop our systems, actually with BLIK, to offer a kind of a BNPL solution, right? And I was scratching my head, taking my business experience into account, doing some calculations. I said, guys, you know what? It doesn't make sense for us, okay? Because if I have 1 million customers having my cards already in the wallets, credit cards, right? And they are underwritten by the risk, the credit risk, right? Already. If there is a huge portfolio and there are ready systems, ready processes, everything works fine, I would rather focus on that, and my card system can offer installment loans, as a feature of the card, of a payment, instead of jumping on something completely new, which will not bring me enough new value, but will bring me much more new cost instead, right? So I said that's not a good idea business-wise, even though everyone around is talking about it. One of the reasons was that the guys were saying, okay, you can escape from some regulations, right? Because it's not so much regulated yet. And I said, okay, yet is the clue word here, right? Because the guys who started to do it, a couple of years ago, they benefited from that, Klarna and this kind of things, right? But because of the social problems in the US popping up, especially with the young generation coming out of BNPL, the regulators are, starting to look at this more closely, and it's going to be regulated pretty soon, right?
Sorry to interrupt, but I think we will talk about regulation in the second question.
Fine.
So
I just said there is no premium coming from that, and you need to pay additional costs. It doesn't make sense. You can do it with whatever you have already in your systems, in your customer portfolio, right? So that's another example that you don't have to always jump blindly on something new coming up, right? But you need to always take the business case kind of a calculation.
But if I understand well, you lost a client, a customer there.
No.
No?
No. Well, if I may lose it if I'm not active enough on my portfolio, if I'm not active enough to propose my product, which has the same functionality at the end, to the new customers, I may. But that's not the best way or quickest way or most efficient way to get to the goal.
Thank you.
Just quick reflection on buy now, pay later, and running your business with cards with later payment. You can just relabel it. You can just say, okay, our cards already have pay later.
That's what I said. Yeah.
But back to the original question. The problem I'm seeing, and actually all of you mentioned it, and it was mentioned also in the presentations. We, in one hand, from very good reason, look everything through the investment. Of course, you need to have money. But sometimes I have a feeling we lose the track actually, what are we trying to achieve? And just example to make, in many banks I saw, there is a target, okay, we go cloud, right? But cloud isn't and shouldn't be the target. Cloud is simply one of, for example, technologies which is around there. It is offering certain benefits. It has certain risks and serious risks, which I try to highlight. And you should think, what are you trying to achieve actually? What is the level of or operating model for your bank to be? How can cloud support it, and where it cannot support it, toast it off. Simple as that.
Cloud could be a target for providers eventually.
It could be for providers, but again, a point is, cloud, first of all, shouldn't be a target architecture for everything.
No, it's not cloud, it's AI.
It's AI.
Cloud.
Even that. One of the sales propositions of the top 5 cloud providers is that they have already built in quite a lot of AI capabilities within their systems, which means if you are migrating your core systems and your functions and everything into that, you can kind of natively use it, which is good selling proposition, no question about it. But again, those engines need data, and obviously they need your data, right? So which means when you transfer your systems, core systems data there, those AI systems are going to work even better, but again, on your data. Do you really want that? The question is always, if you are combining lessons learned or data whatsoever from several banks, those AI agents are going to be better because they depend on the quality and quantity of the data. That's simply mathematics behind it. But the question is, again, are you want to be exposed as an organization, or you want to run into the risk where your data is not any more controllable by you?
Okay, let's rephrase to help our audience also to understand. Let's go with go, no go. In which case you have to go from scratch? Do we have any examples to give to?
I think it's just simply comparison of financial calculations, right? Like the business case, right? You need to calculate option 1 and what's your bottom line, in that scenario and the second scenario, right? I need to compare which one is better.
So business planning.
Business planning, definitely. And apart, on the top of that, I would add one more thing. It is much easier to go agile, which means a stepped approach, right? To go step by step. Okay.
We will talk about agile in the...
Okay, because of the board's acceptance.
But we all know that business planning is real for 6 months and then it needs adjustments. So
That's exactly the problem. I mean, if you want to make some transformation, it takes certain time, right? And the problem is that...
how much time does it take?
It depends. I mean, look, there is no magic formula for everything. But when you ask, since you asked when to go to the rebuilding whatsoever, it's always technically easier and cleaner to build something new and migrate to that than adopt. Adopting the existing has some advantages, but up to a certain level. I mean, this is like, I don't know, fine-tuning a car. Yeah, you can paint it, you can remove the rust, you can maybe put nice soundproof or whatsoever, but there are limits you can make with that.
Sure.
At some point of time, you need to buy a new one. So this is the same logic is with technical systems and everything. At some point of time, there is no more adoption. But now, problem is that we are then usually trying to make general solution or general recommendation, do this or do that. And there is no general recommendation, especially in the situations where you have those complex systems evolving over decades, actually being intersected between each other. And unfortunately, from those which I was having a chance to evaluate, they did not follow some basic architectural principles, like decoupling, the processing part from the data and so on. And this is where problems comes. I saw it in my organization when it comes to replacing one system. This is a nightmare actually to find out what this system actually does in addition to what it was supposed to do once it was introduced 15 years ago. And then what to do with this extra functionality and things like that. So problem is we are not very good in banking area with this architectural governance. And once when you mess up that and this happens for a decade or two, God help you actually. I mean, the simpler system would be, build something new and migrate to that rather
But
than...
this is the case with every system. Every system has to evolve and then you will have discontinuities and things like that. I think that's the rule of operation.
Not that much rule. I mean, if you say by rule, this is something what we do, doesn't mean that this is something what we are supposed to do. I mean,
yes, I agree. Let's talk about agile and hybrid transition. Do we have any success stories on that?
I mean, look, around agile, I could speak for a long time, but I'll try to squeeze it out. Everything around what we now call agile is, umbrella term. Let's put it this way very clearly. Agile doesn't exist as a methodology or something. It's an umbrella term for many methodologies which were evolved over some 2 decades, 3 decades of time in software development industry to tackle the problem of managing software delivery. But highlight is software delivery, right? Agile is not built for software operations, not built for banking operations and whatsoever. For some reason, we are trying to squeeze it out into that. But when it comes to, again, upgrading systems and so on, if you are considering building system on your own from the scratch, then some of those methodologies for building might be very useful. Because in that build, you will have to adapt to many different topics and you will not have requirements at the very beginning. If you want to, I don't know, buy from the shelf some system, there is no need for agile development methodology because you're not developing anything. You are taking off the shelf and integrating.
What about the whole COBOL programs we had since the beginning of time? They still exist in some places. So this is an agile process to try to replace them, no?
Look, again, agile is about...
Do you know about COBOL? Who knows COBOL? And the banking? You all know. Yeah, it's a famous, it's a trend. It's still a trend.
My first language which I learned was COBOL.
All of us.
Okay. So if I may add something to that. Okay. So what I meant by agile, I agree with Davor that it's a very wide term, and you can use it in different ways. But I meant specifically the stepped approach, right? So kind of an approach that you start with the smallest step and then you make one at a time, right?
That's great. And step by step, quick results. That's
not even quick results, but results at all, I would say. Okay, results at all. What I mean by that is, if you want to change a system, be it a central banking system or a payment system, right? It's a big thing. It's a big budget. It's very complex. It's gonna take a lot of time. It's gonna take a lot of resources, like people from the bank and so on. So the turnover. The return period is also long, right? And that's why it's going to be difficult. Imagine yourself, right? You being the head of the business, right? Or Davor, me, right? And we have a challenge, right? We think we need to change the system, okay? It needs to be more modernized, better functionalities, whatever, right? And I need to sell it internally in the organization, okay? I need to make it happen. So if I'm be looking for a decision and acceptance of, I don't know, 100 million euros, kind of a budget, it is less likely to happen. That's first. Then 10 million, let's say, in one go. That's first. And the second, if somebody would need to wait, I don't know, 3 years, 4 years, 5 years to see the fruit of it, the result, if you take a look at the average board perspective, right, it's much less than that, right? So they will not be willing to take decision on a bigger budget, on more risk in one go, and a longer period of seeing the result, right? So you rather cut it in smaller pieces, and you give them the chance to swallow it, one by one, right? So that's kind of an approach. I would say it's more practical.
Great. Sure. Do you want to add something?
I just wanted to say, I mean, the stepwise approach is a valid approach. I wouldn't call it necessarily agile. This is just a way to kind of manage the complexity of transformation. However, again, when there is no major development, I would consider different methodologies, simply like that.
Okay, great. So there is no rule. You have to swim.
The rule is it depends. The rule is it depends. But I can give you one rule if you like. I can give you one rule.
Yes, I like
example.
rules. Tell me one.
I feel you like the rules, right? So I'll give you one. If you put on Google the name of the panel, right? Rip and replace. Guess what pops up?
We don't use Google anymore.
Okay,
we use other.
I'm old-fashioned. I've used it a couple of days ago, and what pops up is the law in the U.S. a couple of years ago that was cutting out the Chinese companies like Huawei and ZTE, right, out of the U.S. infrastructure for telecommunications mostly, right? So that was kind of a rip-replace rule they took on, right, because they lost the trust for the providers, right? So what I would, that's one of the examples that you can have a clear rule, okay? We need to rip it down, even though it's going to cost us more, because somehow, we don't have the trust for the provider, let's say, right? In this case, particular case. But basically the whole thing that we discuss here is the same as you and your wife deciding to renovate your bathroom or kitchen, right? It's exactly very much the same,
That's
right?
a very nice and very simple
because
rule.
whatever you do, you need to repeat it in a couple of years again.
We
right?
all understand it.
Yeah.
So, it's kitchen restoration. I don't know. Yeah. Do we have any questions? We have one winner. Yes, we can take your question.
This is
It's as fast as a blink, yes,
yes,
almost.
no. This is used for account-to-account payments, and in Spain they have Bisum. And I know that in the beginning this was created as a rival to the payment schemes like MasterCard, and I see MasterCard made a very clever move and took some stake from Blik.
That's why I said it's a win-win, I think. Yeah.
Okay, and here in Greece we have Iris, for example. And my point is that in Europe we have too many things and we do not aggregate. So also from EPI, European Payment Initiative, which is supported by ECB also, we have Wiro. Okay, so do you see space for all of these account-to-account payments through Europe, or maybe they would be isolated for Poland, Central Europe, because they are in Benelux, for example, Wiro? What do you think the evolution of account-to-account payment will be? A short comment, yes.
All right, thanks for the question.
This could be a regulation also question.
I'm sure it's going to be even. So I'm going to answer carefully. Okay, that's an interesting question. So clarifying, Blik is not only P2P payments, it is, and I've heard recently, a couple of days ago, that half of the volume is already a P2P transaction from based on the phone number, basically, right? From the phone to phone. But it's huge in e-commerce. It's huge in acceptance as well through MasterCard Tap to Pay, right? Acceptance network. So it's not only account to account, but yeah, I mean, I was talking recently, like a week ago, with my colleague from Wiro, the Polish guy. He used to work for Blik, by the way, in expansion, Piotrek Piotrzak, and he was presenting together with Worldline in one of the conferences in Warsaw. You know, the outlook of development of Wiro, and we had a nice discussion about the regulations later on as well. And I think if Europe wants to have an European scheme, and apparently they want to again, right, for different reasons, but it's a long story, they need to try to aggregate. It's not so easy. I'm keeping fingers crossed for Wiro to develop. I think it's a nice, but again, they need to look. They are already aware that they need to look for compromises, okay? Because they know they are not going to be able to put one hard standard to everyone. Rather, integrate the local players this way or another. And secondly, UX-wise, interesting discussion, because they don't want to follow Blik route to get some kind of a dependency from the global schemes, being US schemes, right? Visa, MasterCard. So it's going to be very difficult for them to get into the NFC solution, Tap to Pay solution. So they are more thinking about the QR codes, for example, right? Which are fine for China, but I think the European customers, once you get the better, I'm going to talk about it later on during the presentation, it's hard to go back, right? I mean, once you get more convenient solution being Tap to Pay, you don't want to get back, you know, to QR codes, which are more difficult to use, basically, right? So I can see a challenge there, right? I can see a challenge there.
I would just have philosophical comment. I mean, every transaction is at the end of the day account to account, right? I mean, eventually money has to go from my pocket to, I don't know, merchant pocket and whatsoever. I do believe that we should talk about, and we usually talk about several segments of it. One is how the money is transferred, really, and the last, which you mentioned, is on the point of sale, actually, how you are initiating the transaction, right? And in that sense, probably at least from technical perspective, this interrelation of these several segments, because not everything is in the hands of one provider, right, has to be aligned. Otherwise, it simply doesn't work. Right?
that's why we are in Athens, to have a lot of philosophical discussions. So I think time is running off. So I want one last very brief statement from you.
Why you are looking at me saying brief?
From both of you. So, please, very briefly, in one or two words, tell me what's your rule for legacy systems?
I would say the following: as long as they work, I would not, kill them just because there is something better.
You're a COBOL guy. So.
Not necessarily. I was working as the web developer as well, so I'm old enough to have tried. Quite a lot of different.
Save Willy. Save.
Don't change because everybody does it. Change
Great.
is because it makes sense for you.
Great. Thank you.
My rule would be, as I mentioned, it depends. You need to
depends.
You
Very
need to
clear.
very carefully analyze each case, mostly financially, risk-wise, and in that practical internal game of the company.
So we have the winners are don't change and it depends. Thank you so much.
Thank you.
Thank you very much, Spiros, and dear panelists. It was really interesting.
now the lending session, everything about that one. I honestly have to say that this is probably one of my weak points, even though I'm working as a board member in the bank, then this is the place where I have to catch up the most. So I will ask a lot of questions. But Alex is coming from Mifundo, so Estonian company. We share that one, but he's working under the Estonian flag. I'm working under the Czech flag. Neither of us in the original territory, and he's covering the topic that I have probably already had a chance to hear many times over the last 3-4 years by the founder and then by him as well. So this is one of those things that I would really dig into. So how this kind of like how to use the CCD2 and cross-border credit data for the strategic advantage. So definitely a topic that is worth going heavily into. So Alex.
Thank you, Marcus. So thank you very much, Marcus. I'm very happy to be here and for having me here. So, do you hear me well? Yes. So, let's get started. I'm Alex Bley, head of strategic partnerships, as Marcus' intro. Today I'm gonna speak about two things. The first thing is gonna be a short intro about Mifundo, what we do, who we are, why we do what we do, and then talk to you about the new Consumer Credit Directive that's going to be implemented in 2026, which is going to have a deep impact in many banks and other lenders, non-bank lenders. So to understand what Mifundo does, we have to look first at what's the problem that Mifundo is solving. And the problem that is solving is a highly fragmented landscape in credit data in Europe. And let me start with a very simple question. Why a citizen in the United States can relocate from New York to California and in California have immediate access to financial service, to banks, to credit products? And that's why so? Because that's not because the United States is a single country, but because in the United States they have an integrated credit data system. So unlike in the States, in Europe we don't have that, and that's a huge problem for individuals and for banks. For banks, it's a huge cost of opportunity because most banks are rejecting international customers, people who are arriving there because they don't know them, because they don't trust them, because people have to start from scratch. And for people, it's also a huge problem because when you arrive into a new country, you are buying a property abroad, you need housing, you need car loans, so you need many things. And if you don't have that, that's not financial inclusion. So in Europe, we have a very fragmented credit data landscape. Databases spread in between public central banks, private databases across many countries, no common standards, no common data sharing. So Mifundo is fixing this problem that we have in Europe. That's why we have backup from the European Commission, 10 million in funding last year. How do we do that? So we connect consumers with banks directly, and we make a process that today is very cumbersome, very frustrating for the consumer, very analogic. They have to take the PDF from the bureau of their country, take it, so very cumbersome, into a very instant digital process, instantaneous, and connecting people to the banks directly via Mifundo. So we are aggregating all these data sources into one single API and deliver this to the bank. And in this process, we are adding some value, we are standardizing, we are unifying all these databases to make it very easy for the bank to understand, to interpret. So typical use cases for people, for consumers. So people relocating to a new country, as I said, people who are daily commuting in between two countries. Many places in Europe that's a scenario that's in border areas, and also cross-border property buyers. Typical use case, for instance, in Southern European countries, Northern European people who are buying vacation house, also as investors who are buying houses abroad. So all in all, this is very much in line with the financial inclusion of all these people. So many people think this is a niche market. It's not a niche market. It's a huge market. Actually, we say it's a 45 million people market who are going to be in one of these situations in the coming years. Roughly, that's 10% of the European population. So that's not a niche. That's a massive market. And we validate that with every bank we speak in every country in Europe. And we have spoken virtually to all banks in all countries in Europe. 10 to 15% of credit applicants in every bank, in every country in Europe, are in one of those situations, in one of those use cases I've just spoken. So for the banks, what we do, we deliver a single credit report, very easy to interpret. We harmonize currencies, we translate it, we make it very easy and very convenient for credit analysts to interpret all this data. We also standardize credit scoring because, as you know, we have different systems, A, B, C, different scales, etc. So we make it very easy. And on top of that, we add value, added value from open banking statements. So we fill in the gaps where the bureau does not provide data information. So we have a very comprehensive credit report, whatever the nationality of the credit applicant is. So for banks, all in all, we can summarize in 3 points. Reduce the risk for the bank dramatically. So banks can underwrite foreign customers, international customers, as they would do as local population. So very comfortably, we allow banks to increase lending volumes by 15%, 10 to 15% approx. I would say that with the neobanks that we work, that can raise up to 25, 30% of credit applications. And we make a very cumbersome analogic process that might take days, even weeks, even months, in a few minutes. Again, in line with responsible lending, and that's why we have this European backup. Let me comment very briefly some use cases with banks that we work with. This is a bank from the Northern European country, as you can maybe figure out for the nationalities applying to credit. This could be like a sample, like an average case of people who are applying to credit products. This is mortgages. So bank is dealing with 27% of the credit applications, but Mifundo is taking care of 12.8% of this long tail of a small fraction of nationalities. We cover virtually all of these countries. There may be some that we don't, like Eritrea or Syria, but for all the rest, we do cover them. This is another use case. This is Central European Bank. In this case, it's a buy now, pay later instrument of the bank. So the main goal was here to increase the conversion purchasing rate for the people, for the customers buying in this e-commerce platform. Here, the bank, they have the direct connection with Germany because most of the customers, apart from locals, coming from Germany, but all the rest, 12.1%, is Mifundo who is taking care of. This is another case. These are daily commuters. So a bank wants to explicitly launch products for those people who are working in that country but living in the country aside. So residence is in another place. And this is Southern European countries. So this is a mortgage use case. So this bank is providing mortgages for nationals of their own country who are living abroad, who are living in all these countries. So 9.5% of these nationals of this country, of this bank, they are living in the UK, 4.3% in Germany, and so on. So these are people who are buying a house with a mortgage in that country, but living abroad. So this could be a good sample of where Mifundo can help. Okay, so now let's turn on to the second Consumer Credit Directive that, as I told, is going to be implemented in 2026. And why it matters for banks, not only banks, but other lenders too, as we will comment. And having said that, I'm fully aware that most of your compliance departments in the banks, they have this on their agendas. They are working on this. Probably some of you are working on changing some procedures, some policies internally, and preparing for the implementation. So it's not my intention today to revisit something that you already know, but probably give you a little a different approach in that sense. not looking at it as a compliance, as a tick in the box, a boring compliance stuff to grapple with, but more on a strategic side, giving you a perspective for growth, for innovation, and ultimately to provide to the end user a great user experience. So what are we talking about? So let me first begin by outlining the 4 pillars of this credit directive. So let's start with pillar 1. It's the scope of the directive. And one of the main new things in this directive is the range of products that fall into this directive. This is a major change compared to the previous one. So now the directive includes other credit products like buy now, pay later instruments, loans under 200 euros, overdraft, leasing instruments. So it has been significantly expanded in the terms of the credit products covered. That said, there's still an upper threshold of 100K euros, beyond which products are excluded from this directive. So most of mortgages will be excluded, apart from mortgages are under the mortgage directive. So this is first pillar. Second pillar. Second pillar addresses affordability and creditworthiness assessment. This is a major also change. This is setting higher expectations on how banks and financial institutions will evaluate and will evaluate the ability of a borrower to repay. So from now on, I would say banks will not have to ask themselves, will their borrower be able to pay, but also will the borrower be able to pay, and will the borrower will be able to pay without undue burden. So also in responsible lending in the focus. So it's a major step forward that goal. But maybe you say, what? Okay, that's fantastic, but what are the implications on a daily basis? And have deep implications. And one of them is that purely mathematical or profiling-based models will no longer be sufficient to do credit assessment, underwriting. So banks will have to consult credit databases wherever they are available, both private, both public databases, and as the directive says, to make reasonable efforts to access and use those databases. That's comprised in Articles 18 and 19 of the directive. In this context, obviously there are plenty of companies and fintechs, as is the case of Mifundo, that can support banks in complying for our particular case. So moving to the third pillar, it's about communication. And we say, okay, communication, yeah, but it's very important this point compared to the previous directive regarding advertising. So no preventing from aggressive, misleading, or ambiguous marketing campaigns. So to protect the consumers, but also in terms of sales, this directive will prevent sales to be linked, sales goals to be linked to the remuneration policies in the bank. So let's put it this way, so not to close a sale, whatever it takes, which is not always in the best interest of the consumer. Again, putting the accent on the consumer protection. And finally, the fourth pillar concerns fairness and non-discrimination in cross-border credit. So this principle is comprised under Article 6 of the directive, which explicitly says no credit institution may treat a consumer less favorably based on the nationality or place of residence. So obviously, any credit applicant can be rejected, but must be for fact-driven reasons, but not on nationality, not on the place of residence. And now at this point, I can assure you, I promise that we didn't talk to Christine Lagarde for drafting this article. I know it looks like we did, but we didn't. But probably it looks like a fit for purpose for Mifundo. That said, seriously, this provision is where Mifundo can add value, and not only help you comply, but also open new opportunity to spoil, to treat international customers, and to permit them to have access to credit. So when is this happening? So it's happening now, and when I say now, I mean next Monday. Next Monday is going to be, this directive is going to be transposed at the national level. And then institutions, credit institutions and other lenders will have 1 year to implement such a directive. And from that point, the regulators will be able to oversee a proper implementation of the directive. So to wrap up, international customers are a significant share of credit applicants and offer excellent growth opportunities for banks and lenders. And Credit Directive 2 is a great opportunity to mobilize internal resources so the momentum is optimal at this point. As we've seen, this is not a niche. This is a potential increase of 10% in your retail portfolio. And if you have the data in place, you can underwrite this segment with the same level of comfort as you do with a local population. So we like to end my presentation with the mission and the claim of Mifundo, why it was founded, why it was born, and is to provide the freedom to move to people and the freedom to be trusted by financial institutions. So I'm happy to take some questions. Otherwise, also after the coffee break, happy to take some questions too. I saw that nobody got sleep, so that's good point.
Then I will have a quick question.
Sure.
Like all the regulations, they all intend to do a lot of good, and then the reality tends to be a bit different. Do you feel that in 2 years' time there will be something significantly different, for example, for you, for me, both foreigners in the countries that we operate? What will actually change for us?
Well, I think it's already happening. I mean, I think well, I'm kind of optimistic on that, but I think we are. In our case, we are talking with many banks, banks in virtually every country in Europe, and I think they have the willingness to take this forward and to at the end going through a great integration. So that's one tiny first step towards that direction. And I think that the regulator also is willing to take us there. So I think we will see disruption in verticals like lending, as we have seen in the past 10 years, disruption in payments, for instance. So now today, seeing things in payments that 10 years ago were unthinkable of.
Okay. If no further questions. Thank you. Thank you, Alex.
Thank you.
So moving from Estonia to Finland, Jarkko Mäntsivu from Saldo Bank, and he's going to cover the kind of like his challenger bank take on the B2B liquidity and embedded solutions. So Jarkko.
Everybody hear me? Thank you, Marcus. So, firstly, apologies for my voice. I'm still trying to shake off this cold, so if I do run out of voice, I'm sorry about that. Trying to move forward, I mean, it's been very interesting discussions this morning where there's been a lot of discussion on what should banks be, actually, right? Should they be technology companies? Should they be banks? Should they be on cloud, off cloud, hybrid cloud, all that stuff. So I'm kind of happy that I think my address will speak a bit on those sides. And firstly, perhaps to talk a few words about the company. So Saldo Bank, nobody knows it because we are an 80-person, very new, very small bank. We founded in 23, and 25 is our second full year in operations. However, if we look at why it's a bit different is that we are one of those who have created a greenfield bank, meaning that we just basically looked at what needs to be a new bank, and we built it. And this is now where I'm going to just talk a bit about what do we see that's missing in the market? Because the key thing for a new bank is, right, well, why do we need a new bank? So what is the new bank going to do? What is it going to do that the big banks aren't doing already today? Which is something that I'll try and cover, whilst also giving few concrete examples of what we've actually built, how it looks like, and then hoping that will spark a bit of questioning. So we are not a Revolut out there like we said today. That's a very funny one, that there are a lot of Revoluts out there. So we're not a super app, don't even intend to be. We built the bank for one very clear mission, which is democratizing access to credit. So we are focusing on that side, which is actually very well what Alex just pointed out. Works very well as a continuation. So I think it's been a very clear setup on the speakers from that perspective. But a couple of topics. So what does it look today in B2B access to finance? And what then when very obviously we've heard today the word embedded probably 20 times, right? So what does that look in the B2B world? What are the solutions out there today? What do we think is happening in that world? So a few observations from that, and then moving on to what a small player like us is going to try and do in that field. So the sort of prospectus, the problem statement, there's a huge gap in B2B access credit today. Whether that'll be the global 5 trillion, which is of course a Gemini figure. But then if you look at more importantly what McKinsey has written, it's very obvious that they believe without embedded, that gap wouldn't very well be tied back together. So even in Europe alone, which is of course the main point of ours, we are talking several hundreds of billions of gap today. And if we are talking about how to support the economic growth, how to support the companies, entrepreneurship, well, clearly this is one key thing that we can try and do. And nobody's saying, by the way, that big banks aren't trying to do it, but big banks aren't doing it today well. They do several things extremely well, right? They have their own good coverage. They are already, like we've heard today, they're trying to partner up now further and further with tech companies, with fintechs, trying to get themselves out there. We've heard they're building complete new infrastructures in addition to the current legacy that they have. So they'll be ready in the future, to tackle this in a much sophisticated format. So it's not like they aren't doing what they tried to do now today already, just that today in this world that's not enough. And that's why I believe that there is still places for challenger banks like us. So we've heard the word neobank. I still like the term challenger because, again, we need to be able to challenge somehow, not by size, because that's obvious, but by somehow. Moving on to the B2B embedded, right? So perhaps no need to go into all details what the embedded in B2B could be, but you can think of very wide use cases, whether that'll be platforms, points of sale, combining leasing straight to the buyer, whatever that may be. That is in all the places there is still lack of access to the solutions actually from the B2B world. And then when we move to what are the core use cases, right? So there is a need for more working capital. There is clear use cases in sort of supplier invoice financing, which is a lot of stuff what we're seeing happening today. Now there, the issue becomes on how can we get the funding behind it? How can we actually make sure that the embedded will start to flow? It will start to bring the liquidity into the market, right? And in the strategic values, well, that's something that everybody today has heard already. We need to get to real time. Customers, even in B2B world, don't anymore want to wait for months or weeks or something. They want it to be an instant solution, and they want to get to it very quickly. We've also talked today about customer stickiness, right? If we can plug very well the platforms into the product offering of the banks, that'll actually create even the stickiness, and it will drive this transaction growth like we've talked about. But in the end, it all comes down to, well, Davor is not here because he's on the other stage, but he was then raising this risk, right, from the technology standpoint. So what's the cost of making the bank more technologically proven, making it more able to think of the business differently, attacking, for example, embedded? And that's, of course, something where, as a regulated entity, you always have to be in balance, doing both worlds. Moving a bit forward, I think one bank in the market that stands out to me, I think there's at least Monzo today in the hall, so coming from their neck of the woods. I think what we've noticed when we look at who are doing well in the market, at least in somewhat, we're thinking who should we try and see what they're doing, what's up next, and so on. It's one that I was prompting Gemini with me, so Alika Bank. And what they've done is they've also created a quite new bank. Not remembering exactly if it's 7 or 8 years old that they're now, but they do a lot of stuff where they do what Davor was talking and what was spoken in the morning, combining the hybrid. So combining technology to personalization. That's, at least to what I can find from the market, their ideology and their way of really trying to win in the market, which they have done quite successfully. Now, when we talk of this embedded, what we see them doing is they're doing it on a wholesale play, right? So they are partnering up with the platforms, they're funding the fintechs, they're doing it as a wholesale play. And of course, us as a small bank, we don't have the capacity or the funding to do the wholesale, which is why I'm going to talk about what are we going to try and do in embedded in just a few minutes, but it won't be the wholesale, because that's for already bigger, more established, like a Liga Bank here as a question. But at least we see that they are trying to rethink this from a different perspective and trying to really make it work on the hybrid approach that there is. Talking a bit about us as a Saldo Bank. So I've been here before speaking, and then if you look to the top corner, you will see the architecture slide I've shown here before, which was the sort of 1.0 of what we built on Greenfield to launch the bank in. And then, again, reminding we are 80 people in the whole bank, so it's not like we can do whatever we wish. But what has actually happened in 12 months or so is the 2.0 picture below it, which is, for a size of ours, again, how do we proceed in our mission? How do we proceed in our strategy? We've built different components, again, into the architecture, allowing us to move forward in the way that we need to. And very interestingly, there are the building blocks to do embedded. And for us, what it means by embedded, again, I'll cover that in a minute, but it's not, it all starts from the architecture, right? So if there was the question, which was in the morning, is bank today a bank or is it a tech company? I mean, from my perspective, I'm going to say we are a regulated tech company. So the word bank, yes, for me it means regulation. It doesn't necessarily mean being a bank, but that's where we are today. So quite happy about the result that we've built, and that it's on the Greenfield, it's fully composable and it's components based, which means that we can very swiftly maneuver on to where we see the need. And in 2025, the biggest strategic move has been the move towards B2B and towards embedded. So we started with B2C and then started segueing more into B2B. And now we're moving into the embedded, trying to make sure that we fulfill to our mission. When we look at quickly on what's behind it, right? I know Hannah was talking a lot about credit risk. So I did want to mention here, because regulation has been a big part, I always try and think the other way. What has regulation actually given us, right? And for us as a bank, it has given one thing. The EU regulation has given open banking, because that's actually something that was born out of regulatory push and so on. Because in the US, if you've read the recent news, even Visa is now pulling out from USA open banking efforts, because they don't seem to all agree in USA what it means to do open banking. And then again, if I think of us, our entire data and analytics is based on open banking, it's based on PSD2, because that's the only way we take customers, we identify them, we run their credit scoring through the full bank account data. And even now for B2Bs, we of course still want to get the PSD2 data, whilst it's not as powerful as for consumers, but that's the mainstay of all of our analytics that we do. And that's the one thing where Europe, even if you always say, Europe regulates, USA innovates, well, in this case, I think that regulation has also been a bit of an innovation. If you think of new players like us, it gives us an opportunity to do it that way, rather than trying to be in USA where the big banks are now talking that they will start to charge the new players on the data, which would probably make it then not working as an open banking. Again, buzzword today, wanted to touch quickly. AI, right? Well, nobody can go through a presentation anymore without talking about AI. What I really wanted to touch was that in our company, we try and now focus on how is it measurable. So how is the work that we do, the benefit we get from AI, how can we measure it? And the only reason why I'm only using here analytics as an example is because that's where you can actually measure it. And there are a few bullet points there measuring how we're utilizing that today. It's extreme gradient boost that we use in the analytics function. So it does create already clear benefit that we can measure and we can prove in the analytics function. However, it's not yet something that we could say, whoa, this is groundbreaking. No, I mean, it's a great progressive movement, but it's not yet groundbreaking versus logistic models or other models that may be used. There is, however, good use cases like the AML one that I'm mentioning there. So the AML scoring that we've built in-house, that's where we were able to use the agent to aggregate the data in much better and make it in use. But that's just, again, thinking we, as a challenger bank, with limited resources, with limited money, we need to think smartly. When I heard over the lunch the discussion on how much should banks invest in AI, well, I'm rather thinking what are the use cases we should find to invest in, but that's where it is, right? But all of our analytics, all of our credit scoring is based on NPV. It's based on cash flow that we convert into NPV, but we can't make that work unless we get the full data where open banking plays a big role. And that's perhaps my message to Mifundo that was here before me, that the more data that we can get, because what is AI? It's nothing without good data, right? So that's where at least we see a lot of use cases. If I move forward, so what is then based on these two slides, the architecture, the analytics? What is the domain that we are trying to do that will help us break ground in the market, fighting against fintechs, fighting against banks? So what is our domain? Well, it's the whole orchestration layer, right? We need to be very efficient in the way the digital journey of the customer goes, whether we speak about B2C, whether we speak about B2B. So it is actually that we've tried to build in a way that when there was a discussion this morning, are we a first bank to the customer? Well, we are saying openly, we don't even aim to be the first bank to the customer. We don't often offer today current accounts. We offer products on savings and products on credit that we expect to be so good from the offering, from the orchestration, that the customer just wants that one product from us and buys that one product from us. And that's the different strategy compared to what, of course, the big banks today have a very good position in, having the full scope, having all the big customers that they have today. And yes, we do believe in this transition where the customers won't have any more one bank. They have several banks, and we're going to be wanting to be one of those banks that they bank with for a certain product, whether that'll be in savings, lending, wherever that may be, B2C, B2B, or then on the embedded side. Now, what this brings us, this whole orchestration layer, the architecture that I showed, it brings us to the B2B embedded, which is the key thing that we've been building in 25. And this is how it looks like, right? So when you think of wholesale in embedded, it's easy, right? Big bank will fund a fintech lender, and they will fund the end customers, and there is liquidity to the market, right? So what we are doing right now with few successful partners already and more to come is actually to replicate the process from early on. So merging the technology with the fintechs, the customer will be approved by both companies, will be onboarded by both companies. Naturally, on the regulatory side, when we talk about AML and KYC and so on, it will always be us who will be doing the customer selection, who will be doing the data retrieval, and so on. But what we're trying to do here is, instead of wholesale, we want to bring the embedded to the end, where we actually, through the embedded partnership with the fintechs, we will fund the end customers. Thus, allowing the fintechs who are today with a good reach to customers, geographically, or other ways they may have good channels how to reach customers, which we as a new bank don't have, right? So we want to handle the technology, the regulatory, the analytics, whatever the fintech is lacking, right? Funding, of course, included. So whatever is that the fintech is lacking, we want to bring that to the table. And we still want to release that so the customer will actually be serviced fully by both the fintech and by ours. So it is actually going to be a full partnership. But we go all the way to the end customer rather than just doing on the wholesale. So that's something that we, at least in our way, are trying to do what the market, in our view, is lacking, which is finding the way to bring liquidity through the embedded solutions into the market. And this is our way, through technology, to bring it up. And there are some interesting things here, like you see that after digital signing, we can actually replicate the data into the ledger of the fintech. So they can actually treat it on a surface, on the front, as their customer, whilst on the back, and on regulatory terms, it is, of course, our customer. So it is something that has gained a lot of interest, especially on the B2B fintech side. And this is what's our way to drive the bank forward from now on. Finally, where is this all then leading, right? So you always need to be a bit visionary when you are running a new company, right? So where this is leading is, of course, I still believe all the banks will be some level platforms, one way or the other, somewhere down the line. And that's been our mission from early on, to make sure that we do the right choices to allow us to be a platform, because actually the embedded you just saw fits well into platform thinking. So what does this fintech need from the platform? Do they need A? Do they need B? Do they need A, B, and C? And that's what we are now building and trying to do. What is the example here, what we've looked at, perhaps a bit of a more unknown bank for Europeans, but it's a company called Nubank, which is mainly based in LATAM. And I think if I look at their technology, right, which you see in the image, that's pretty much something that I look up to saying, well, that probably looks like, a good one. Whether it will fit regulatory manner into Europe, right? Nobody knows yet. I haven't gone into checking what that platform actually looks like from all the components based. But that's at least on a vision level, something we look at saying, what if there was a platform which could deliver all that? B2C, B2B, embedded, even marketplace like they have there. That's at least on a visionary level, something that we are seeing that the market may be lacking, even in Europe. Whether Nubank is coming to Europe soon, I don't know, by the way. It's not something I'm trying to advertise here. It's just that when you are a new company, you need to look in what is out there in the market. What do you think is working and what do you think is worth following? And these couple of banks mentioned here are somebody we're trying to follow, not to copy, but just to see how they see the market and what they're trying to do, and then making our own inroads into what works for our mission and our strategy. So that's it from my side. Thank you very much. And I said here, kiitos.
Thank you. Maybe if there is no further questions, but I have actually another one. I mean, you seem to be in a similar situation as any other challenger bank. Is that the incumbents, they have no reason to change. Challengers want to change something, and then there will be a race. Who is going to get either you get to the point as a challenger bank that you all have matured the solution, you have created enough traction on the market, customers already like you, it somehow starts to create pain for the incumbents, or incumbents basically finally start to do something, changing their complexity, starting offering something that is valuable for the customers. So if you're looking from this perspective, I understand your challenges, but if you think about the incumbents, what is the main challenges for them to move to the similar direction that you do and basically outrun the incumbents?
I have an easy answer for that. The only thing preventing is the legacy that they hold, right? So if they had no legacy where their old customer base is in and they could just, run everything on greenfield, they would be much more competitive, even working in where we work today. So we try and bring the credit where it's underserved, talking about micro companies, talking about small companies, which are not in the focus point of big banks today for obvious reasons, right? But the big banks, make no mistake, are exactly building this tech structure now, that they are going to be ready, they are going to be able to fight. It's going to take them a few more years, in my view, right? So our runway is now, but if we don't get this model and we don't get our business proven in the next, say, 3 years or so, I think they're going to be ready then to challenge us much better than they do today. So it's not like they are thinking, oh, I don't need to do anything. They are, but it's taking a bit of time still, and that's why there are, for challenger banks, now a bit of runway, if they can, and we can, to make sure that we uphold to everything we promise to deliver.
And you say that this runway is approximately 3, 4, 5 years?
In my view, but that, of course, I don't know everything that the big banks are doing, but based on what I hear from the market, based on what I hear in my discussions with the incumbents and so on, maybe longer, maybe shorter, but that's where I would sort of put the needle on.
Coming from the incumbent, I will give you an extra couple of
Thank you. Thank you. Yes. That's fine.
Raiffeisen. Thank you. Good afternoon, everyone. My name is Serhiy, and I'm from Ukraine. I represent Raiffeisen Bank Ukraine. I am responsible for lending for PIs and for small companies and for private entrepreneurs there. And I have just 5 steps of this presentation. First of all, I would like to explain you the market context and how business worked in this environment. After that, I will dig deeper in the problems our entrepreneurs have, our solution, and results we gain. So, what first of all should you know? I would say thank you for all of you and for all European countries that supports Ukrainian displaced persons or refugees. Especially you should know that there are 5 million of Ukrainians are in Europe. 1 million in Germany, 1 million in Poland, 3 million in other countries. So first of all, thank you for your countries and for all of you for that support. It's very important for our families, for our citizens. But this presentation not about that. It's just introduction for my explanation for you of economic circumstances. What you should know, that it is -5 million of workers and -5 million of consumers from the economy of the country. And here's the context we are talking about. There is a context we are living in. We have 30% GDP decrease in the first year of war, and after that, we have slightly economic growth. So the entrepreneurs are one of the main drivers of Ukraine resilience. Who we are? I would be happy to say that we are a leading bank, very digital and very innovative, but we are not. We are one of the banks who are typically said like digital laggards in all these PDFs about digital transformation. So you can imagine us as a digital laggard. We are a little bit behind our market in terms of digitalization and quality of value proposition for the customers. We are a big bank. We are number 4 in the competition of assets in the country, and we serve 120,000 SMEs and more than 2.5 million of PI customers, of private individuals. What you should know more about our market? We are a credit card-driven market. About 55% of population use credit card. 55% of bankable population, of course. The product number 2 is buy now, pay later. Installment loan, pay by parts, it's called in our market. But you know it is a buy now, pay later functionality. And driver number 3 is that about 30% of entrepreneurs use credit products for any of their needs to support their working capital, to support their liquidity. And of course, we have these programs with EBRD or another financial institutions like risk-sharing finance and cashbacks to support our development economy. This is our market context. Talking about our market share, we are number 4, and we have 7% of market share in assets. So we are not the biggest bank in the market, but we are number 4. And the market is mainly driven by government banks. 52% of market of assets are driven by government banks. What it means for us? They are more now about creation some social good and less about business. And all these government-supported programs who supports entrepreneurs, crucial industries, or and of course EBRD and some financial institutions, they are mainly going through banks, through government banks, not through commercial banks. And also we have fintech players. I would explain you only two examples. First one is the biggest in the market delivery company. Their name is Nova Post, like New Post. And they already launched fintech based on their customer flow, and they issue loans for SMEs. And the second player is the biggest in the country e-com player, is Rozetka. It's like an Amazon of Ukraine. And all e-commerce is going through this marketplace. And they also have their own fintech, and they are coming to lending. So to wrap up this part of the presentation, we have growing GDP, first. Second, we are a credit card-driven market. Third, half of our assets portfolio is driven by government banks. We are number 4, and we have fintech companies from e-com and from delivery who are coming into the lending for SMEs. Here's our market context. Who are our entrepreneurs? 5 years ago, I would start this presentation from the steel and metal industries. But unfortunately now it's destroyed, so our biggest drivers of economy is agriculture, retail and wholesale, personal services, and IT development, of course. So here's like 4 types of our customers who we are talking about. We are talking about entrepreneurs, agricultural, or IT stuff. And what kind of problems do they have? Can you see it here? Yes. They have troubles that are bigger than assets to finance. The problem number 12 of our entrepreneurs and our companies is access to finance or credit. The biggest problems of these entrepreneurs or customers are insolvency of customers, cost of resources, electricity, for example, change in regulation, and mobilization of their staff. So they have lack of labor resources. And the access to finance, to the loan, is the problem number 12. 11% of customers have this problem. We went through our typical agile playbook where we started from customer interview, then we make qualitative research, then we tested our hypothesis with customers. This is not presentation about that, but we went through this program. What we understood and what kind of problems do this customer have? They have the biggest problem, high interest rate, difficulties to obtain the necessary amount of loans. It's typical problem for every market. I think we should not dig deep there. Of course, the money is quite expensive on the country. Our central bank rate is 15.5%. So if you want this loan, you should have higher margin to pay higher than 15.5% a year. The money are quite expensive on the market. Of course, we have inflation, it's clear, and we have liquidity constraints. It's clear. During the interviews with our customers, we understood several problems that are typical for lending, like bureaucracy, a lot of documentation, manual application, slow process, especially for bigger companies. It's clear on every conference we are talking about that. But what we found not typical for us, for our market, that one main insight. What we understood that our entrepreneurs use their personal credit card for their business need to support their liquidity, to support their working capital needs. And that was the main insight of the following presentation and of our following development. I'm in this market for 19 years, and I've worked as a CRM director, as a head of buy now, pay later business, and I knew market quite well, but I didn't know about that. I didn't know that private entrepreneurs use personal credit cards for the supporting the liquidity. That was the main insight. After that, we made quantitative research. It's already like 7 or 8 months after this insight. We understood that 17% of entrepreneurs use personal loans to support their liquidity, and 15% of private entrepreneurs use business loans and business functionality to support their liquidity. So, as you know, 17 is higher than 15. And it's simple. And we started our development based on this insight that customers already use their personal credit cards for working capital needs. What we did, we offered for customers what they need. Our solution was simple credit card with higher grace period, with higher limits, premium type of PI-based credit card. The credit card in the PI app, the customer journey, repayment functionality, everything is like personal individual customers, like private consumer in the credit card. But the only one difference of this process, only two differences. The main difference is from the risk management point of view, we treat these customers as a businessman, as an entrepreneur. And we calculate the ability to repay this loan as an entrepreneur and calculate higher limits for these premium products. And the second part is technical. We should communicate, and we had to make an integration with National Tax Authority system to inform the tax authorities that these customers opens new account. So we didn't invite credit card, but we repackaged this based on needs and pains of these customers. Like if you have higher interest rate, your biggest pain, we have free grace period for 100 days for all types of transactions. If it was difficult to obtain the loan, we offer a digital process in 5 clicks in mobile application for private individuals. And all other functionalities. Also, on clear lending terms, we simplify tariffs, everything costs 3%, like 3% per month, 3% ATM withdrawal, 3% every ATM withdrawal. For legal entities, we made exactly the same, but based on overdraft for legal entities. What it resulted for us? Before this so-called innovation or reframing or repackaging of a problem, we used to sell not more than 100 credit cards a month. Now we sell 7 times more, from 800 to 500. And looks like it's great progress. And we are redeveloping our functionality now. And next steps, we are creating the same product, same functionality for new-to-bank customers. Talking about overdrafts. After relaunching these overdrafts, we also have significant boost of our sales. And that's simple. But what is the main conclusion here? Before these changes and before understanding customer journey and their needs, our focus as a bank was mainly on cream de la cream customers of top agricultural firms with highest revenue, with highest potential portfolio. And this caused for us some troubles because we were too dependent from government-supported programs. We had customer churn, and we had huge exposure on agricultural firms. By changing this type of business model, and we are in process of changing this business model from, like our risk management said, it's low and growth strategy. We offer firstly small limits, credit cards, overdrafts, and after that we cross-sell for bigger ticket purchases like working capital finance loan, like investment loans, like secured loans to this target audience. And even based on our summer campaign, we already received like 8% conversion of customers who use overdrafts or credit cards of the conversion to the real business banking loans with bigger tickets and lower prices. What has resulted? You remember that we have GDP decrease, and we had constant customer churn from 9,000 of active SME lending customers to less than 8,000 at the beginning of this year. And now, due to this innovation, so-called innovation, it's like changing value proposition and channels and using PI products for entrepreneurs and doing the same for legal entities, we have customer growth. Again, almost 20% in the first 9 months of this year. So it's just simple steps that I wanted to share with you. And main conclusions of this presentation, here's my 5 key points. First of all, we should understand the context. For us, being not the first year in the lending market and not the first year in the lending product development, we understood main customer insights that they already solving this problem with another methods. And we just made another method, this method, but better. Second part is ask customer first what we did, and we understood the insight. Then we should focus on delivered core value before changing business model. Like we catch customers with credit need first, then develop their as a cross-sell functionality. And creative solutions, we found the way to deliver value for business banking customer into the private individuals app using private individuals product. And our next steps, we are scaling the success. That's all. So thank you so much. I think this is an innovation in value delivery and in customer experience. But for sure, we didn't invent the credit card. We didn't invent the decision-making process, but we repackaged that. And we used like our legacy systems. That's why I don't know, it's so called, for us it's so called innovation because it's the same, almost the same product, almost the same process, but just another combination. And for us, it brings us great results. We stopped our customer retention and we start to grow.
I've seen some kind of overview about the so-called banking innovations in the last 100 years or so. I think that the last one, something was coming in 1960s, something was coming in 1980s. In the recent years, the only innovation has been whatever is causing the next financial crisis in a way. Some kind of packaged products, but you know, cannot be modest here. I would say that the kind of the innovations that are happening because we do listen to the customer and adjust our products. It's very much, I mean, impressive turnaround as a kind of product. In any kind of society where there is some kind of major shock going through, the war being like one of the good examples here, but what other challenges you see in the Ukrainian banking market as such that, you know, the things where the customer needs are significantly different than the things that the banks do need?
I think, I don't know about, I cannot say about entire market, but I can say about our challenges. Our challenges is two types of regulation. Because we are regulated by Central Bank of Ukraine, by National Bank of Ukraine, with a different approach to, for example, Ukrainian bonds. And as a part of Raiffeisen Bank International Group, we are regulated by, according to European Central Bank rules, with a different view of the risk profile of Ukrainian sovereign bonds, for example. That is why, answering your question, risk-weighted assets from two types of regulation, local one and European one, is one of our biggest challenges. From the customer point of view, access to credit, especially when you have not sustainable business, is still quite challenging, especially for small entrepreneurs and micro businesses. And I think also for bank is the biggest challenge is like risk management, especially when you have pressure from the government and pressure from the society that we should issue mortgages, for example. But if you almost every 5 or every 6 years you have crisis, would you like to offer mortgages for 20 years or for 15 years? So this mismatch from customer expectations, it is very complicated to receive housing loan in Ukraine now. So, but and for consumers, and bank don't want to do that. I think there is an answer.
Maybe the last question about the timing. How long time did it take the whole effort for you to go through the whole process of talking to the customers until the product was actually ready?
I think the beginning of these interviews, actually at the beginning of this journey, we wanted to create another overdraft. it was like a project to recreate overdraft for customers. It was in February, I think, this year. And we understood this insight, I think, next month, on March. And we repackaged product in summer and launched it in summer, I think. But we had everything that, besides we just needed to connect another decision engine to our PI process, and that's all.
I just remember one of the good presentations. I don't remember the name of the bank now, but basically Ukrainian biggest bank who took the whole infrastructure into the public cloud in just a matter of a month or two, because if the rockets are basically exploding next to the data centers, then you just...
Yes, you have a completely different discussion with IT architecture, compliance, and other.
But this is something, as I think it was an excellent example, that the typical European bank, it probably takes like 5 years to plan, and then they start executing. And in the kind of like the crisis situation, the people are capable for much more, like delivering something in a very short time frame. So this is also, from my perspective, like an excellent example. Don't need next budget cycle in order to plan something, but we just get things done in 3 months. Thank you, Sari.
Okay, thank you.
For the panel discussion, are the credit models there? That's an ambitious statement, I would say. And what's replacing them, and who's actually doing it? So kind of looking into the world where everything is getting disrupted, but the world is still necessary.
Thank you, Mark.
Thank you.
Okay. Good. Well, welcome all, and welcome dear panelists to the discussion. I mean, normally when I've been on the panels, it's always been a push of time. So for now, for once, it seems like we'll have a lot of time, so you can really speak up. I think for the first, let's just do a round where you can introduce yourselves, and if you can, go for what Marcus already pointed out as well, very sort of challenging question: are the traditional credit models dead? And if they are, do you see that there's anything proven that would prove that, so to say? But if you introduce yourself and just say yes or no, or give out anything that you may already think that we can use in the panel, that we can draw on to why we would think that they're dead. But firstly, the introductions.
My name is Dimitris Anastopoulos. I'm Chief Risk Officer of Snappy Bank. Snappy Bank is a new digital bank here in Greece. Started its operations this year and got a license from Bank of Greece 1 year ago, almost. If I could go to your question and give a reply, I would say that is too much to say that credit bureaus are dead. This is my opinion. I mean, credit bureaus have.
Sorry, Dimitris. Credit bureaus are the next one. Just the traditional credit models.
Traditional credit models. The traditional credit models, I think, no, I think they are not dead yet. They still have significant impact in the decisioning process. Nevertheless, they have to be adapted. That means that they have to be enriched with new kind of information. That means mainly transactional information, the PSD2 information that I have mentioned previously, taking into account debits, credits of the client, spending patterns, and sometimes even this model should take into account non-traditional information, like, for example, information that could be taken from marketplaces, see how the clients behave, how they behave within these places, about the size of the basket that they use and stuff like that, when they make payments, when they buy their goods, and try to analyze them, incorporate them in the models that we call them as traditional, and like that, improving the predictability and the discriminatory power of the model. So I think that yet they are not dead, but they have to be adjusted.
Okay, thank you. Serhi?
So I have this. So can you hear me well? Yes? I'm Sergey, and I have experience in leading lending in different banks in Ukraine, and also experience in fintech and in CRM and customer value management processes and building CVM. Answering your question, I don't think that traditional credit models are dead, but I fully agree they should be and must be augmented with additional data sources like telco data, like behavioral data from mobile application, or another open source data from the customers.
Okay, thank you. Hanna?
Hanna Sarraf, I'm CRO for Monzo Europe. I think to answer this question, we really need to kind of remember what is the fundamental business problem we're trying to solve here with the scorecard. And it's really an all-age, ever since banking was invented, simple question: if I lend somebody money, are they going to pay me back the money? That's essentially what we're trying to solve here. And historically, if you go back in time, those of us who were lucky enough to kind of go through the process of the branch relationship management to seek a loan, essentially the scorecard back then didn't exist. So it's all about who you are. Do I know this guy's parents, which city they live in, how they are dressed, and the relationship manager make a score, a virtual score opinion in his mind. Actually, this person is creditworthy because they're employed, they can pay me back the money. Fast forward, scorecard 1.1 to 1.0 after Basel came along. We said, okay, well, look, we can take that relationship judgment and then put it into different factors in a model and say, actually, you know what, if this person is employed, if this person is within this age bracket, and actually they live in this postcode in that city, therefore there's a higher chance that they're going to pay back the money. So what essentially we're trying to figure out here is the capacity of somebody to pay back the loan, but also their willingness to pay the loan. That's what we're trying to achieve. Fast forward to now, what happens is nothing. The problem's still the same. We're still assessing likelihood of repayment, but the advantage we have today is a massive tsunami of data available at our fingertips, driven by behavioral cash flow, real-time cash flow analysis of bank balance movements. And what AI does allow us to do today is to classify those movements into simple features that you can incorporate into your traditional scorecard model. So the answer to the question is, are they dead? I don't think they're dead. They are actually, it's a necessary but not sufficient solution anymore. We have to augment them or layer them with those features. There's an industry there called feature engineering. Basically, you hoover trillions and trillions of data and try to classify them to different factors or features. And these themselves can be then incorporated into your typical classic logistic regression model, so they can then use it to explain and augment the power of predicting the likelihood of repayment.
Thank you, Hanna. I think moving from that is exactly the sort of next point, which is there was already credit bureaus mentioned. So when we go to the points that you all raised, that it needs to be augmented, it needs to have much more granular and new data sources in it. Are credit bureaus still going to be the bedrock of the decisioning, or is that going to change? And if yes, how? Let Hanna start.
Well, that is a really good point, because most of us, especially if we're entering a new market or we're starting to start up from fresh, and we don't have the history of default history, so they can build a model. So you're going to have to rely on credit bureau. I suppose the credit bureau, it has, for me, it's not so much of a dead industry, but it must evolve. Like everything else, we're all evolving with the new technology and the world around us. I don't think providing an institution with a static score is going to do it anymore, because there's so much that could happen between in real time in terms of cash flows, real-time cash flow movements, or using some open banking data, you may form a different view on that particular customer. So I suppose from a credit bureau perspective, for me, is to see the evolution of that industry from static score production to something more of a real-time event-based notifications. So therefore, if I'm receiving those scores from my credit bureau agency, I would love to know if they are aware through their open banking channels or API channels that actually there are real-time early warning indicators that I need to know about now, not just to wait until the next time I call for another score. So that dynamic aspect is important. The other element is, I mentioned earlier feature engineering, like they have the ability to, again, hoover all that information and classify them into meaningful, accessible, simple features that one can use to augment the bureau score. And if you do that well, and if you really want to get clients to engage with you as a credit bureau agency, you need to be able to explain to the clients the contribution of these features to the final score. So you don't just hit me with a score of 600 or 650 or 500. Tell me of that 500, how much of that is driven by demographic features, transaction features, behavioral, and then at least I can have meaningful understanding of the behavior.
Okay, thank you, Hannah. Go ahead.
In my mind, I think credit bureaus have an institutional role. I don't think how easy it is to be replaced. We must not forget that they have the full respect of the banking institutions, they have the full respect of the regulators, so they play a significant role. Nevertheless, I have to agree with Hannah because it seems that they have to reinvent a little bit themselves. That means to incorporate in their enormous databases, because they have enormous databases that they already utilize them, they already build models, they already use machine learning models. It's not something that they invented now. The machine learning models are here the last 15 years. So they already analyze their information, but what they have to do is to enrich their information. It's what it was previously mentioned, get information from other type of sources, open banking data, bring them inside, try to analyze them, build all the variables that we call them, the features, the independent variables as we call them technically, in order to make, in order to summarize on a more discriminant way their models, because they already have models, some of them. So I would say that credit bureaus will be there. They will have to change the way that they work a bit to become better, to include more information, open banking information, transaction information, and proceed with improving the models that they already have, because as far as I know, they do have. I think it would be quite interesting if they could provide us, it was mentioned, early warning signals. This is what we are interested in anymore, not just whether somebody is good or bad. It might be good, let's say, but it might have a higher probability of being bad after a few days or a few weeks. It would be, for example, very interesting if they could utilize their information to build other kind of services, like rehabilitation scores, to help risk managers to select among, let's say, clients that seems to be bad, but they have a high probability to become good. Not the opposite, because currently this is what we do. We have the probability of being bad, probability of being defaulted, let's say. Let's change the way and let's think a little bit differently. How somebody who is defaulted, was the probability of being bad after 6 or 7 months, so to slightly open the door again to them. So I think they will, credit bureaus will be there, and they will update their services and become better and support the mission of the banking system.
Siri?
Yes, I also think that credit bureaus are not becoming obsolete. They, and in our market, they're evolving, I think sometimes even faster rather than biggest banks. Their development is mainly driven by also non-financial lending institutions. And for example, our credit bureaus in our market, they provide us with online data. For example, how amount of requests to credit bureau today or during previous 5 days. And this is the first online service that they provide us via API. Second one, they already sold and we tested with them the product when they can predict the probability that this customer will buy the loan or credit card from another provider, not from her main bank. That's the probability to buy the product, and we used this this product from credit bureau, and it increased the efficiency and the conversion rate in our campaigns significantly. And third point, in our market, credit bureau are sometimes driving this data science or AI-driven innovation, and they're going in cooperation with telco providers, and empowering or augmenting their data with telco scoring. For example, of probability of proxy income. What is the probability that you have such type of income in this bucket? And we also use such product both from or telco or credit bureaus.
Thank you, Serhi. I think the telco one has been an interesting topic here. And I think drawing that to sort of an additional question relating to credit bureaus is, we're talking a lot about B2C basically here, right? But what if we turn a bit to what I tried to touch earlier on the B2B, access to liquidity and so on. Do you think the credit bureaus are doing enough to enable banks and financial institutions to actually gain the new data that is available for B2B lending? And what should they be doing so that you would want to buy more services from the credit bureaus for B2B specifically?
For bureaus, I can answer. First of all, let's cover the first telco topic and then bureaus. We tested the income probability and certain level of revenue probability with telco, like for private individuals. It didn't work quite well for micro companies and for private entrepreneurs. We tested, and this didn't work. From the business to business point of view, we use effectively, and we use almost all our decision-making process for business to business based on data from bureau, for new to bank customers, of course, and from the open data about the revenue, about the finance. But what is important for us, and from this point of for B2B, it is very important to understand so-called group of connected customers who have connection like from the revenue from the business point of view, and have groups of customers like entrepreneurs and several legal entities are connected to one to another. And from my point of view, where bureaus can create additional value by better understanding and better showing to all banks this group of connected customers. Like I can be a co-owner of your company, we can have another company together, and we can with you be financially connected, like I'm generating 50% of your revenue. So I think this is a group of connected customers is the greatest point for development of bureaus in this area.
Okay, thank you. And I think before I pass on to Dimitrios and Hannah, just bringing on what you said, Serhi, on the connected customers, I'm also, you said something about getting the revenue live, but what I mean is, do you actually mean that in Ukraine you can actually get interim financials live from the credit bureaus? Because I think that's the biggest lag I see, yeah?
No. We can have last year financials from government statistical agency, not lifetime.
Thank
you. Last year reporting only.
Yeah, concerning your question, I think at least here in Greece we have this capacity using the credit bureau to get information for businesses and having an idea about the profile of the business and the financials and the main financials of the business. Nevertheless, what could be quite interesting here is that credit bureaus could, let's say, deep dive on their data again, try to analyze them and serve the banks again with either a score or a signal whether the company that requires a specific finances is a result of a financial distress or a result of the need to be developed. I think this is something that, for example, credit bureaus could work to analyze their data and try to discriminate between those two. Yes, so that's from me.
Hannah?
Similar to my colleagues here, I think the fact that there's a lag. The biggest problem I have at the moment is static data. The static data, you're automatic and reactive mode. So if something goes wrong, you're the last one in the queue to be either repaid or figure out what's going on. So you really need something slightly more forward, like more, you want to call it early warning signals, whatever you want to call them, but something that helps you anticipate, predict, and therefore act quickly. And for me, the bureaus sits on such a wealth of information. They could help by augmenting the static data by, it doesn't have to be open banking data. It could be macroeconomic factors that they believe are very highly correlated with certain SME type structures that could be sensitive to an economic movement. Anything that can help give you that early warning would be really appreciated.
Okay, thank you. Then let's move to the sort of regulatory topic a bit which I touched earlier. So when we talk about the black box, now this is consumers that we're going to talk about, right? So there needs to be full explainability and transparency of the models, right? We all say that there's a lot of new data available, which has to be incorporated, has to be augmented. We all agree on that. But then comes the other point, which is the regulator, right? So using our company as an example, we would, of course, very much look to have the sort of process to be approved instead of the model, right? To take away that regulatory transparency for allowing the models to be self-trained. But where do you and your companies sit with this? Where do you see the sort of regulatory black box transparency? Have you calculated anything? Have you looked at what it would mean for your company if that was taken away? Start from Hanna.
So it's interesting. Maybe this is a question for the regulators themselves, because I was looking earlier at one of the slides of CC, the Consumer Directive 2. It says you must have better than standard scorecard, but then the EU AI Act said you must be able to explain those. So like, both camps are completely not conflicting, but it involves a trade-off. And in anything else, it's really assessing that trade-off and make up where do you want to sit on that spectrum between 100% very predictive, super sophisticated model that can tell me with precision the likelihood of somebody to pay me back my money versus I can explain fully the decision whether I can grant a loan or not. I think that's really the trade-off. And along the way, you can deploy any type of models. Historically, the scorecard 1.0 would have been more on the explainability side of things. You can say, well, there are 6, 7 factors. Typically, 2 of them really are predictive. And actually, one of them is the most predictive and tend to have that customer defaulted in the past. And therefore, if that customer has defaulted in the past, therefore, it has a high likelihood of defaulting again. Useless kind of scorecard models, but they are there. They were built, and a lot of banks were using them. And moving along the spectrum from there, say, okay, well, maybe we should do something slightly more clever. Maybe we could do something more like, regression analysis. Maybe we can do multi-factor analysis. Maybe we can do what we call nowadays neural network. But neural network has been there ever since I went to university, and like it's not new. The reason why we talk a lot about it today because we have the technology power to compute those networks at speed. Whereas in the old days, I remember back in the 90s, to run a simulation, you have to hit the button on a Friday evening, go home, come back on Monday, see hopefully that the system didn't crash and you get the answer. So you have that speed and power to compute. Therefore, neural networks are usable. And therefore, along that spectrum, and then you go into ensemble and deep learning and all that kind of stuff. Having said all of that, each one of these adds incremental information value to your predictive power of the model. So then the question is, on that spectrum, I want my strategy here, if I'm building a model for, let's say, credit scoring, I want to assess risk. My strategy is to always observe that I want to be able to explain the outcome, and at the same time, I want a predictive model. We talked about credit bureau earlier. If you take credit bureau scores applied on a sample population, not the full population of the bank, but take the thin credit file population. So take away the obvious no's. Like you're not going to give someone who is, less a certain age, or someone who has, I don't know, a certain history of gambling. Whatever, you're going to exclude them from your population anyway. If you look at the near prime kind of population and apply the scorecard and look at the predictive power of that scorecard on that sample population, it's no more than 20% in terms of Gini ratio. So when you add open banking data on top as a feature engineering, as explained earlier, that could nearly double in terms of predictive. So you have an interest in augmenting the predictive power. So we're not talking about, well, I want this to be from 80 to 90% predictive. We're saying we're going from 20% to something like 45, 50%, which is good in lending circles when we talk about Gini coefficients. So therefore, there is a strategic objective here from a risk management perspective to augment the predictive power of the model. Therefore, using those clever tools, you call them black box, but they're essentially sophisticated analytical techniques that allows using data to improve the predictive power of models. On the flip side, this has to be explainable. Meaning, if you decline a customer credit and a customer asks why under either GDPR or EU AI Act, the answer cannot be because the neural network, third classifier layer had the number 3 on it, and therefore it's declined. It has to be something that the customer explain and understand. So the trick around here is essentially go back to the point about if you are going to use open banking data, transactional data, behavioral data, which is super powerful. As I said, it can improve accuracy ratio from 20 to 40+%. Use that in the model in a way that you can classifying them by features. So classify, different type of data into different factors. We call them dependent variables, basically, and then you ingest them in your classical model in terms of regression analysis. So then, this becomes easy to explain the why, but also easy to validate, because then you could ask yourself, show me truly that this is adding value. So you could apply the standard statistical techniques to validate those features. As I said earlier, we used to use a lot of factors and models in the past. It's only one or two really that matter. Now, are these really features predicting something? And this is where you can demonstrate and justify the reason why you're using them, but also are they explainable to the customer? So I'll end on the point of that paradox you're calling it, essentially, it has a cost, right? Because every time you go on the spectrum of I want to improve the predictive power of the model, you need to invest in techniques, processes, people, validation teams, and so on. And for me, the cost really, it depends on whether your organization as a bank has already invested in what we call in the industry the model risk management framework. Different countries in the world, but also different regions, different regulators have different spin on model risk management. Where I come from, model risk management has been in angst ever since the Basel II came along, and therefore, for us, this is another feature you have to add into your framework, meaning explainability now becomes something you have to put in model development standard, you have to put in model validation standard, you have to put in the governance standard, and as you go through all the layers of model risk assessment, explainability, transparency, fairness, ethical use, all of these become key feature for an independent model validators will look at. And therefore, when the model validation report is produced, it covers so many different things, including the explainability factor. And that can then be part of proper governance of models. That has a cost, but fundamentally, the biggest cost ultimately is how much are you prepared to forego in terms of predictive power percentage, right? In the interest of being able to explain more with using a simpler model. And that has an impact on ultimately impairment, because like we're talking about ECL in the credit world, PD, LGD, EAD, they are all models, and we're trying to make as accurate prediction as possible. If you have less predictive models, there will be probably slightly more volatile loss history or loss rate. And the question is, how comfortable, what is your risk appetite as an institution to tolerate volatility and losses in the interest of being able to explain, but using less sophisticated tools?
So it is a paradox, even if you elaborately said it, but it's still a paradox, right? Anything to add, Serhii Dimitrios?
Yes, I just want to add something on this paradox, because it is a paradox. It is a paradox because on one hand, banks are responsible for protecting the client. That means you have to provide credit to somebody who can pay, and you must not provide credit to somebody who cannot pay. And at the same time, if you use a very good model, a very efficient model that can detect who can't pay back and who cannot pay back, you cannot use it because you cannot explain why you approve or you reject. So it is you understand, it's a paradox by itself. I think here potentially, and I hope that we will see some changes in the future, maybe banks should start, of course they have to be compliant with the regulatory environment, and on the other hand, maybe they could, let's say, use a combination of the two methods, ending up in a regression model that could be easily explained, as Hannah said. Or maybe they could use, let's say, more advanced techniques to a very specific areas where the traditional models cannot discriminate between which client has a high probability of default and which does not have. And as long as they perform some models there and try to analyze and see what kind of results they provide, they could potentially open a small door to open a discussion for the usage of such models in the future. Because at the end of the day, the client is protected and the balance sheet of the bank is protected.
Can I add one anecdote, just to show you in practice where you're bumping against things. In one example situation in the past where we have a jurisdiction and we're trying to validate the models using that jurisdiction. And it's a discrimination model, so it's scorecard, discriminating goods from bad, log odds and all that. And the team came back and say, look, we've done the validation and we found that one of the key driver of default here in that country is gender. So if the borrower is a male there's a higher probability of default than a borrower female. And trying to sell that. So this is where you get, quantitative analysis versus ethical bias, and it's hard, right? So the legal advice there, Godwin, you cannot have that in the model because it's discriminating. Guess what? It is a discriminating model we're trying to build. So like, how can you discriminate if it's not? It's an interesting dynamic.
So we can't shape the paradox again. Sorry. Serhi, anything to add? No.
No, I just wanted to say that nothing to add. I wanted to join this discussion just to hear the explanation because I tried to avoid this question. But I consulted with our risk management team. And what we do? In the corner, for us, the biggest part of modeling is explainability. So if you have very best neural network or random forest driven model with Gini 85 and explainable model with Gini 50, we would go to the model with Gini 50. But what we can do and what is not regulated so hard is limit management. So So that's why we use this low and grow strategy. You can use combination of model that is explainable with lower Gini that predicts will this customer repay loan or not. And you can use another your home-driven model for prediction, and you can have limit policy. Limit policy is not regulated. You can issue for this man. Huh?
Yet.
It's not regulated yet. But for those men, you can issue 100 euro limits and check. That's why from our experience, we are also regulated by European Central Bank as a part of Raiffeisen Bank International. We issue for so-called gray zone. From your point of view, it can be men. In our point of view, it could be another persons. I don't know really who they are. But we issue for them small loans, like 100 euro, 200 euro, and we are working on upsell or credit limit review procedures after that. So it's a real paradox. I don't know the answer, and nobody knows the answer, to be honest, but we can use explainable models for decision making, like probability of default, yes or no, and you can augment this decision, yes for men, but with lower limit, with significantly lower limit. And there is where next stage of strategy, low and grow or limit management, we can say.
Thank you, Serhi. Very good idea. Let's take a sort of a pivot to another type of risk and modeling topic. So if we think of outside of credit risk, let's go for ESG, geographical, all the sort of non-direct risks that are out there. So in your view, what is the most underpriced risk at the moment that you see for either yourselves or for banking in general in this field? Start with Dimitrios.
I think this is a really difficult question because the first answer that we could say is that it's not easy to predict what is this risk. So in my mind, I think that the most important that we have at the moment is one is the geopolitical. That is also quite difficult to be quantified, practically quantified, I mean. We live in an era of a lot of tensions, to Europe too. It's not like in the past. So this could impact it and impacts unexpectedly interest rates, liquidity, and this a lot of times create a lot of stress in the balance sheet of the bank. So the geopolitical, I think it's the first one. And we have seen that also in Ukraine with the war and what happens there. The second one is again connected to the geopolitical and has to do with the cybersecurity. Those two go hand by hand. We have seen that. I think that all the institutions and the companies will have to invest a lot in this area. It's the number one risk, I think, at the moment. It's unpredictable. You don't know what is going to happen until you have an attack. And sometimes the attack, it's not like the defaulted clients where you have time to react and close and stop dispersing loans and this and that. You can have sudden bad things happen in the cybersecurity area. So this is the second one. And the third one, it's I would say is the continuous additional of the addition of regulations. Is the fact that we always are waiting something to be regulated and again, making our life quite more difficult and giving to us less degrees of freedom, let's say, to innovate and proceed. So I think these three are the most important in my mind.
Thank you, Dimitrios. I think for that one, considering you are also a new bank, have you priced any of these risks into your risk models or not?
Yes, we have taken this into account, especially concerning the international expansion. But at the moment, Snap is quite limited in financing. So I wouldn't say that we have practically put in our model such a factor. Nevertheless, what we have done is that we have invested a lot in the area of the cybersecurity, I would say. So from the day one, even before the day one, there's a whole team there, up and running, protecting and monitoring the whole environment of the bank. In the credit risk, I think at the moment we are too small to worry about that. So we have invested a lot as a first step in the area of the cybersecurity.
Okay, thanks. Serhii, do you want to take the next one?
Yes, I can prepare a PhD about risks I underestimated in my life. First, I used to have, at my previous job, I used to have an office near the embassy of Netherlands, I think. And 2-3 days before war, they rolled down their windows. Can it be a sign for me? Now, or trigger? Early warning signal. For me, yes, it could, it will be in future. But I underestimated this risk. Coming back to professional type of view of question, to the professional view of this question. We have, as a company, big exposure on agricultural firms. And what is the all factors there is not under our control. Geopolitical, like logistic, political influence from Poland, for example. So logistics cannot be underestimated. Second part, the world prices for grain. It's also underestimated. It's macroeconomical factor, finally. I think those are quite underestimated also now. What also should be, what type of risk is underestimated now? I think the changing of geopolitical power, especially from the point of view of energy resources. The gasoline can be much more expensive soon. It will influence all areas of our life. For example, delivery, production, so the cost of resources will increase, and the ability of SMEs especially to repay their loan will decrease because of that. And fourth risk that I think is quite underestimated now is the fragility of energy system. I think the electricity, and in case of any geopolitical significant events, significant threats, the energy infrastructure will be under the threat. And without electricity, any businesses cannot deliver value. They will not have the revenue. So everything like frozen. So the fourth and one of the biggest underestimated risks, I think we even should model. What would be in Europe, what would be with our bank if there are 3 days without electricity, or half day without electricity, or months with limited electricity. From the European point of view, I think there is even should be included in stress testing.
So have you priced that into your models?
Yes, we have special risk factors. We have several types of special risk factors in our risk model and expert adjustments. For our reservation policy, one of them are, we call it blackouts. It's a special risk factors, and not from the ability to repay the customer, to repay the loan point of view, but we have significant influence of blackouts on our sales of loans, for sure. But it's also influence on SMEs, to the revenue, to the success also. So answer to your question, yes, we have special risk factors, including geopolitical exposures, more territory can be occupied, and also we have special risk factors, so-called like blackouts.
Okay, Hannah?
Like we can pick any of those subjects. Really, they are all like mega trends in their own right. For me, if you ask me, if I want to narrow it down to the one biggest risk for all banks, nearly, that hasn't been really thought through properly, either from regulation perspective or market pricing or practice perspective, is sovereign risk. If you go back in time and you try to figure out all the banking crises that happened across the globe, the single common denominator to all this, some form of sovereign sustainability challenge. At least we're in the country of one of those, and I come from a country which we had one of those. And every time you have that sovereign debt sustainability issue, you're almost guaranteed there will be banking failure after it, because banks are exposed to sovereigns, and therefore, are they priced? Well, certainly regulators don't think so, because they have zero risk-weighted assets on these, so it's risk-free. Yet we all know every single basis points movement in any of the spread of the bonds that you bought for investment portfolio to diversify your income stream has a massive implication on P&L, balance sheet, capital, and solvency. So this is very important subject. Yet it's been avoided. It's like the elephant sitting in the room over there. Basel Committee doesn't want to address it. They issue discussion papers here and there, but that's it. Not much. When we come together as an industry practitioner and say, look, like, what are we going to do about it? I mean, even if you try to do something internally, like forget about RWA and say internally, like how do you assess the risk of, we're not talking about sovereign default, like sovereign downgrade. I mean, last 2 weeks ago when France was downgraded. Right? We're not talking about developing country anymore. It's developed countries being downgraded, and has massive implications of those banks who hold sovereign debt on their balance sheet. Right? What happens if Italy follows? What happens if other European countries follows? And therefore back to the limit, because again, I think limit sometimes be perceived like this is like a stopper of something. Actually, it's the most useful tool you could ever use to diversify your eggs rather than having them all in one basket. So you can have different limits at different sovereign, different countries. That's how you call pricing it. It's more like managing it, because there's no way you can put a price on sovereign default, because it's just going to weigh out. There's no way you can provision for that.
Thank you, Hanan. Well,
I also support your point of view. I agree with what you're thinking about sovereign debt. For example, if you consider Ukrainian banks that invest in government bonds, from the Central Bank of Ukraine point of view, it's zero. It's zero pressure to the RWA, to risk-weighted assets. But from the European Central Bank, you're issuing you're lending, you issue the loan for the government that is in default. Finally, for the consumer who is in default, and the significantly higher pressure to the capital and to the risk RWA from the different points of view. I also agree that this is quite underestimated.
Thank you. Then let's continue the journey. Let's now move to, let's say, a bit ahead again in terms of, if we think about traditional credit risk modeling and so on. So in the era of embedded finance, right? So if we think of a structure where there's a platform, there is a bank/financial institution, right? So who actually owns the credit decision and the risk? Is it A, the platform issuing the loan? Is it B, the bank servicing the loan? Or is it C, an external credit model?
It's like this type of question B.
Well, Serhi, let's start with you because you already jumped on it. So tell me B and why.
Please.
No, Serhi, go ahead.
If this is type of question, the answer is B. The bank owns the decision, and who pays, who is capital, that is the owner of decision, the owner of the risk. So I think from our experience in buy now pay later market, the bank pays for risk, but the user experience and journey is owned by ecosystem, by the partner, by this partner. I think there is only one possible answer there.
Yeah, let me comment. Sergio, you're right. From regulatory and from current standings perspective, of course, it's always the bank who does the who owns the actual balance sheet risk, right? And therefore that's the one. But if we think of more on the where are we headed, right? So how do you see this? So that's fine. That's the answer. Absolutely, 100% correct. Do you see any evolution in that? That's sort of part of the question. Do we see that that's changing? That the banks can actually A, outsource credit risk modeling somehow in the future, or B, have risk leveraged away from them towards the platform?
That is a very nice question.
Nice meaning not good.
I think there may be a pressure from the platforms, from the biggest platforms like Amazon, from the biggest player of the market. The more loans you issue as a buy now, pay later functionality, they would be happy if you have 100% approval rate. And that would be cost zero for the platform. Correct? This is the ideal state. Or even you pay additional cashback to your customers if you issue loans there. That would be ideal state for the platform. But so the platform cannot own the risk, because for the platform, the best state is 100% approval rate there. Can it be another way? You sell for everybody, even for people who will not repay this buy now pay later loan. So I think there could be a pressure from the e-com providers, from the platforms, to increase approval rate of these loans at the platform. But finally, over the time, the lending is a basic business of the banking industry, of the bank. And I don't think a lot of banks will outsource the decision-making or risk management process to another provider.
Yeah, I mean, that's probably just trying to bring a bit of, let's say, productive conflict here. Wouldn't the bank be able to agree to making a creditworthiness assessment towards the platform that they can actually outsource part of the risk and this way increase the penetration?
I don't know.
If anybody wants to take that.
I think it's important to differentiate the type of models we have there at the moment. So you have this, what we call the SaaS model, so software as a service, right? Like you sell a platform and it's white labeled and somebody else's journey and someone else's problem. Of course, you're responsible on the performance of the platform, but you're not responsible for the regulatory risk attached to everything that is attached to the platform. And then there's what we call the BaaS model, which is banking as a service. Slight nuances between the two. I used to work for Starling Bank, and BaaS was one of the key selling points for Starling. Starling was a UK bank that sold its banking platform to other banks who wanted to be digitalized quickly. So it's a quick win for both. There are a couple of success stories in Eastern Europe and Australia. So the biggest challenge we had at the time, the number one challenge, wasn't with the partner, wasn't within the bank itself, it was with the regulator, trying to make them understand that exact question. Who owns, not so much about the scorecard or the risk, but is who owns the customer? Regulators across Europe is all about customer protection, customer conduct risk. You see it in the UK, you see it in Europe, you see it in Ireland. Every country has its own version of consumer duty. You need to make sure you are always operating in the interest of the customer. Therefore, the accountability on producing good customer outcomes was the question back to both parties. Who is responsible for the customer outcome? And it's a long journey to convince them at the end, okay, that part of the journey is owned by the partner, that part of the journey is on the, you're selling the regulatory license essentially to some other retailer to use it, but you still have the accountability and the obligations of all the various compliance requirements. So it's not an easy kind of, like you're not buying a software that, white label, put your logo and you move on. It comes with this entire compliance, I don't want to call it burden, but it's a big cost that has to be dealt with.
Dimitrios?
Yes, I think in the era of embedded finance and concerning the risk and who owns it, I think we have to define what are the risks. For example, there is the main risk in my mind is the legal risk that was mentioned. This, for me, clearly belongs to the banking institution, because it's the regulated institution, it's the balance sheet provider, end of story. We have the risk. they will have to follow the rules, you have to follow specific disclosures, specific guidelines, and blah, blah, blah. You know that very well. Now, in the area of the cost of risk, because this is an issue, this could be, let's say, agreed between the point of sales, the merchant through which we disperse the loan, and the bank. That means it can be negotiated. And a part of the cost could be paid by the merchant, and a part could be paid by the bank. So the cost of risk could be split, let's say, between these two areas. The legal risk, nevertheless, is on the bank. Now, concerning the model, it depends. Not it depends. I mean, if the model is externally developed, then, of course, the company that develops it has a responsibility. They have to develop it scientifically correct. They have to validate it. They have to backtest it, and etc. But on the same time, the bank also has a responsibility again, because the fact that somebody gives you a model and assuming that provides all the evidences that is a fantastic model and etc., you have to monitor it, you have to validate it independently, as the regulator says, you have to run internal exercises, be sure that everything is correct. So I think on 2/3, the risk is on the bank, I would say. Unless something changes in the future.
Okay, thank you. I'm seeing the chair of today for our session walking in a way that I don't think we were allowed to use the full time, although we were sort of getting in that. So I think, Marcus, do you want us to ask questions from the audience, or are we wrapping up? Oh, then I was wrong. Okay, then we conclude.
If anybody has a quick question, then yes. Otherwise, I would use it for the very British afternoon tea break, as it is announced in our schedule. So we will continue around 16:00, so 4 o'clock sharp. There will be, in this room, there will be cybersecurity risk and all that stuff. In the other room, there will be the boring things, the customer experience. So whoever wants to join here, then happy to accommodate you. Everybody else can be on the other side. Thank you very much for your time.
Thank you.
Can you hear me? Okay, so right now we have a next speaker. Where's dynamic?
We can try with putting microphone here, your mic.
there's no option for USB. There wasn't the option. Δεν είχε επιλογή του χθες για USB. Η επιλογή ήταν...
Ναι, αλλά όταν το βάλαμε και έπαιζε από το USB, δεν έπαιζε τα ηχεία του λάπτοπ.
Ναι, αλλά δεν είχε επιλογή για...
Δηλαδή δεν το παίρνει.
Δεν καταλαβαίνει ότι έχει συνδεθεί κάτι.
Το άλλο το λάπτοπ.
want the podium?
Okay. To your pocket.
So the first participant was not able to join us. At least she's online, but nothing else works. So therefore, we continue immediately with our 410 topic about georisk simulation, preparing for the cross-border shock events. And Sotirios Papakonstantinou is taking over the topic.
Long.
Yes, it's sorry about, but the names around here are challenging.
You can also say, you can just say Sotirios. Okay.
Okay, Sotirios.
You can leave the last name.
Okay,
it's
thank you.
not an easy one.
Handing over to you.
Thank you very much. Thank you very much, Christina, and the organization committee, which I'm here today for you, in order to address an interesting subject where we discuss it in the early stages of planning this event. I will try to give you a strategic overview of what we have done in Optima Bank as far as geopolitical and geopolitical risks. And why does this matter so much to us? It matters because, as all the panelists, all the previous panelists have mentioned, that at the end of the day, we have a connected global economy. So whatever happens in one region of the world, you have somehow think that it could disrupt in some way your business in the local environment. I tried to find out a lot of, and I came up with a lot of definitions outside. Even I used some AI agents, but I think at the end I came up with this one, which is not cross interest with ESG or other with other risks. Here we can read that geopolitical risk is the threat, realization, and escalation of adverse events associated with war, terrorism, and any tensions, where at the end of the day will disrupt global peace and prosperity and all of this stuff. And, or it's the collection of risk-facing companies that stem from conflict or other tensions worldwide, and they disrupt your business. I think when we are in banks, you have to think both of them. Because at the end of the day, a geopolitical risk may have a direct impact on your assets or indirect impact through the supply chains of your customers. What do we mean with cross-border shocks? A geopolitical shock is dramatic, anticipated, and significant event of violence, etc. It increasing geopolitical risk for economic activity, disrupting international relations. Here we have seen in Europe at the latest, after the Ukraine war, that we have some domestic conflicts. We don't have spillovers in a broader area. We don't see the conflict going outside Ukraine, even some drones, they're flying, let's say, over the cross-border countries. But they stay in, let's say, in a local in a local area. Even in the Middle East, the Israeli Palestinian tension focuses on mainly on the Gaza region, with some bombing on the Lebanon state. So, here comes the risk management department. When we have tensions, the first one that calls us is the national bank. they sent a very easy to read letter, and they state, give us your thought, what would be the impact on your portfolios, let's say from the Ukrainian conflict, full stop. And then you have the management of the bank ask you, as a risk manager, what are they trying to say to us? We need more capital. We will have, would we have liquidity problems? Do we have to do something at the end of the day? Because management is not, it's looking for actions and not some theoretical exercises at the end of the day. How we try to measure geopolitical risks? There is not a unified, let's say, aspect in this. Some organizations or even private companies are trying to map all the great events that have an impact in the global economy. You can find easily some time series and methodologies online, which we can employ them and explore them, how this, at the end of the day, can have an impact on your actual figures. So we have all the, you have the sources of the data. What we are going to do with all of this? Just present them to the board and send them that a time series of conflicts may affect the bank? Who cares at the end of the day? They have to see what's going to be, what's going to be mainly if you are listed with your stock, or what's going to be if they're going to be a disruption in the execution of your business plan. So, the first step, if you want to do it right, the first step is to establish a framework. As a risk manager, you can't go around the bank, your organization, and simply just deliver non-papers or some exercises without having an establishment of a proper framework, where you have to select all the scenarios, you have to identify the stakeholders, which is critical, and you have to say what tools are you going to use and what are the metrics in order to say that this whole exercise is successful. So you have to first try to establish a framework. If you can do it with yourself, always there is a possibility to engage an external party or a consultant firm which have more capacity for you. The second step is to walk through the market and search what kind of model are you going to use in order to quantify all of this massive data that are available. You want to use agent-based models. You want to use quantitative. You want to use hybrid. At the end of the day, just think about it that your outcome if it is significant, has to be disclosed and explained to investors by people that don't understand all of this. So it is, the previous panelist stated, explainability, but not explainability from the risk management perspective, but from business perspective, it's crucial. I maybe choose to have an AI cool model, which at the end of the day states that we're going to lose 1% of the CET1 capital, but I'm not the one that is going to explain it to the stock market. So how a CEO could understand and present all of this to potential investors. And the third step is to plan your scenarios and perform your stress testing quite with a lot of caution, because all of this, because geopolitical risk can also have a devastating impact if you run a test without having all the parameters right. And I can't imagine myself going to a board and say, okay, we have a conflict, let's say in India, and in the next 10 days we're going to close. I will be fired. That was the first reaction. He's talking about some people that, I'm talking to people that don't understand what I have done. And I'm told them that if somebody is if there is a conflict, the other side of the globe is going to close my bank here in Greece. So think about it as if you are the board members, and I came inside and said, oh yes, we established a cool framework, an excellent framework that performs an geopolitical stress tests. And now there is a tension in Australia. Okay, we need to raise 500 million in tier 2 capital. I don't know if you would accept. If you accept it, it would be fine for me. Okay, because this is the outcome of my exercise. Okay. So these are the key steps that we take in our bank, trying to incorporate some geopolitical factors in our models. First, we define the scope and the risk appetite of our exercise. The scope, let's say, when we have the Ukrainian or the Israeli-Palestinian, was to identify which line of business, which part of our customers, for our customers' base, is going to be affected somehow from this conflict. If there's going to be a drop in their business, and if we're going to have, if we call it a sick event or a default event. You have to separate them. You find a way to separate them both. You need the first line, of course, in order to communicate with the clients and get this info. You cannot do it by yourself, just using system data, because you somehow we all have large companies, our portfolios forming commerce with the United States, but at the end of the day, when the tariffs came along, the impact on our bank was minor. And then our clients were not disrupted by Trump tariffs. You have to enhance geo-risk intelligence identification. You have to find data sources. If they are already available online, you can use time series from large organizations or rating agencies. And then you have to enhance a risk-aware culture inside your own bank, because when something at the end of the day comes to the risk management department, it's already too late. You have to have early warning systems, and you have to train your people on the first line to use them. We need the triggers, but someone else has to bring this forth for us. Because when it comes to the qualitative ones, we are not easily caught through the data channels, then the time is something that is valuable, and you can't wait. You don't have to wait until it has an impact on your client's balance sheet. So the training of the people and the culture for to make them on board on this exercise, let's say, or in this system, early warning system, is crucial. Then conduct special assessments and scenario planning. Always you have in mind that you need to present plausible scenarios. But at the end of the day, we saw that life has always some great scenarios that we cannot draft and assess. Try to be reasonable, and maybe sometimes it is it's more easier if you bring some people in the same room and perform like, let's say, a wargaming play. Bring people from the first line, from the second line, from the third line of the defense inside the room. Tell them that you need to draft or to formulate some geopolitical risk, and let them give you some ideas. What will come out from this? Maybe it would be, I think it would be so useful for the risk department to continue with this analysis, and you get a feedback outside the risk, how all the others think of what are you designing. Then develop and integrate mitigating strategies if it's possible. If you have catastrophic events, then the only mitigating action is the state to intervene. But if you have something that the management has the ability to act, bring it forth and state the actions, measure the actions, and help them get the right decisions early. Last but not least, you have to continuously monitor, evaluate, and adapt in the current environment. It's not something that is static. It's not something that you should perform it once in a year. It's something that it has to be in the risk department culture, always to adapt in the new environment. Okay. And last but not least, some key challenges. This I've already stated: the lack of executive sponsorship. Don't make it a risk management exercise. Engage your management from the beginning in order to have all the necessary tools and access to the people. Siloed data and expertise, that's where you need to perform, that's where you need to collaborate, bring people from outside the risk department to the table when you're designing your scenarios. That's at least that's what we do, because they always have other perspective than us. Use measurement and quantification issues. Yes, it's something geopolitical risk have it inside of them. How do you measure all of this? We saw that you can use models. You can use data sources. You have to define them clearly. What are you going to do with what and how? And last but not least, cultural resistance. If you're trying to integrate new risks in your risk culture, always there will be the change, bring some reaction, even if the upper or lower management. So we have to be clear what we're going to try to do in order to bring them, to have them on the same side with us in this kind of exercises. Or at the end of the day, will be another nice to have tool for the regulator. So, at the end of the day, geopolitical risk, as stated, has emerged. It was always around us, but has emerged in the last years because we see that the peace in Europe is no longer a de facto thing that we should have in mind, but local conflicts may happen in the near future. Even pandemics or even whatever, I think that the imagination is the limit when you're designing a geopolitical risk scenario. And at the end of the day, the challenges is that when you have a geopolitical risk, not all the cross-border members of where it comes have the same reaction. Even we go away from the conflicts, let me state a visionary example. Let's say that here in Greece and northern Greece, we have a pandemic in, let's say, domestic animals. Then all the Greece healthcare department demands all the people to kill all this animal and prepare sanitation, something like that. But on the other side of the border, you have 3 countries that at the end of the day, let's say they had no reaction. And you have the spread of the disease from their side. And at the end of the day, when I'm buying a new dog, it will eventually become ill because there was no cross-border collaboration. That is the tricky and the difficult part with geopolitical risks. It's not depending what are you going to do or what your nation is going to do. At the end of the day, they need much more collaboration and coordination among nations, which at the end of the day are not in the same region. They don't even lie in the same, let's say, global organization. You have the EU members which act fast and they take measures. I think many times they go to the very far side for their actions, but you have inside Europe countries that are not EU members. So they are not bonded with what all the others are doing. So this is the part of that we as risk managers cannot intervene. We have no, even the banks have no call for. We cannot tackle this. It's something that is on politicians. And at the end of the day, when it comes to the politicians, I think it's a cool geopolitical scenario by its own. Okay, to model it. Thank you.
Thank you, Sotirios. If I may, I have 2 very simple questions in the end. I mean, as a board member, I have read and those kind of reports and analysis, and these kind of materials always reach to the board in order for us to be more aware about the true risk that the bank is carrying. 2 questions for you as an expert. If you look the average bank readiness to produce a paper that would have something meaningful written into that, on the scale of 0 to 10, what would you rate it?
I think that now the banks are, and I think the major banks, I think that there are 6, the smaller ones are 2 to 3.
So
we're not ready, even we have COVID, we have all these tensions. It is not for the domestic banks, it's not in their culture to think outside the box. What would happen if something happens in the other side of the border? And this is something that we're trying to change.
And the second simple question, if any of that paper is being produced already, and we can't even predict what we want to have ourselves for the dinner, probably, because our appetite changes many times. You are bringing all kinds of political examples, etc. There is so many unknowns in the mix. How much that paper actually reflects the reality?
That is the part where you need, when you're drafting such kind of paper, when you need people from all the spectrum of the organization, and even from outside, if you can, consultants or agencies or something like that. You can't predict that the Etna in Italy will produce, let's say, a winter phenomenon, and for the next 2 years there will be a drop in the global temperature by 2%. But I think we can, you can target your team where you can actually has a meaning and you have some tools to act. If this is something that, let's say, we will have a devastating earthquake of 9%, what are our BCP? Our BCP is to keep ourselves alive and our families. I don't think that the first priority would be to raise capital for a bank. It would be weird if there is a person, when there is a catastrophic event, that would think that we need to keep the bank solvent at the time. You have to be realistic in order to have the scenarios some meaning for the management and the board.
Mm-hmm. Okay.
If it's gonna hit us an asteroid, we're gonna sit and enjoy it. We cannot do anything at the end of the day.
So we are going to go only more gloomy and gloomy, I see. Thank you, Sotirios. Thank you for the presentation. This is probably one of those topics where I personally say that, you know, as the kind of like the prediction capabilities today are probably low in the banks, but not having anything at all is probably even worse. So this is usually the common result about any of the risk management. Moving on to the next topic, and this is about beyond risk management, how to build a culture of resilience across the bank. So this is the most fun topic, how to deliver the actual culture change in the behavior of the bank and in the people that are working in it. And it will be Jonathan Winkler from Commerzbank to give that overview.
No.
I'll give you one. Just working? Okay, perfect. And I need the, you still have the one for the, perfect, thanks. The good thing about my presentation is that it really fits your color scheme. Thanks a lot for that. And I think it's also, I might also give you some good answers on really train your employees and your colleagues to have that risk awareness and this risk culture. And I really will deliver some practical examples from our bank. I'm Jonathan. I'm working for Commerzbank. It's the second largest private bank in Germany. And today, I think this presentation fits quite well. We heard about resilience in the morning, and now we heard about geopolitical situations. And I think that those are two topics I want to cover with a special focus on the culture part of it. It's really the aim of this presentation to think about how can we take every employee with us on this journey, so not to lose someone. That's not only an exercise for the top management, but for all employees on our company. And I want to help a little bit with, you have said that the world is messy and there can be so many things, and I think that is true. But I think there are also some narratives which can help us to understand geopolitics a little bit better and make it more tangible for our employees, and maybe give them the feeling that they do not need to panic the whole time. And in the end, I want to really give you 3 brief examples of how in our company we are training employees through simulations to actually show and build that resilience. But first, a little bit more about resilience, and we talked about it in the morning. I think resilience is actually a thing which you can train and which you can acquire over time, and I took this from psychology. So we are now making a little bit of move into psychology, and then we are coming back on the organizational level. So if you look at this definition of resilience, which I took from the Cambridge Dictionary, so something, the first thing comes up when you Google it, says the ability to be happy, successful again after something difficult and bad happened. And we all know that feeling, right? We are losing our jobs, we have a family crisis, and then finally we, most of the time, thankfully, recover somehow, and this is somehow the resistance. There was an interesting experiment taken by a professor, and he put up a $50 note and asked the students, would you take it? And of course, all the students were raising their hand. Yes, of course, $50, why not? Then he threw it on the floor, and he asked the students again, would you still take it? And the students still raised their hands and said, of course, I would take it. And then he even put some dirt on the $50 note, and the students still wanted to take it. Why? Because it's still a $50 note, right, and still has its value. And the same is true for us as humans. Even if we go through times where we have difficulties, maybe there's like a bad situation in the job, we have a boss which we do not like. If we have enough self-esteem and self-awareness, we are still a human, we are still worth something, so we do not lose our value. And this is something people try to train in psychology, and I think this is where we also need our organizations to be, right? Even in times of crisis, where the world around us is crazy or we have internal problems in our organization, we still want to be resilient and want to be able to recover from that. And that is actually, I think your points in the morning were going in the same direction. This is how we can define resilience in an organizational context. So something to achieve an intended outcome through uncertainty, disruption, and change, being highly resistant organization by foresight, preparation, and planning, and minimizing service impacts and be able to recover. So we can all think about organizations where this is kind of key. I mean, one example is obviously, maybe a really radical example, the army, right? Imagine your country being in a war and the army is losing material or in worst case, even lives. We expect from an army that the army recovers rather fast. If something gets lost, it needs to be somehow prepared or made up for it. And an army does that through measures like strict discipline, for example, or like standard operating procedures. Another example I have to bring as a German is like the German railway system, which is really bad at the moment. And why is that? Because they were not investing for a long, long time. And now if a tree falls on the tracks, there's only one track and not two tracks. If personnel is sick, there's no one to replace the people. If a train is not working, there is no other car to replace that. So this is an example where a company obviously failed to build up operational resilience, and now they're getting in huge problems, and customers are unsatisfied. And of course, we in banks, we should also be very resilient, because that is what our customer expects from us. And I think we heard in the morning that trust is an important part of banking, and I think it's actually the core part of banking. This is why people choose a bank, because they somehow trust this company to take care of their money. And this operational resilience is key. If we look at rising NFR risk, for example, geopolitical risk we see, but the trade wars, but also, for example, cyber risk. I think this I will mention later as well. And cyber risk is probably the biggest threats to non-financial risk factor in banks nowadays. We see regulatory scrutiny also demanding us to take care of that, build up frameworks. We need to have a more holistic perspective on risk. Let's see, the geopolitical risk is, of course, a horizontal risk factor, which also has an impact, for example, on cyber risk. Now cyber risk affecting, comes from certain regions as well. And this is what is meant by the interconnection of risks. And finally, I think, and that is obviously controversial, I think we can also add some value, because if we create a resilient company, it's actually a value in itself, because we have fewer breakdowns in online banking, in our services, and that is, of course, core for customer satisfaction. Should be standard, but isn't often. And then, of course, there's this cultural element, which I want to focus on today, where we really have to think about how can every employee in a company have that risk awareness and be aware of risks. Going more into the geopolitical risks, which you have tackled just now, I want to create two narratives. And you might say they're a little bit maybe simplified, and they probably are, but I think it's still good to have narratives in place to give your employees at least a feeling that they somehow have things in their hands and they are not getting completely lost in an ever more increasing complex world. The first one I want to do is like the King Trump thingy. So this is, of course, Trump depicts himself sometimes as a king, and also this is the theme of the protests right now we are seeing across the US. And actually, this can help us maybe. I mean, we can look at some factors, and those are some like insights or things we can see if we look it up, where Trump has actually acted a little bit like a king, right? You can say this is a good thing or a bad thing. I don't want to go into like a normative judgment of that, but yeah, he's centralizing power. He's weakening Congress. He is trying to bypass Congress at some parts. He wants to incorporate some of those independent agencies. I mean, we're seeing how he wants to influence Fed as well. He is using budget for fast legislation to minimize reviews. He's also questioning some of the court rulings. And he's, yeah, so, and then the last part is that this can be compared to somehow like a king-like behavior, which we saw back in the days. And I think this kind of narrative, and it is a narrative, can actually help us to understand his policies, right? He's always behaving in that way. And this helps us to kind of see his policies in another light. For example, if we think about the tariff war with China or also with Europe, in the end, he was always backing off when it got too painful for him, besides some countries like Switzerland, who really took a hard hit. But in other cases, he backed off because he was aware that still he has some people who need to like the king in the end, and it would be too costly for him. And this is why he was not following through. So if we always think from that perspective, Trump being a little bit like a king makes it easier maybe to predict his next steps or at least understand them somehow. I was very happy to attend an academy this year in Cambridge on foreign politics. And there was one presentation which I found especially useful, and that was from Ruby Osman. She is head of geopolitical policy affairs for China at the Tony Blair Institute. And she somehow in a nutshell says that all the actions which China does in the world are somehow also affected by domestic politics. So things or targets China wants to achieve domestically. So they have like a long-term strategic governance. They pay much attention to strategic planning, long-term focus. They always want to strengthen their national security, self-reliance. I mean, we heard that in the morning with like data on the ground in China rather than distributed among the globes. Want to decrease vulnerability. They have like a very strong central party control. Yeah, they want to somehow save their geopolitical position, especially in terms of technology as well. But it's more because they want to have a good situation within their country. And if we transfer that to some of their geopolitical or foreign affairs approaches, for example, the situation with Hong Kong and Taiwan, this is obviously seems like a contradiction, but for China, that's like a domestic affair, right? Because that was always seen as part of China, and therefore they treat it like an internal problem. And other than that, they are not following an imperialistic scheme. So this kind of like perspective on China, caring much more about inner affairs than other countries, can also help us to put things into perspective. But now, after we have created those narratives and we understand what resilience is, we somehow want to bring that to our company and make everyone, and I'm from risk management, in our bank aware of those challenges and somehow train our workforce. And that's not easy. And we in Commerzbank did 3 things, which I will show you now, which I hope were helpful for the colleagues. and help us to bring that into perspective. First event we conducted was a crisis simulation. So we did kind of like, I don't know if some of you know the United Nations model United Nations, I think. It's like students from around the globe play United Nations in a safe environment. So this was something similar we did. We invited someone who was doing a crisis simulation. In this case, it was female leaders within the company, but also from outside in Frankfurt. And those people divided into groups. They were representing a country. They were electing a president. They also elected an ambassador from their rows. And then they conducted a political simulation. They got a specific scenario, like country A starts war with country B. And how would now the other actors react, like the European Union, the UK, United States of America, Russia, and China. And it was interesting to see because I think most of the participants were really getting into that case and they really took the position of that country. And that goes back to the narratives, right? They were thinking, what would the US do in such a situation? Or what would Russia do in such a situation? Or obviously, European Union, there was always big discussions because there was no unity. So it was interesting for the participants to actually see how those actors would act in such a situation. And I think that was exactly what we wanted to achieve. And I think the key thing here is this was more like a grassroots thing. So female leaders from the whole, like from all the areas in the bank were participating. The good thing about that one is now they spread their knowledge within their departments and get the message actually across. So this is not knowledge which remains within the risk area, but is now also with front office, with IT department, and I think that is kind of key importance. So scenarios happens, those people at least have some awareness of it. Second thing we did, and I think that's kind of a traditional thing, I can imagine that your banks are doing that as well. We trained the top management. In this case, this was like first and second leadership level exercise, and they conducted a scenario-based exercise. So they were split into 4 groups representing the areas, let's say like credit risk area, market risk area, and non-financial risk area. And then they also selected a leader amongst themselves, and there was like a secret agenda, and then they got a scenario, and they were navigating through a complex geopolitical scenario. And it included multiple stages. There were also some things added later on. And in the end, it was the aim to protect the bank's resilience and targets through that situation of crisis. And lessons learned were conducted in the end. And I think what is interesting here is that normally leaders perform quite well in such a scenario, but there are, of course, shortfalls. And I mean, the training is there to detect those. And some are, for example, do all the participants know the committees, right? Are there a way which committee can decide what? Do they act like a leader, or do we have like a lack of leadership traits within our senior management? Do they know like basic KPIs, right? And things come up, like some of the leaders do not even know like KPI XYZ, so obviously they need to learn them if such a situation comes up. Do they know which other department they need to talk to in an event of the crisis? So do they know like the org chart or where something is worked on? So that are kind of the interesting lessons learned from that kind of training, which you then take care of. And the last simulation I want to quickly talk about is again, cyber risk. I mean, I said there's probably not a single presentation today without like talking a little bit about cyber risk. At least there, of course, we do like all of the tests, like external penetration tests, installing malware, and then I think it's really interesting to see how an organization actually reacts to that, and if things are going well. And I completely agree. There's always like an element of spontaneous actions towards that, because you can never actually train all of the scenarios. But at least I think it gets your employees some confidence that in a kind of a crisis they can react in a sufficient way. I mean, we all know like probably the industry with the highest operational resilience is like airline industry. They have standard procedures for everything, and if engine number 1 breaks down, the pilots exactly know what to do, and this is kind of what you can achieve with those simulation trainings. Yeah, coming to the boring part and talking a little bit about frameworks. I think still, of course, you need like strong frameworks. You have said that as well in your presentation. You cannot just do like the fancy and nice simulation, which everyone enjoys, although being a little bit stressful. To be honest. And I just want to point out one framework we have created in the bank, and this is the framework for AI culture. Also probably no presentation today without AI. And we don't have to go into detail for that, but what I want to say with this slide is, again, like looking at culture, I think a framework needs to be understood by every employee. And often we know we have like policies which have 50 pages, written in font size 12, and no one can actually understand them. So we started to draw pictures. So we found a colleague who is very good in drawing, and that's like, he's also a data specialist, but he likes drawing. And now he draws those nice pictures for us. And they are now hanging in some of the offices because people like the pictures. And it actually visualizes the frameworks, and it makes it a little bit easier to understand. And people now know, okay, I have to do this training, skill sets, because it's in there, right? Oh, there's a center of competency for AI in our company. Interesting. I might even read the governance piece, which is a boring policy, but it's on this map, so I'm now a little bit more interested in that. And from my department, we have here, I'm working for model risk management validation, which is probably one of the boring areas you can work in a bank. But we invented Valerie. So Valerie, she's a doctor, and she validates the models. So she's pretty cool. She looks cool. We have hoodies with her now and some cups. So people are now interested, like, what is this validation area about? They have a funny comic figure, which is Valerie, and she's taking care of the models. The models are here. Those are the models. So the thing I want to say, to create this cultural awareness in the company, you also have to navigate a little bit, make it interesting for colleagues, make it somehow understandable, use a simulation, use a game, use a picture. And then you will, in face of a crisis, you will have a more resilient organization because people have actually engaged with the topic rather than just making it another tick box exercise or a boring online training simulation. And I think this is the end of my presentation. I want to say the one last sentence, which is resilience is not a commodity you're born with. It's an attribute that is cultivated over time. And I think this goes back to our personal resilience, right? We can build up the self-esteem. We are worth something. I think the dollar is just a dollar. But we can build up self-esteem if we train it. Organizations can do so as well. So it's something we need to have on our agenda. And thanks for your attention. Thanks, Ronja, for helping me with the presentation. That's it. Any questions?
Thank you. Any questions?
I swear we didn't exchange presentations before.
No, but it was perfect. It was a perfect fit. I agree.
No, I think that the risk awareness, I mean, I'm running the technology part, I think that 60% of my job is risk and 40% is budget. So nothing related to technology anymore. 2 questions to you if nobody else shoots. Okay, Rainer?
I have one question. You really nicely talked about picking up resilience within the organization. That's great. But how much should banks focus on building up, let's say, the knowledge and resilience of their customers? Because that's also important, in particular considering cyber attacks, DDoS attacks. There kind of is a tendency that some banks are afraid of saying that we are under a DDoS attack. They're not giving any comments. The reason is that they fear that the trust of the customer is lost.
Fading.
But the reality, what we fear, at least in Estonia, is that if there is a DDoS attack and this is accompanied by misinformation campaign, then the impact is even larger because people may start panicking and withdrawing money or transferring it elsewhere, even if there is no DDoS attack or it's just a minor thing or whatever. So how important for the banks should be to educate their customers to talk honestly about cyber attacks, DDoS attacks, so that customers are aware that this is the new reality where we are living the banks are not safe if the banks are under a DDoS.
I think that is a very, very good question. There's probably no good answer to that one. I mean, maybe some thoughts from my side. So you're right. I mean, this is always like damaging reputation, right? So I cannot talk for my bank because I'm not in that department, so I don't know how they handle those cases. But I can just imagine that you might be probably careful with like opening up those cases to not show vulnerability. But at the same time, you're right. If everyone does that, right, then it's always hidden and the problem is also not apparent. I mean, and there's also the questions of like cyber insurances and all that related to this. I can still imagine that it might be a good idea to talk with customers about that and making that awareness that something like this can happen. But in the end, it's a very sensitive topic. Also because you don't want to, I mean, if you fully disclose what happened, then it can also create like successing events, right? Then the bad guys, they know, okay, this company is vulnerable. I would try it again. I also want to take on that company. So that is probably a tricky one. But I don't know if there are like any other examples to share how your bank is on that. But I think like creating awareness of the customer is never a bad thing. Also because it can impact your other risk types, right? Credit risk, for example.
Well, I can actually respond to that. Komerční was probably the most attacked by the Russian hackers approximately 12 months ago. So we had DDoS coming in approximately twice a week. In the end, it was becoming a national pride because if you were attacked, then you were somehow, you were considered the proper bank, at least by the Russian hackers, and that was the kind of, created certain respect in the country. But otherwise, I would say that we encourage talking about it quite a lot. The most important element, though, we had an agreement on the Czech market among all the existing banks that we do not compete in terms of security. We do not use any of the kind of like the security-related messages saying we are more safe, we are not being attacked, etc. It can hit absolutely anybody, and therefore it was quite helpful that the market decided we talk about it, we share. And then, yes, they feel sorry that you are down, but if you say that it's a DDoS, then everybody understands. They just do their payments 2 hours later and all is good.
But you thankfully recovered from that, right? So,
I mean, in the end, it became already such a nuisance that you just don't even notice there is another DDoS happening somewhere, but you have your own mechanisms fully in place. But I have a question to you. I mean, there is a lot of talking about being like more risk aware, being able to assess risks properly. And sometimes I feel that the organizations are losing in the process of like managing risks and assessing risks. They are losing the ability to take any risks. Because you look at all the list of 100 things that potentially can go wrong, and then eventually you stop doing anything at all. How have you solved that part in the bank? I mean, how do you still take risks? How do you say this is the okay level? Don't go further than that, but do that.
I think we have not solved it, but it's like a constant discussion, right? I rather prefer this kind of like creating risk awareness rather than just putting out like regulation and tick box exercises, which actually no one follows. So I think we talked about that earlier today, that people just see things as a tick box exercise and they don't follow the rules actually, but just on paper. So I would rather prefer that. But of course, like risk taking, therefore you need to define risk appetite. This is always a big challenge. But I think what helped us in the bank is that we actually defined those narratives and we said, yes, I mean, times seem to be so uncertain, but are they actually, right? I was talking before about the narrative on the US or in China. Is it really that uncertain, or isn't it actually easier than we think? We just, maybe media also drives us a little bit crazy with like this news and that news, but is it really that much of a news, or is it just, again, like feeding that narrative of Trump acting a little bit like a king, but then in the end he might still back off. So I think through that, we also saw some potential of taking a little bit more risk than just seeing the world as being messy and stepping back from everything, and now we are only doing Germany and nothing else, because nothing else seems to be too crazy. But we are seeing now still a partner country, right, where we can actually do business. But of course, it's a constant struggle of defining risk appetite, and I think we especially are more like our core business is like credit for corporate clients, so we tend to be a little bit risk averse, overall, which I think is not a bad thing, but yeah.
Thank you, Jonathan.
Welcome. Thank you.
So, our first presenter, Belma, was not able to join us physically. But we have at least recorded her speech so that whoever wants an extra appetizer before the dinner starts, then there's an opportunity to hear it after the panel. But let's move on with panel. Deepfakes and synthetic everything. Are we building systems for criminals? Moderator will be Irma. So she will guide us through the topic. You have changed the job since the last time I saw you, I guess. Yes. Okay. So, and there will be Rainer from Bank of Estonia, Igor from DashDevs, and Dimitrios from Swinburne University of Technology. You actually came from Australia all the way here?
Yes.
Okay.
Arrived a couple of hours ago.
Okay. So
yes.
you are still
still
jet lagged. Okay. Excellent.
It's all right.
Thanks.
Last ones who survived this day, and thank you for choosing us. I know that the last session is always the hardest one, but as I know who is here, I promise you it will be interesting. We have some interesting computer thing ongoing, so we will change a bit our way of presenting the topic. What I want to say is that today we talked a lot about risks, about AI, about different surveillance options and different surveillance phases. And here, in this panel discussion, we want to talk about deepfakes and how it impacts us as humans and, of course, as financial ecosystem participants. So, as you have the topic in here, maybe we can move to next slide and see the video. I think it will make sense.
Don't know the video. Okay.
I am not Morgan Freeman, and what you see is not real. Well, at least in contemporary terms, it is not. I am not Morgan Freeman, and what you see is not real. Well, at least in contemporary terms, it is not. What if I were to tell you that I am not even a human being? Would you believe me? What is your perception of reality? Is it the ability to capture, process, and make sense of the information our senses receive? If you can see, hear, taste, or smell something, does that make it real? Or is it simply the ability to feel? I would like to welcome you to the era of synthetic reality. Now, what do you see?
Does it make you think more deeper about synthetic data, synthetic processes? Does it make you feel how the lines are blurring between what is real and what is perceived not so real? And of course, we need to understand with all the innovation which we are having now, the use of synthetic material, it is increasing for fraud cases. And even during the last 2 years, 2-3 years, the fraud cases using deepfakes risen by 2,000%. Actually, even more than 2,000%. If you will show next slide, I don't remember exact number, but it's more than 2,000% now are using deepfakes. So we have great panelists here who will talk about deepfakes and what we can do with fraud cases using them. We have 3 panelists, and we have Dimitrios. I don't know if I will pronounce your surname well, but Solom Basis.
Good.
Perfect, yeah. And he represents academia, which bridges also an industry. He works with synthetic identity, with integrity and cybersecurity. And he works also in university. He represents fintech capability in there. Then we have Rainer Old, who is working in ST Bank. Basically, it's Central Bank of Estonia. Additionally, he has broad experience in central bank, and his major focus is on payments and settlements, I think. And then we have Igor
Tomic.
Igor Tomic, yeah. And he is founder of DashDev, fintech engineering company, and additionally he is also founder for Fintech Garden, who helps us to connect and to be up to date with all fintech info. So welcome, dear panelists, and maybe let's start this panel from first question. Could you, each of you, share one story from your life, from your work, where you encountered deepfake or something, some situation related to deepfake?
I think I have an example, but it's not really a recent one. And I was thinking about deepfakes and how we're actually ensuring that information that we're receiving is valid and real. And I don't think that this problem is really recent, because the maybe first examples of the deepfakes is the notes from your parents to the school, because a lot of kids are actually faking signature or writing of the notes from parents to school. So I think when we communicate about deepfakes, it's not about deep or fake, it's about granting or are assuming that something is real and valid without keeping in mind that you need to use the critical mind. What do I see? So it's not a new problem. Maybe it's formed in new format of the video and photos, but my maybe first experience is having the fake notes from parents that kids are bringing to the teacher and saying, yeah, that's the note from my parent that actually I was sick and not missing the school.
Thank you. If I could add to your comment, is that maybe the concept is not that new, but the easiness, how easy you can use deepfake fraud, is what raises concerns for financial institutions. Then, could you proceed? Who would like to proceed?
Yeah, I can share, let's say, about deepfakes. The brightest memory is, and that was not related to financial crime, but I recall Madame Lagarde, the ECB president, had a Teams meeting with President Zelensky, and President Zelensky was a deepfake. So it's and genuinely everything seemed so real. And that actually relates to the financial crime. We have had also in the world incidents where huge amounts of money have been transferred because people have been validating the transactions via Teams meetings. So everything what is digital, in today's world, if it's not you cannot fully trust it anymore. I think since 5 years ago or something, at conferences, people started telling, or experts started telling that even at home, agree on a safe word, that if someone asks you to transfer money quickly, then use the safe word, otherwise you cannot be sure that this person is calling you. And that brings me to the fact that currently we are facing a pandemic of fraud, of payment fraud, financial fraud. And this is because of, the AI models are so nice and it's possible to mimic the speech so well. And then the customer is already hooked and basically renders his or her identity to the fraudster. And then we see bad things happening. The account is being emptied. The customer gets loans in addition, and so forth. So there is a pandemic. This is of strategic importance in Europe to prevent and also protect the customers. It's in the legislation. We can talk about it a little bit later. And I think in each country at national level, in Estonia, we are also, let's say, looking at this a lot. But the 9-month figures already show that we have passed the volume of last year, and it's growing. Each day we hear about different attempts, and it's, I think in countries which have really a good e-identity solution, such as Estonia, it's so convenient to use, but it's also so convenient to get frauded in this way, and in some cases it's really difficult to educate the customers. I will stop here because I have also a point that you make what actually banks can do on this point.
And Dimitrios, maybe you would like to tell.
Sure. If I may, I'll just give you a flavor from Australia. So in 2025, in Western Australia, we had scammers who stole 10.8 million from 48 victims using fake celebrity endorsement via deepfake. So basically, a very famous politician actually was put in a video, and it was all over social media, and basically promoting investment schemes, which are of course Ponzi. And what is interesting is that people believe, and I think the notion of impulsiveness and the notion of people wanting to trust something, this is where I think one of the biggest challenges is when it comes to deepfakes. And of course, a personal example that I have is when you receive a phone call which goes into voice cloning, and it was actually the voice of a friend of mine who was presumably in need of help. But for me, it was very critical enough because I had spoken with that person a couple of hours earlier, and I knew where he was and what he was doing. But you can fall into this very, very easily. So it's very scary, especially for elderly population and people who probably are not that, tech savvy, or and I'm going to make a final comment later on, but all of this requires a stepping back. It requires critical thinking, and unfortunately, what deepfake and scammers do, they really push the button towards impulsiveness.
Yeah, totally agree. I could ask some of you for examples, but I know that then we will take even more time and you are waiting for evening. So I will ask to vote you. And I have a nice sentence, and I would like to get yes, the ones who agrees with it, so that they would raise their hand. And what I'm stating is that soon, providing that you are human will be harder than providing that you are not. Who agrees with this statement? Not yet. This means that you are not exposed to deepfakes that much yet. And beware, because they are coming. Okay, if we have such issue in financial ecosystems, what we can do about it? How we can what solutions we can use, what we can set up in companies or in our even daily lives so that we could at least be safe or resilient.
So I can start once again. I'm always trying to think like what exactly we're dealing with and what we're trying to fix. And in this case, the visual identity is becoming something that you have to be checked as authenticity. So that's an issue. And I think just taking it from equation that if we see someone, we cannot guarantee that this is the person is fixing it, because if we take a look on the current solution with the digital platforms, SMS is no longer valid as a multi-factor checks because SMS can be hijacked, operators can give a backdoors to read it, etc., etc. So we're using other methods as multi-factor authentication, one code generation, something that you know rather than you have. And usually the process is combining several factors, like what you have, what you know, what you have an access to. And by combining those methods, we will become better with the checking the identities. And I'm trying to take a look at this on more as a spear and shield approach, because always the innovation in technology brings an ability to build better spears, but also the better shields. So right now with AI, we can say, okay, that's an image, is it fake? But the same way, AI can analyze and say, is it digitally edited AI video or the real one? Because the math statistics can, with the real video, can be looking different. Like, if we step back, even before the AI and deepfakes, people were submitting documents, and documents can be edited digitally. And there is a lot of software which can find those areas which were digitally edited and then find it out. So the same might be happening with the deepfakes. So I think it's better to understand what we're solving and what are the tools for solving those issues rather than specifically aiming on the deepfakes.
Yeah, so basically you would look at it from technological point of view. What are technological solutions or process-related solutions which could help you understand if the thing you see is what you expect to see?
But let's split two different issues. One is when you're falling into the scams with the deepfake AIs, or when you're using the visual identity to access the financial institution, etc., etc. Two different cases. We cannot fix the critical thinking of people even being in populist era, because everything what is happening right now around us is populist. TikTok, Instagram, marketing, like people are telling you the things which are not real. It's not possible to fix. But if we come into the usage of the technology and financial instruments, we have the control, we understand how to build those protocols, and I don't see any other ways rather than fixing through the technology.
Maybe I will continue. You said nicely that SMSs are hijacked. I have to say that in principle, the technology is used by fraudsters to hijack people's minds. Because when I said that people are hooked, then basically if a person looks at a really nice investment opportunity or a love scam, and then the person actually wants to do the payment himself on the bank, in the bank, internet banking. And even if the bank currently says that, sorry, this is a fraudulent account, don't do the payment, and the banks do. Today, many people or customers then still say that, yes, I want to do the payment, I will do the payment, and you cannot stop me. And the banks are then faced with an issue that actually they cannot stop the transaction. Here, of course, it's a good thing that the legislation now changing will enable the banks to stop these kinds of transactions without the banks having to fear that they will face liabilities or that the customer can then sue them and claim money. I think that's one really important thing. And then the other thing is to exchange this information about those fraud-related accounts, and there are also solutions out there, and this will be enforced with the legislation. The second part now is when the customer is hooked, either, I don't know, a Teams call or a phone call, impersonating the bank or whatever else asking for the really nice identity, because in Estonia we have a really nice e-identity, and then smoothly asks me to identify myself. I put my PIN 1. Then to do something else, I put my PIN 2, and then I have lost all my money. But in this case, actually what the banks can see is that the customer is not actually on the bank account. The customer, yes, in person or on the phone is actually confirming the transactions. So there is strong customer authentication. And in principle, the bank is not liable today. In the future, the bank will be liable under the payment services regulation for this impersonation fraud. And now the question is how actually banks can identify that the customer is actually not the customer who is moving around in the internet bank. And here, of course, the old things are the whitelisting, blacklisting, the devices, everything. That's all fine, but it's also, I say it's the digital fingerprint of the customer. How I actually log into my bank account, where I move, how fast I move. The technology enables to identify that. And if at that point of time the fraudster in parallel actually moves himself, the bank actually, if the technology is used, can immediately understand that that's not the customer, let's block the account fully. And then contact the customer and saying, what were you doing, or you are being fraud. And I think that is one important thing to consider. It's not mature currently. It has to mature to keep pace and to fight the pandemic of the fraud which we are currently facing.
If I understand correctly, so what you suggest is to include behavioral analytics into banking applications.
Yes, I think it's a must.
Because I know that there are some applications in phones which know that it's me just by how I type or how I walk, because my phone is in my near me all the time. So you say that we should maybe go that way and mature the technology.
I think there is no other way. In principle, what the legislation, the Payment Services Directive 3 and the Payment Services Regulation now pose is that if the customer is then frauded like this, and this is like proven, then the bank is liable. The bank will pay all the amount back to the customer. And then I think it's, it's mathematics. Either the bank takes the risk and pays the money back, or invests so that the bank can prevent these kinds of fraud of happening. And here we have the technology. This has to be developed further, matured, and rolled out.
Dimitrios.
So when it comes to digital identity, in Australia we've got what we call a 100-point system. So basically you would be required to provide information coming from different types of sources. Now, there are a couple of banks in Australia that they are piloting access to geolocation. So basically, when you call, they are able to track you down from where you're actually calling. However, I must also say that we talk a lot about the financial institutions' duty of care, but I think it's about time we start talking about individual duty of care. And at least from the Australian reality, banks are becoming way less willing to compensate. So and we have a new law coming in that it will make it even harder for individuals to claim from banks, even though they might have been scammed. So this is a very tricky situation, and I think, and I totally agree with both the other panel members, it's about triangulating multiple types of data and multiple sources of data, and I think Gen AI can definitely do a good job there to be able to, give us access to financial information, digital identity information from social media, which of course creates another loop, because if we have a cyber attack and all this information is being put on the dark web, then that's another risk. But I think the whole purpose here is to authenticate reality rather than simply to authenticate digital identity, which makes things even more difficult.
Mm-hmm. Yeah, but who should take the lead? Is it regulator? Is it banks should self-regulate? Or is it who is responsible for providing such similar solutions?
Self-regulation doesn't really work. It might work as a pilot, but you need strong regulatory support from that, especially in such a highly regulated industry, which is financial services, and especially banks. You know very well they don't want to be fined, they don't want to be, be deemed non-compliant, and their risk tolerance and risk appetite is becoming way more higher at the moment, and especially the moment they see a fraudulent or a maybe spooky transaction, it's not only blocking, but it's actually stopping the person having even access to all the financial accounts and all that. So debanking to, in inverted commas, is going to become, I'm afraid, is going to become more of the norm, especially when it comes to these kind of transactions.
What if some regulators can't keep up?
I think it's not about regulators keeping up or not. It's always really tricky to start regulating concrete solutions or technology, because that moves faster than regulation does. And we have seen, when strong customer authentication was enforced in Payment Services Directive 2, then this was nicely rolled out and it made payments more secure. But now, in time, the technology has evolved, and we see the rise of fraud with strong customer authenticated payments. And the issues are, let's say, not necessarily related to the strong customer authentication or EID being safe or not safe. I think it's safe, but as I said, the customer is hooked and the customer is doing it willingly, or let's say, basically at that moment of time willingly. And the way out to motivate and self-regulation, so to say, is to put the liabilities. Currently, of course, the Payment Services Directive puts liabilities on the banks, but it's a shared responsibility in principle also with the telcos, who also fight the scams. They block lots of SMS and phone calls and so on. And this cooperation has to get even better. I think there is also room for improvement. And currently, how I see the things, that it's not the pandemic in Estonia only, it's in Europe in general, in globe, I think, or at the global level. So there is kind of appetite of all the relevant stakeholders, from the financial sector to telcos to the ministries to police, to get around one table and agree on pragmatic measures. I see that it's in Estonia. I see it also in Europe. So the ground is ripe to do something in reality. Yes, in some cases it might seem unfair that some liability is put directly to the bank if the customer has authorized the payment herself or himself. But the thing is, you have to protect the weakest link, and we do try to educate the customers. But we have to admit it's so real. In the past, the phone calls were maybe more, let's say, like a robot is calling you, but now it's so real. So it's we have to do something, and I think the strategy which has been outlined in Europe, I think it's into the right direction. But now the self-regulatory part with the technology, let's use the technology, let's build it up together and roll it out as fast as possible. I think that we don't need regulation saying that you have to do it.
Yeah, but then who takes the lead? Regulator?
I think here the public sector, the Commission, and also the central banks will be taking a lead in the financial sector, definitely. Of course, we have the financial intelligence unit to combat money laundering and so on, because that's the aftermath. But we have to focus, I think, on the prevention side, not making it difficult to clean the money, but making it difficult to do the business, because that's an entire business, how to build those schemes also. It's another really interesting let's say, topic worth of another presentation even.
How could it impact customer and convenience for the customer? Because if you add additional regulations, of course, it will be boiled down to banks and financial institutions implementing them, and most probably it will have some kind of impact on end user. Or can we do that somehow transparently without impacting their convenience? Any ideas?
I think in this case I'm coming from master degree in information security, and there is a formula. The security is 1 divided by usability. So the more unusable interface is, the more is secure. So basically, the unplugged computer from internet is the most secure thing, but it doesn't do anything. So in this case, it's pretty hard to keep this balance, because once again, the both sides are evolving, and the dark net and the gray area of scamming people has huge budgets and huge margins, which investing into the technology. So it's basically competing against like what technology and budgets and resources we have, and what are the other side that is also competing with us. So it's pretty hard, and I think it will be more messy. My vision is that if people will have skin in the game, like if I'm doing something but then someone else is liable, it doesn't bring much thinking to my side, but if somehow I will be liable and I will have skin in the game, but several times I will start like asking questions, putting my critical mind, and not really willingly giving money away to other people. So maybe that's one of the things that we should keep an eye, or educate, I don't know, our kids and our generations who are struggling with that, educate them as a first step, because it will reduce these frictions with the fighting against two parties.
Thank you. Do we have some questions from audience? Yes.
You have said that UID should be, UID or digital ID, digital wallet should be the next generation of today's OTP SMS. And today's OTP SMS are hijacked and so on. So how is it like trusting another factor, which is the evolution, currently, let's say, wrong situation? How will this be safe? Also, the second part is that you mentioned about this 100-point system. Is the diversity of those kind of factors a better improvement or a next level, next generation of having this trust of identity?
I can talk about the second part. Yes, the diversity of the sources of information is this what the banks are looking to achieve. So basically, they would be looking at different types of information, which are actually information and data and that, from verifiable sources, government-based, of course. So this way, they are trying to minimize the fact that even if you may have, your ID faked, or a particular document might be fake, you still have others which would even make them even more harder to be fake as well. So, but it's not an ideal scenario. It's something that is bringing more bureaucracy, but probably opens for more mitigation phases as well.
And I can answer maybe the first part. And in this case, I think we always thinking that the issues that we are facing, they're new. No. Think about the spies, and they have kind of the similar issue. If you need to encrypt the message and send it back to your center, you don't have an ability to prove that you're doing it. And the way actually in math and in cryptology has been developed like years ago. You have one-time passwords, you have like offline password generators, which are able, and then more modern solutions like quantum computers, because when you observe the phantom, then it changes. So something that can be used one time, or if you're observer and trying to steal, then it changes. So I don't think that it's a question what replaces SMS. It's the question how we understand that something that we think is secure as with the operator still can be hijacked. And another recommendation is to see the videos with the founder of Signal, because this chat was particularly designed with the perception that everything from infrastructure to end-to-end can be hijacked, and they put it as the values into the chat from the beginning. So the security starts with the thinking rather than fixing certain things that doesn't work.
Any more questions? If no, yes.
Maybe I just wanted to jump a little bit back because you said about customer convenience, and I just want to make the point that even if today the banks have had the concern that if they start, I don't know, based on the devices or IP addresses, start blocking access to bank accounts, then maybe there are false positives, and then the customer relationship suffers. I agree. There might be, if we tighten the rules or the security, then there might be collateral damage. But first off, this is for the greater good, for the greater benefit, and these things also help the customers to learn that actually they have to pay attention. But the second thing that I want to reiterate is that even if you have strong EID solutions or whatever solutions to identify yourself, then for the banks, it's important to understand whether the digital person in that bank account currently, basically in the internet bank, moving around there, whether it's actually the bank's customer. And then I think that is key. That is where we are today, because the typology of the fraud shows that it's not about anymore the weaker authentication tools. It's about the customer is hooked psychologically, and then the customer actually cannot save him or herself anymore. The customer is gone. The customer may even lose the house or everything, basically, because the customer has given away the identity. And now the question is, who will save the customer, and who can save the customer? And if the things are happening in the bank account, of course, the bank can see with technology whether that's the customer. And similarly, other, let's say, in the public sector, in the private sector, where there is a possibility to cause some financial damage to the customer, those entities should also try to adopt these kinds of technologies to identify behaviorally the customer. Thanks.
Dimitris? If you don't have any more comments to this, I'm just looking at the time, and I know that everyone wants to get ready to the evening part.
I have a final comment, if I may.
Yeah, I would like to ask each of you to provide one key message which you would like to know for our audience.
So, look, the surface of scamming is growing, and it will keep on growing. And I think one of the things we really need to remember as individuals, we need to do our proper duty of care, but at the same time, we really need to start rethinking our presence in the digital world, what kind of digital footprint we live, and do a digital hygiene. That's from an individual standpoint. And from financial institutions, they really have to fight a very massive and expanded surface. Sophistication of scams will keep on growing. And look, potentially all of us are hackable at some point. So starting with this, and it's not about, constantly challenging reality and challenging everything, but it's a culture of being cautious. And I think, unfortunately, this is what the future will be.
Thank you. Reiner?
I think my last point was already kind of the concluding, so I will save time.
Maybe the small comment on Dimitrios. Everything is hackable. The question is how much resources should be put there. So I think the formula is here to make the easiest schemes which are working right now harder to implement and to run, and then it will decline. But there are good examples, like we know some Middle East countries who on the government level were hacking the platforms of operating phones or operating system of the phones to have an ability to read the messages. So then it's not about even the resource of the particular scam group, it's the resources of the government deliberately hijacking your data. And it's unavoidable. That's a question of the price for that.
Thank you. So, one last message from me. When we are talking about deepfakes and about any other fraud cases, we're all running on synthetic data. AI is enabling and to secure and to hack. What we need to do, we need to understand that truth can be faked. And what we need to do, we need to understand that trust needs to be designed by default. And it's emerging area too. Thank you.
So, thank you everyone. We have still a video of Benoit.